recording. Once the recording starts, I want to make sure the audio is clear once again, because I think the last time when the when the recording started, the audio went away. So I just want to make sure that, okay, record on this computer. All right, everything's good. Audio clear, 1 2 1 2. Can I get a thumbs up? Thumbs up? Yeah, perfect. Awesome. Okay, perfect. So, good morning, good afternoon to everyone, whoever we have here from all around the world. I really appreciate you guys took the time, you guys taking the time out and coming in. So this, for some people, this is going to be a refresher. For some, it's going to be some repetitive information, but it's also very good. For some people, this is going to be a very, it's going to be something very, very new, something they haven't done before. So I'm going to keep my pace nice and slow. I'm going to keep my pace very simple. Um, I think so. What we're going to discuss here is we will discuss exactly how we trade on the live streams. I mean, the methods I will discuss here, the way I trade has made me considerable amount of income here from Forex. So we're going to go over some very basic concepts leading on to some very advanced concepts as well. Sometimes some things are going to be very repetitive, and I do believe that when you start repeating different things, you understand them much better. There is some disturbance here. Let me just mute. Can everyone please mute yourselves? It's going to cause some unnecessary audio noise, which we don't want. Brian Miller and Terry B. Can you just mute yourselves? It's going to be, I'll appreciate it. Okay, so let's start ahead. The order of business is first we're going to talk about what exactly is Forex. Then we're going to talk about different market sessions. What are they? How are you going to trade it? Most importantly, how are you going to choose your market sessions there as well? We're going to talk about currency pairs, how are they correlated, minor and major pairs. We're going to talk about how price is measured in pips, what are lots and leverage. So risk management. When we talk about risk management, I've divided it into three parts: 1.0, 2.0, and 3.0. These are basically spread across the presentation. We're going to have breaks. We're going to talk about time frames, candlesticks, different types of candlesticks, and how you can use them to gauge momentum, how you can use them to gauge some sort of volume in the market as well. We're going to talk about how market moves, basic ideas of support resistance, risk management 2.0. We're going to talk about momentum versus volatility versus volume. This is going to be something very, very important. We're going to talk what is the wick fill, breaking down the wick fill, risk management 3.0, and then we're going to dive into some very heavy technicals here. I guess if someone is having sound issues, I'm 100% sure it's on your end. The sound is perfectly working here, correct? Yep. No? Yeah? Yes. Okay. Awesome. Perfect. Yeah, sound's working. Awesome. Let's move along. Oh, also, we're also going to have a guest. We're also going to have a guest after our basic information here, so I think that's going to be very interesting too. So when you talk about Forex, what's the first thing that comes to your mind? The first thing when I heard about Forex was, okay, it's a $5.2 trillion market. You know, when you say it's a $5.2 trillion market, this means is that someone can say, oh, okay, well, it's a huge market. If it's a huge market, this means that it's bigger than the stock market, right? It's a decentralized market as well. So basically, what happens is when someone starts to learn about Forex, they're told it's a $5.2 trillion market. It's open 24 hours a day, 5 days a week, right? You can make money at any time you want. You can, like, wake up, you can start to make money. You can, like, trade from anywhere in the world. Now, those ideas are very valid, but they're also false, because the thing is, the when you start to trade, hold on one second here. If people are having issues, okay, awesome. So it's working. Everyone is awesome. Perfect. Right. So continue on. So when you're trading in the sessions, what happens is that you have different sessions that are at your disposal, right? You have your New York, you have your Asian, and London. So basically, what happens is now you have to make a mind. Now you have to choose which session are you going to focus on. Are you going to focus on in the morning, evening, or late at night? Those things, when we want to discuss those things, they will play a vital role in your trading plan. So that's going to be very important. Um, as we go along the presentation, we will talk about a lot of rules. Those rules are going to be based off of technicals, based off of psychology as well. So once we're moving through the presentation, sorry, I'm just getting sidetracked with all the chat here on the side. People are trying to come in, but I think yeah, it's all working fine. There's no issues here. I have a limit of 1,000 people on Zoom, so we're only at 320. Okay, let's continue on. All right. So first, what we're going to do is we're going to talk about the market sessions, right? First of all, you have the Asian session. The Asian session, and then you have the London, and after London, you have the New York session, right? When you're starting trading, you need to first realize that, okay, what time of the day is going to suit you best? Is it going to be in the evening time? Like, if you live in North America, you're going to have evening time, and then you're going to have in the middle of the night, and then you're going to have in the early morning, right? So what I like to do is I like to break them down into smaller times, right? So when you talk about the Asian is divided into pre-Asian and the regular Asian session. Pre-Asian starts from before the Asian Open. This is from 6 p.m. Eastern to 8 p.m. Eastern, right? Let's say someone who works in the morning, and if you only have time to trade in the evening time, then you're going to be looking at pre-Asian to Asian, right? Once the Asian session opens, it starts from 8 p.m. to 10 p.m. The reason I'm discussing these specific times, it's because these are the times when there's a lot of volume in the market, right? You want to trade when there's volume in the market. Now, of course, you can say, okay, you know what? Trading happens throughout the day. Like you can sit from 10 p.m. till 1 p.m. and still find trades, but the thing is, there's not enough volume. We only come to trading at certain times when there's going to be volume in the market, when it's going to be busy, when there's going to be a lot of things going on, right? So this is going to be the Asian session. If someone's looking to trade Asian sessions, in my opinion, these are the best times to trade. I personally trade from like if I will be trading the Asian, I'm going to focus on 6 p.m. to 8 p.m. Next, you have the pre-London. Pre-London starts at 1 a.m. till 3 a.m. Eastern. I'm not sure what time it's going to be in, like, in the UK or somewhere in Asia, but this is based on the Eastern time zones. Now, pre-London is basically before the London opens, when you see some sort of volume coming in. The reason the sessions are divided into pre and like the mid sessions is because you need to look at it from a perspective of, okay, like let's say you go to the bank, right? Let's say you work at a bank or you work at a hedge fund, and in the morning you go to the hedge fund, in the morning you go in and you're like, okay, let's see what happened during the night. Let's see what happened in the London so that we know how to manage our trades in the day moving forward. So that's when there's a lot of volume in the market. As you come into the time when there's 3 a.m. to 5 a.m., this is when the London session opens, and then there's even more volume in the market, right? Because that's the most busiest time in the market. So let's say for someone who only has time to trade at this specific time, this is going to be the best time for you to look at the charts when there's a lot of volume in the market, momentum in the market. Because if you look at the time between 10 p.m. Eastern and 1 a.m. Eastern, there is some sort of volume. You can still find trades, but there's going to be like low quality trades because there's going to be no volume in the market. You're going to notice that I'm going to say volume a lot. I'm going to say certain phrases I'm going to say a lot repeatedly. And I think that's very important to truly understand that you really need some sort of volume, some sort of momentum in the market, some juice in the market so you could get those bigger candles to trade. Now, moving on, you have pre-New York. Pre-New York starts before the New York Open. This is when you have when you go to the futures market, it hasn't opened yet, but you try to see that, okay, what's the futures market doing? Is it negative, positive? So that's what the pre-New York is. Now, normally for me, when I wake up, I have the time to trade between 6 a.m. and 8:30 a.m. That's what suits me best, right? Because if I'm going to look at the London is not going to suit me best because this means I have to wake up in the middle of the night. That's not logically feasible for me. So I focus on the pre-New York till almost until New York open till like 8 a.m., 8:30 a.m. Eastern. Um, one now. After this time, what happens is you have the London close, right? And there's a lot of volume in London close as well. The reason why is because when the market is closing, it's processing the orders that happen throughout the day. And whenever you process the orders that happen throughout the day, there's a lot of volume in the market too. So in my opinion, these are the best time frames, best times in the market to look at when you're trying to decide, okay, what time is going to suit you best. Now, let's say if someone says, oh, okay, well, I'm going to start trading from 12 p.m. Eastern onwards to 4 p.m. Eastern. The problem there becomes is now you're trying to trade when the London session is closed. You're trying to trade when the Asian is closed. You're trying to trade when the New York session is the afternoon session. There's not enough volume in the market. At that time, what you might find is there's going to be a lot of consolidation. You might find there's going to be some sort of choppy movement, something you haven't seen before. Like it's not going to be a very good environment to trade. So it's if you want to take pictures of the screen, go ahead. But I think these are the best times to trade if you're looking for solid entries, if you're looking for solid moves. This is very, very important, right? So if you're gonna, I think as we go on, this is going to be a way to create a trading plan as well. So you need to see, okay, what time is going to suit you best, and what time can you dedicate to the markets? Because the thing is, you're not going to be spending more than 3 hours on the charts, right? You will only be spending around maybe 2.5 to 3 hours and nothing more. So market sessions, and that correlates directly with what currency pairs do you trade, right? First of all, we chose what session is going to work for us, and now we're going to look at that, okay, in these sessions, what currency pairs are going to work best, right? This is really important too. So first we have the major currencies, which are your your USD pairs, your euro pairs, your pound pairs. These are your major currencies. Right now, when you look at the spreads on these major currencies, they're relatively low than all the other minor currencies here, which are like your euro against the pound, euro against the yen, AUD versus New Zealand, and so on and so forth. Right? This is important in a way for you to understand that, okay, which pairs are going to have the most volatility, or which pairs are going to be the easiest to trade in different sessions. Now, one thing really important to note is how are currencies correlated in different sessions. This is also extremely important. Now, when you're talking about the Asian session, what you're going to find is now in the Asian, you have the yen that's open, you have Australian dollar, New Zealand dollar, and then you have some sort of movement in gold as well, right? So now, when we talk about, okay, let's say someone says, hey Raja, what I'm going to do is I'm going to trade GBP USD in the Asian session. So let's logically think about it. Is the pound open in Asian? And the answer is going to be no. And then you say, okay, is the USD open in Asian? And the answer is still going to be no. So it makes no sense to look at GBP USD or GBP CAD to trade in the Asian, right? Because you need to look at the pairs that are actually open in that session. Let's say we have your, where's my marker over here? Let's say we have your USD JPY. Let me just write down over here. Let's say you have USD JPY, you have GBP JPY, and then you have Euro JPY, right? So now this will be sort of interesting here for some people. Now, when you're looking at USD JPY in the Asian, you're going to notice that there's only JPY that's open in USD JPY, there's only JPY that's open in GBP JPY, and there's only JPY open in Euro JPY. So in the Asian session, you might find that all the JPY pairs, they tend to move the same way, right? If you're going to say that, okay, in the Asian, what's going to happen is that your JPY is going to move bullish. So if you backtest, if you look at the charts, you're going to notice that with your JPY, GBP JPY also moved up. USD JPY also moved up. CHF JPY also moved up because they all are open in this, like only one currency is open in the Asian session, right? If you look at, let's say, AUD JPY, what you might find is that maybe AUD JPY, it may not move as these two pairs move. And the reason why is because in AUD JPY, both AUD is open and JPY is also open, right? So now you have a fight between two currencies. So whenever you're looking at a market session, you're always looking at that, okay, I want to choose a pair that's only influenced by just one currency, which is why like my main objective in the Asian session is to only focus on either the pound yen, the euro yen, or the USD yen, because I know that from these pairs, it's only influenced by just one currency. I'm not going to look at AUD JPY because I know that, okay, in the Asian session, AUD JPY is influenced by the Australian dollar and the Japanese yen, so it would make no sense, right? So now if we move along to the next session, next we're going to talk about is going to be the London session, right? So when you talk about London, you're talking about the pound, you're talking about the euro, you're talking about the Swiss, and you're talking about gold as well. So the same thing applies in the London session here. Now, one most important thing is that currencies have both strengths and weaknesses, right? And the easiest way to identify strength and weakness is just by looking at the chart and see what the correlations are. So we're going to talk about that later on there as well. But what I really want to emphasize is on the fact that, okay, let's say you choose GBP, Euro GBP, right? Let's say someone says here, let's say we have Steven, right? And Steven says, hey guys, you know what I'm going to do? I'm going to trade Euro GBP, right? So when Steven is going to try to trade Euro GBP, he will have to make sure that for him to have a profitable trade on Euro GBP, he would want one pair, like one currency to be really weak and one to be really, really strong, right? That's the only way you're going to know that, okay, now the pair is going to move. But if both currencies are strong, then there's a very, very high chance there's going to be some sort of consolidation. Then it's going to get really hard to trade, right? So for someone like, let's say myself, if I was a new trader and if I chose the London session to trade, I would maybe go ahead to focus on maybe GBP USD or GBP JPY, Euro JPY, Euro USD. I would want to choose a pair which is only influenced by just one currency. It just makes sense in that aspect, right? So now when we move along to the New York session, now you have an entire stable of currencies that are open. You have the USD is open, you have CAD is open, you have pound is open, you have Swiss and gold, right? Now gold is mostly moved based on the Australian dollar, because like, with the Australian dollar, gold is directly correlated. I don't expect anyone to use this information based on their trading because it's a little bit of an advanced concept. You have gold is also influenced by the US dollar. Gold is also influenced by the yen because they're both safe havens. Now, when you talk about the New York session, one mistake I see people make is that they will say, okay, I'm only going to focus on GBP USD. Now, there's nothing wrong in that, but when you're looking at two currency pairs that are heavily moved by, that are heavily correlated, like let's say if the pound is strong and the USD is strong, so it's going to get extremely hard for you to trade that pair because it might start ranging. Now, sometimes what happens is that if you're looking at let's say you're looking at GBP JPY and also you're looking at GBP USD in the New York session, and sometimes you might say that, hey man, like how come GBP JPY in the New York is moving bullish, and how come GBP USD in New York is just consolidating, right? And the only answer to that is like, okay, when you're talking about GBP JPY, what's mostly happening is that there's only one pair that's moving in GBP JPY, and when you're looking at the New York and you're only looking at to see that, okay, why is the pound yen moving up? You come to a conclusion that, okay, maybe pound is really strong. If GJ is moving bullish in New York session, that means the pound is strong. But if the GBP USD is consolidating, that means even if the pound is strong, maybe the US dollar is strong as well. That's why sometimes, all the pound pairs, they don't move the same way. This is very important. So what you might find is that maybe GBP/JPY and GBP/USD, they move the same way in the London Open because it's only influenced by one currency, that's the pound. So whenever you're looking at the pairs and the sessions here, you're looking to see that, okay, which pair is going to make sense to me first. So if you're writing down your trading plan, you're writing down which session you're going to trade, and then you're writing down one or two pairs that you're going to focus on. It's extremely important because the thing is, when you're choosing a currency pair, you're going to notice that every currency pair is going to act the same way in every session. So I've been looking at GPJPY for a very, very long time, like almost like 2, 3 years, and I've noticed that it has almost the same movements in every New York session. It's going to move differently in London session. It's going to move differently in the Asian session there as well. So that's why I think it's really important for you to choose one or two pairs and only focus on those pairs at specific times of the day. Because if I were to trade GPJPY in the London Open, I won't be able to trade it because I don't know how it moves in the London Open. Just like when someone says, "Oh, hey Raja, let's do a GBP USD simulation in London session," and I wouldn't know what to do with it because I haven't looked at GBP USD in the London session. So it's very important to just focus on one or two pairs and just focus on one session. It's going to be a very slow process, but at the end of the day, you're going to start to see similarities. We have some experienced people here in the Zoom session that have done that, and they have seen some very profitable moves that they can catch every day. So let's move along here. Now, I want to do a sound check here again. Is my sound working fine? Perfect. And 67161. Okay, let's move along here. Can we ask questions right now or later? We will ask questions in the very, very end. So I have reserved a separate thing for questions and answers. Okay, so now we talked about currencies and pairs, and we also talked about the sessions. Now what we're going to talk about, how do we actually make money from the pairs? What are pips, how are pips calculated, and how do we go about that? So now change in price of a pair is measured in pips. It's 1 pip. Now when you talk about 1 pip is 10 micro pips or points. That's what pips are. It's a very basic concept, but it's very, very important. So now, in the same way, when you talk about 10 pips, 10 pips equals to 100 micropoints, or 100 micropips. So basically, what we're going to see is we're only going to talk about pips in terms of pips. So when you say, oh, my price moved 10 pips, that's going to be like, okay, it's going to be like 100 micropips or 100 points. So for general talking terms, we're only going to focus on like 1 pip, 10 pips, 15 pips, and so on. So when we're talking about, let's say, GPJPY, right? And for example, GPJPY moves from 131,220 to 131,120. That's a difference of 100 points, which also means it's a difference of 10 pips, right? So if you had a buy order at 131,220 and price moved at if price moved 10 pips below, that's going to be, now you're going to be in negative 10 pips. But if you had a sell order at 131,220 and price moved to 131,120, now you're going to be in positive 10 pips. Some people are very, very new, so this is very, very important here. This is how you measure pips, right? You're subtracting the numbers, you're getting the 100 points, and then you're dividing it by 10 to get 10 pips. And when we talk about, let's say, Euro USD, and we're looking at, okay, if price moved from 1.08400 to 1.08150, that's a change of 250 points or 25 pips, right? So this is how you're measuring pips. So let's say if you're saying that, okay, I had a sell order at 0.08400 and price moved down to 0.8150, this means now there was a change of 25 pips. So now I'm positive 25 pips. But if you had a buy order at this point, then you're going to say, okay, now I'm in negative 25 pips. In the same way, when we're talking about USDJPY and we talk about, okay, let's say that we had price at 106,300 and someone, let's say Hashir, right? Mr. Hashir had a buy order at 106,300 and price moved to 106,568. So when you subtract these two prices, you're going to get 268 points or 268 micropips, which is going to be 26.8 pips. Right, so we're always measuring price in terms of pips because when we calculate pips in lots, we're going to get our dollar outcome, which we're going to talk about here later on. Right, so first I want to really focus on how you're calculating pips, but the most important thing is how do you calculate pips on gold? Calculating pips on gold is completely different because gold is measured in dollars. So let's say you have a gold move and gold moves from 1715.50 to 1717.50, right? So when you subtract this, you get the number 2. So this is a $2 move. So you have to understand this, right? When you're looking at gold prices on your charts, you're always looking at the dollar values, right? You're looking at to see that, okay, right now gold is at $1,715.50. So if gold moves to $1,717.50, that's a change of $2. That means gold has moved by 20 pips. If gold moved from 1715 to let's say 1720, that's going to be a change of $5, which will also mean now gold has moved by 50 pips, right? So now let me just make sure that, okay, I guess some people are still having issues joining Zoom. Zoom is working perfectly fine. Can everyone see the screen here on Zoom? I just want to make sure. Yes, so screen is working fine. Awesome. I had issues, but now I can see it. Okay, perfect. Perfect, yeah. Let me just tell everyone to maybe update the Zoom. Okay, perfect. So let's move along. Now, what we're going to talk about is lots and leverage. So whenever you start when whenever you start to trade, you're told to like look at you're told to look at the lot sizes. You're told about leverage, and the most important question I get all the time is, "Hey man, what leverage should I use?" So leverage basically gives you the ability to determine how much you can risk at any given time, right? Most brokers offer leverage from 10 to 1 all the way up to 500 to 1. It's a personal preference on what leverage you use as long as you understand risk. What this means is if you have a higher leverage, what this basically means now you can risk a lot at any given time. But when you have a lower leverage, this means you cannot risk your account as much. So let's say, for example, you have 10 to 1 leverage, right? If you have 10 to 1 leverage, at any given time, you can risk up to 10% of your account, right? So let's say what's going to happen is if you have a lower leverage and if you open a bunch of trades, a point will come where the terminal is going to say, hey, listen, you can't open any more trades because you have low leverage, which means now you have reached the maximum risk you can open on, which may be like 10%. Like and at any time you can lose 10%, 15%. But if you have a higher leverage, let's say you have a 500 to 1 leverage, now at any given time you can risk a lot. So let's say if you have $1,000 account, at any given time on a 500 to 1 leverage, you can risk up to $600 on one trade. Now that is very, very risky. When you're starting off as a new trader, you're very prone to use that risk. But I would say that always look to see how you can use the least amount of risk. I personally use 200 to 1 leverage or like 400 to 1 leverage because I want to make sure that I don't use a lot of risk, because once you're trading and once you're like once the trade is going against you and you start to look at that, okay, maybe I want to add more risk. If you have higher leverage, you're going to be prone to add more risk. And this has happened to a lot of people. When price moves against you, you're like, oh man, okay, let's say if I'm in a buy and price is moving down, you're going to be prone to add more buys at that point, because you're going to justify those actions saying that, okay, now I'm getting a better price. But at the same time, what's happening is you're adding more risk because you have a higher leverage. If you have a lower leverage, you cannot add more buys, because system is going to say, hey, listen, you've reached your risk capacity. You can't add more buys at this time. If you add more buys, we're going to stop you out. So it's very important. um, when we talk about lot sizes, lot sizes determine your actual risk and the amount of dollars you can potentially gain or lose, right? This is very important. So when you're looking at your MetaTrader, let's say you're looking at your MetaTrader on the phone, or you're looking at your MetaTrader on your, let's say your computer, you're looking at the lot sizes, right? If you have, now yesterday someone asked me this important question, and they're like, hey man, I opened a point 0.5 lot and the price moved by 10 pips and I only made $50. But how come you opened a 5 lot and price moved by 10 pips and you made $500? So that's very important when you're talking about lot sizes. So the lot sizes, they start from, the minimum is going to be 0.01 lot, and they will go all the way up to 100 lots. So when you're starting from 0.01 lots and price moves by 15 pips, or let's say for sake of simplicity, we're going to say, let's say price moves by 10 pips, right? If you have a 0.01 lot and price moves by 10 pips, this means you're making $1. Makes sense? Or if price moves by 15 pips, you're making $1.5, right? If you have a 10-cent lot and price moves by 15 pips, you're making $15. Now, if you increase your lot sizes to 1 lots and price moves by 15 pips, now you're making $150. So see how changing the lot sizes, it can drastically increase your gain or your loss. So let's say if you have a $1,000 account, right? You have a $1,000 account, and you're using a 1 lot on a $1,000 account. Would it really make sense for you to use a 1 lot? Because if price moves by 10 pips and you lose $100 on a $1,000 account, you've lost 10%. That makes no sense at all. So if you have a $1,000 account, I would recommend using maybe like a 10-cent lot, so that even if price moves against you, let's say 15 pips, you're losing $15. That's not going to make a big difference on your $1,000 account. So that's why it's really, really, really important when you're looking at risk. You're also looking at that, okay, what lot sizes am I using? Now, someone can say, okay, well, you know what I'm going to do? I'm going to start using 10-cent lots, but as price starts to move against me, I'm going to keep adding lot sizes. So when you're adding lot sizes, you're realistically adding on more risk. So that's actually very risky. That's something I don't recommend people to do. So one thing, the most important thing to know is leverage, what leverage you're using. Leverage means how much you can risk at any given time. Second thing you're making sure is like what lot sizes you're using. Lot sizes will really determine how much you can make or lose. So like if you're a new trader and if you use a bigger lot size, let's say a 1 lot or a 2 lot on a smaller account, you might make that one win. But at the end of the day, what's going to happen is if you lose, man, you're going to lose big. So it's very important that you understand what lot sizes you're making. Now, sometimes, when you look at social media, what you're going to see is that, okay, people are using like 10 lots and 5 lots and 8 lots on their bigger accounts, and then you look at that and say, man, okay, I want those lots as well. Even though I have a $500 account or a $1,000 account and I want those big lot sizes, can I really do that? No, you can't, because it takes time. When I started back up again after my big downfall last year in February, I started back from like 50-cent lots and 1 lots, and I worked my way up. It took me a whole year to get to where I was before. So it was a gradual process. Just like when you start a new job, you want so like when you start a new job, you want a promotion, but your promotion is going to come after like a year, maybe 2 years, 3 years. Same thing in trading. When you're trading, when you increase your lot sizes, that's your promotion, and that promotion is going to take time. So you really need to know that, okay, this is a race, not with people, but this is a race with yourself that, okay, how much can you grind with 10-cent lots, or how much can you grind with $1 lots? So this is really important. So when you talk about, like, margins or percentage margins, me personally, I've never looked at margins. I've never focused on margins, because margins was a very advanced concept for me, and at that time, I didn't really understand what margins were. Now I really understand them after, like, I've been trading, and now I know, like, leverages and lot sizes. So margin requirements, they come at the very, very end. So we're gonna wait for that later on. Okay, so I want to do a mic check here again. If mic check okay, everyone can see the screen, things are working good. Okay, perfect. All right, let's continue on. I think this is the biggest turnout we've had ever, 318 people, which is really, really good. Okay, so now we're going to talk about risk management, right? First, we talked about lot sizes. We talked about currency pairs, market sessions. I really hope people are making notes. I really, really hope, even though this is recorded, but making notes is really, really important. So when you're talking about risk management 1.0, what you're basically talking about is, like, okay, number one thing is, how do you calculate lot sizes, right? Even though some people have access to magic keys, some people have, like, access to different scripts and websites and not, but, like, the main thing is, how do you actually calculate lot sizes? So this is what we used in the start to calculate lot sizes. So let's say you have risk, right? Dollar risk. Let's say someone has $1,000 account and they say, okay, I want to risk maybe $50. I want to risk $50. And when you calculate your stop loss, then you say, okay, my stop loss is going to be, let's say, 20 pips, right? So what you have to do is, you want to measure stop loss in points. So 20 pips is probably going to be 200 points. So 50 divided by 200, 5, 0 goes 0, 0, 4. So it's going to be around, I'd say, like 5 by 20. 5 by 20 is going to be what? 0 0.4? I think it's going to be 0 0.4. 5 by 20 is 0 0.4. My mental math is not that strong. So 5 by 20 is going to be, oh, 0.25. 0.25. Yeah, my bad. So it's going to be 0.25. So for you to risk $50 on a 20 pip stop loss, you'll be using a 0.25 lot, right? This formula is really, really, really important. Sometimes what happens is that guys have access to different websites where you can input your currency pair, and you can input your like, stop loss and risk and all that stuff. So that takes a lot of time. When you're looking to enter a trade within a minute or 2 minutes, that takes a lot of time. So this formula helps a lot. I have a calculator at my disposal, so I'm really, really easy. It's done. So if you write this formula down, it's going to help you out a lot in determining what your lot size is going to be. And then you can, like, you can move these variables around and calculate, like, what your dollar risk is going to be based on your lot size and stop loss and whatnot. Does this change based on leverage? No. No, the only thing that changes based on leverage is your risk that you can use at any given time. If you have a lower leverage, you cannot use high risk. If you have a higher leverage, then you can use a lot of risk. So there's a little difference right there. Um, so now risk is basically divided into two parts, right? No, number one part is your static risk. Number two part is your dynamic risk, right? The static risk, now, most people, what they do is they like to use static risk. When you're a new trader, I would recommend you to use static risk. What static risk means is that when you're approaching a trade, you're only approaching the trade from the fact that, okay, I'm only going to be using one position, and one position is just going to be one risk. Let's say if someone wants to use, let's say, 1% per trade, or someone wants to use 2% per trade. So what they're going to say is that, okay, I'm going to enter a position, but I'm only going to use 1%, or I'm only going to use 2% on one position, and that's my plan, and that's all what I'm going to do, right? Now, someone who's a little bit advanced or who has some more experience, what they might say is that, okay, hey, you know what I'm going to do? I'm going to use dynamic risk. Now, dynamic risk comes in when you're really, like, breaking down your risk. So what this means is, like, let's say if you're going to say, I'm going to use 2% risk, but I'm going to break down that 2% into two 1% positions. Really important. Let's say if someone says, let's say we have Mac here, right? Mac, or we have Brian here. And Brian says, hey, you know what I'm going to do, guys? I'm going to use 3% risk on this one trade. But what I'm going to do is I'm going to break down 3% into three 1% positions. Makes sense? Now you're breaking down your risk. That's what dynamic risk is. You're breaking down the risk based on the fact that, okay, I'm going to open one position. If it goes into profits, or if it goes like, if it retraces to get a better price, then I'm going to enter another one. And then I'm going to enter another one, bringing the total risk to 3%. But when you're using static risk, you're only using one position, and you're only using a static risk, like let's say just 1, 2%, or just 1, 3%, and so on. Formula should be applicable if you change currency to pound at risk. Yes. So basically, when we talk about pips and we talk about normal risk, we're we're just making sure that it's calculated based on the lot sizes. So just to make it very simple for everybody. Perfect. So let's move on to break time is, let's see if Ted is here. If he's not here, that's fine. We will move along. Um, so no, it's not. It's actually not going to be a break time right now. I'm just going to make sure. Just here. Okay, perfect. Let's continue on here. I'm just going to make sure everyone is working, everything's good, everything's good. Okay, perfect. All right, let's move along here. Now, um, we talked about currency pairs, we talked about risk, we talked about market sessions. Now we're going to talk about time frames, right? Time frames is going to be really, really, really important. So basically, first you have, well, the first we have the weekly time frame. So let me write the weekly here. You have the weekly time frame at the very, very top, and then you have the daily time frame, right? Now, when you're looking at the time frames, you're looking to see that, okay, I mean, when you're looking at the daily time, daily is the most important time frame that you're going to look at, right? Daily will tell you the bias, they will tell you like if the zones are strong enough or not. After that, you have your 4 hour time frames, which is weaker than the daily, but it's still strong enough. So when you're looking for trades, when you're looking to see that, okay, what time frame I'm going to choose, this is something really, really important. I focus on the 4 hour, and then I focus on the 1 hour and the 30 minute. Right, so when you start from this top, daily is the strongest. Then you have the 4 hour. 4 hour is still very, very strong, and then you have the 1 hour, and then you have the 30 minute. Now, when you go down the 30-minute time frame, when you go to the 15-minute and the 5, you might notice that there's going to be a lot of confusion between the candles, right? We're going to talk about candles later on here as well, but the idea is to really stick to a strong confirmation time frame. The 30-minute, 1 hour, and the 4 hour, they are very strong confirmation time frame. So when you look at the 30-minute, you're going to see that, okay, you might find trades, but the trades are not going to be in abundance, just like, let's say, you might find on the 15-minute or the 5-minute. Now, when someone tries to trade the 15-minute and the 5-minute time frames, you might find a lot of trades in those smaller time frames. Someone can say, oh yeah, I only trade the 5-minute time frame, or I only trade the 15-minute time frame. That's all good, but the thing is, you will find a lot of trades, but the confirmations are not going to be strong enough. That's why I focus on the 30-minute. On the 30-minute, I will find trades. The confirmations are going to be stronger, but if I look at the 1 hour, the 1 hour time frames are going to have much stronger confirmations, but the number of trades on the 1 hour are going to be less. But there will be very good confirmation trades. It's like, let's say, when you order something from China in bulk, you're going to get the best price. The price is going to be extremely low, but the quality may not be there. At the same time, when you buy something expensive, it's expensive, and you cannot get in bulk, but the quality is going to be there. It's going to last way, way longer. So please, when you're looking at time frames, focus on the 30-minute or focus on the 15-minute time frames. I'd say 15-minute is still risky. 30-minute is much better than the 15-minute because you want to filter out the number of opportunities versus the number of trades, right? Because on the smaller time frames, you're going to get a lot of opportunities to trade, but on the higher time frames, you will get really good opportunities to trade, but the number of trades are going to be less. Someone said that I got effed so many times this week because of 15-minute confirmations. Yes, a lot of times there's going to be a lot of fake outs in 15-minute time frames, in 5-minute as well. There's going to be a lot of fake outs, and matter of fact, like we are not advanced enough, or we are not quick enough to consecutively win on smaller time frames. That's just fact, so you have to stick to 30-minute or the 1 hour and just wait, because on the 30-minute and the 1 hour you will get less trades, but the confirmation is going to be very, very, very strong. um, let's see what we have next here. Let's move on to the next slide. Let's see if, okay, everything's good. Systems are all running. Now, we're going to talk about candlesticks, right? Now, when we talk about candlesticks, it's basically the first thing that comes to our mind is that, okay, we have a bullish candle, and then we have the bullish candle opens from the bottom and it closes at the top. Someone who's very, very new, this is something very new and I think these basics are really important. So now when you have a bullish candle, it will have two wicks. So when we talk about liquidity wicks and ranges, so this is a liquidity wick. In a bullish candle, a liquidity wick is at the bottom, which means that the bullish candle tried to go down. Let's say it tried to go down, it formed a liquidity wick, which means it grabbed some liquidity, or it grabbed some fuel to continue moving up, and then it created a range at the bottom. So whenever a bullish candle is creating a range at the bottom, a range at the top, this means that, okay, now there's a very high chance for the next candle to continue moving bullish, which is why we break down the candles into liquidity wicks and ranges. Next, we have your bearish candle, right? Now, the bearish candle opens at the top and it closes at the bottom. And when we talk about the liquidity wicks and the ranges on bearish candles, we have the range at the bottom because, price is obviously moving down. And then we have the liquidity wick, which is at the top. So whenever you talk about liquidity wicks, these are what liquidity wicks are. Liquidity wicks are basically movements of candles in the opposite direction. That's what liquidity wicks are. I have a little story to tell. My good friend, he started trading in the 1990s. This is a very long time ago. So what they used to do was they used to get prices. They used to get prices every 15 minutes. So now check this out, right? Just like visualize this. So you're there sitting at the screen, you're getting prices every 15 minutes. So let's say that he would get a price, let's say once he get a price, and the price would be at, let me just remove this. And the price he would get would be at 100, right? He would get price at 100, and he would write this down. Okay, I got a price at 100, and they would have this math paper, that those papers like with boxes on them. So that's what they would have, like grid papers. So he would get a price at 100, and in that 15 minutes or in that 1 hour time frame, he would get a closing price. So he would get an open price at 100, a closing price he would get at 150. Now you have two prices. Now in those two prices, what he would also get is the lowest price. So the lowest price he would get would be 80, and the highest price he would get would be, let's say, 200. So when this would used to happen, they would draw a candle. Does this make sense? Right? So they would wait an hour. They would get an open price. Okay, we got an open price at 100, a closing at 150, a low at 80, and a high at 200. So they would wait. They would wait a couple of hours or a couple of days to draw candles. They were drawing candles this way, and they were really waiting. They were looking at patterns, and they were really waiting to see that, okay, what are the candles saying based on the fact that, okay, where can the next price go, or where can the next candle form? This was the basics how candles were formed, because you would just sit and you just wait for the prices to come in. You would draw candles, you would wait a whole day, and then you would have history. right? Then you would have history on the charts. And once you had that history on the charts, then you could say, okay, based on the 2 days of me drawing candles, now I can finally take a trade, right? But now when we have our platforms, we have C Trader, we have our MetaTrader, it's really easy. It's really easy to take a trade. It's really easy to execute a trade. And I think these systems are meant for us to fail, because when you have your systems on, now you can execute trades within, man, like within a few seconds. Within a few seconds, you can put money at risk. And it's really easy. It's really harmful too, because back in the day, when someone said, "Okay, hey, you have to sit down and draw candles for a day," man, no, not many people will be willing to do that. They'll say, "Oh no, it's a waste of time, whatever, this and that." But now it's really easy, so you have to be very careful. Now you have all these weapons at your hand that you can put money at risk. You have leverage. You can open lot sizes. Man, you can flip accounts from $1,000 to 2,000 and 5,000. You can flip those accounts, but it comes with a lot of responsibility. And that responsibility is that how are you going to manage yourself? You know, are you going to fall into that greed? Are you going to fall into that fear of, like, let's say, losing and making money? So that's going to be something really important. We have Nathan that is unmuted. Nathan, can you mute yourself? As I'm going to really appreciate that. And also Brian Miller there as well. Okay, perfect. So let me just remove this from here and let's continue on to candlesticks continued, right? So um, basically what we talked about were basic candles, right? So now what we're going to talk about is candles without wicks and candles with wicks, right? So candles without wicks basically means that there's no range for the next candle to fill, right? When you have candles that have wicks, that means that the next candle can potentially go in that same direction. But when you have candle with no wicks, then there's no range. So usually when there are no wicks on the candles, there's a 50-50 chance that price will move where you want it to move. For example, let's say you have a bullish candle and this candle has no wick on the top. So if this candle has no wick on the top, this means there's no range for the next candle to move up. And then there's a 50-50 chance that the next candle may move up or it may move down. You can look back on the charts and you can backtest this. There's going to be very less probability that the next candle is going to move up. If we look at a candle that has a wick on the top, then there's a very high probability that the next candle is going to continue moving in that same direction, right? Now, at the same time, let's say you have price moving bearish, right? You have price moving bearish and the candle has no wick at the bottom. So when a candle has no wick at the bottom, this means that there's no range for the next candle to go down. Now there's a 50-50 chance that the next candle can essentially go down or it may start going up, right? So whenever I encounter a candle with no wick at the bottom, I look at that and say, man, okay, there was volume there. The candle was a solid bearish candle, but the candle had no wick at the bottom. So to me, I'm going to say, well, if there's no wick at the bottom, then there's no range, which means the next candle, it may not continue down. It may start going the opposite way. But sometimes the candles do start heading where you want to go. So that's a 50-50 chance. So when you're trying to trade, you're looking at the candles when you have wicks. Let's go back here. When you're looking at the candles, you're looking for these wick ranges. When price is moving up, you're looking at the wick at the top. When price is moving down, you're looking at the wick at the bottom. Because when you have wicks, this means there's a very high probability that price will continue moving in that direction. Um, Now, in the same way, let's say we talk about a bullish candle that has no wick at the bottom, right? And it has a wick range at the top. What this means is there's a lot of volume in the candle. When a candle has a lot of volume, now when when is the time of the day when there's going to be a lot of volume in the candles? When you have your market opens, when you have news events, when you have, let's say, special speeches, those are the times when there's going to be a lot of volume in the candle. So when you have a bullish candle with no wick at the bottom, this means the price didn't even attempt to go down. There was so much bullish pressure. There were so many buyers that price didn't even attempt to go down. It just continued to go up. In the same way, if you have a bearish candle with no wick on the top, this means that price didn't even attempt to go bullish. Price was moving down with so much ferocity that it didn't even have time to continue going up. It didn't even create a liquidity wick. That's what these candles mean. So it's very important to look at candles when they have no wicks, because when you're looking at a candle that is bullish, once again, with no wick on the top, this means there's no range, which means that price went up and it just closed at the spot and it didn't even go up. So now there's a 50 chance that might go up or down. And the same way, if you're looking at, let's say, a bullish candle with no wick at the bottom, this means there was a lot of bullish pressure. You need to be very cognizant of this fact, like, when you're looking at the charts, when you're zooming in, if you're looking at the candles, it's very important that you look at this stuff. Because, like a lot of times when we're looking at something like this here, can you guys see my mouse? Like I've been moving my mouse. Okay, perfect. Yeah, you can see my mouse. So let's say if you're looking at this candle here on the charts and you're like, okay, man, this is bearish. It has no wick at the bottom, so price is going to move down. But then there's a 50-50 chance it might move down. So this is something what I've learned by looking at the charts, by losing based on these candles, because I would look at this and say, oh, hey, there's a lot of momentum here, but there's no range. When there's no range, when price is closing like this is like price is creating a support. So it's very important to make sure that that's understood. Okay, so let me just check this one thing here. Everything's go. System is looking good. Perfect. Um, awesome. So now we talked about candlesticks. We talked about market sessions. We talked about times to trade, and we talked about risk, right? Now we're going to talk about how does the market move. So the market moves basically in three ways. First you have the uptrend, you have consolidation, and then you have the downtrend, right? These are the three ways market moves. I don't look at Fibonacci's, I don't look at harmonics, I don't look at any indicators. I used to look at moving averages, but I strictly deviated from moving averages as well. And now I just look at if the market is trending, if the market is consolidating, or if the market is heading down. Those are the only things I look at. So let's say first off you have an uptrend. You have an uptrend. In uptrend, what's going to happen is price will always make highs. This is really important. Whenever price is trending up, it's always creating highs. Its price went up, price made a high. Whenever price makes a high, there's an 80% chance that that high is going to get retested. And in uptrends, candles will always make higher highs and higher lows. So sometimes, like when you watch some videos or when you open some books, you see that, okay, guys draw like, okay, so this is an uptrend here, price making higher highs and higher lows. So you have a high over here, price made a low, then price made a higher high, price made a higher low, and price made a higher high, yada yada yada. But when you're zooming into the charts and when you're zooming into the candles, you're looking to see that, okay, if price is coming down to support, now notice this, right? Let's take a look at this candle right over here. Let me just remove these arrows and let's look at this candle right here, right? Candle, now see, this candle had no wick at the bottom, so this means there's no range for the next candle to go down, but we don't know because it's a 50-50 chance. It's very difficult. The next candle formed bearish. It had no wick at the bottom after price created a high. So then you have a candle closing bullish. If a trend is bullish, candles will make higher highs and higher lows. This is really, really important. For price to continue moving bullish, this candle has to respect the previous candle's low, and that's the only way prices continue moving bullish, right? That's a very basic definition of an uptrend, that candles will always make higher highs and higher lows. Next, we're going to talk about consolidation. Consolidation is when price is just moving sideways. Whenever you have candles that are printing side by side, that's consolidation. Whenever you have consolidation, it's really hard to say where price is going to move unless you're looking at the higher time frames, which we're going to look at later on. But the most important thing is that for you to identify consolidation, right? When you have candles like, let's say, consolidating like this, basically you're saying that, okay, so we're forming resistance here, but we're also forming support in here. So for you to wait for price to move, you'll have to wait for a candle to break out of this area and maybe close a bullish candle, something like this. Because if you have a bullish candle closing like this, now you can look back and say that, okay, we had one candle that broke above this resistance, and now it made a higher low and a higher high. So now there's a very high chance that the next candle is going to continue making higher highs and higher lows and continue moving up. And that candle is going to be your trading candle, right? That's where you will say, okay, I might want to buy over here and leave a stop down over here and continue moving up. Now we're going to talk about this later on here as well. Now, in the opposite spectrum, when price is ranging, and someone can say, oh well, um, if price is ranging, let me get a better color over here. Let me get blue. So someone can say, okay, let's say if price is at resistance here, and I'm going to try to trade a range, and I'm going to be a cowboy, and I'll try to trade a range, and I'm going to take a sell from up over here to go down to support. Now, that's a very valid idea, but the problem here becomes now you're trading in the range. Now, here's the thing. When you're trading in the range, the probability of success is low, right? When you're waiting for price to go in an uptrend, or if you're waiting for price to go in a downtrend, the probability of the win is going to be much, much higher. So you have to put yourself in the very best position to win. So when price is up over here and you try to take a sell, now you're taking a sell in consolidation. This does not make any sense. Of course, you might win at times, but I've seen majority of the times people lose when they trade in ranges. And that's a very bad place to be, because when you're trying to trade in a range, even though if you're a good trader, now you're taking on a loss. You're taking on a potential risk that may turn into a loss. And when that trade turns into a loss, that affects your psychology, that affects your ego, that affects your confidence, and overall, you're just like, man, this is just so hard. So the best thing to do is to wait for price to come to support and actually break below the support. Because once you have a break, now you know that, okay, price has now broken support and created a low, right? Whenever there's a low formed, there's a very high chance price will retrace, create resistance, and then continue moving down to retest the low and eventually making a new low, right? That's very important. So never ever trade in a range. That's very risky. I normally don't trade in ranges at all. If price is ranging, I wait for a breakout, or if I wait, like let's say if price is going to be at this resistance, and if you have a break above this resistance, now you can say, okay, now price is making a high. So whenever price makes a high, just like right over here, there's going to be some sort of a retracement, will form a support, and then candles will start making higher highs and higher lows. So whenever you're looking at the charts, I don't want you guys to look at the charts from a very zoomed out perspective. I want you guys to look at the charts zoomed in like this, where you can see the candles. Because if you can't see the candles, you can't trade. Because what's this? If the consolidation is on a higher time frame, trade on a lower time frame. Yes, so we're going to talk about that later on too. Um, Okay, so let's move on to the downtrend. Now, downtrend is basically when price is creating lows. Whenever price is making lows, this means that there's going to be some sort of a retracement, and then there's going to be some sort of a resistance formed. So now how these resistances are formed, we're going to talk about this later on here in the presentation, but mostly I want to focus on the downtrend. The downtrends is when price continues making lower lows and lower highs, and that's a basic trend that you see on the chart. So if we were to map this out, we could say, okay, price made down, made a low, made a lower high, and now it made a even lower low. But when you break it down into candles, you're looking at specific candles. You're looking at the fact that, okay, we had this candle here. The next candle made a lower low and a lower high. The next candle made another lower low and a lower high. So now we've made a new low. So once price makes a new low, there's always going to be a retracement. There's always going to be a pullback. So when there's a pullback, you're waiting for the pullback. When the pullback happens, you're waiting for another bearish candle, which will be right here. And when you see a bearish candle here, now you can say that, okay, since we're in a downtrend, and since this is a, let's say, a 1 hour time frame, and we have a bearish candle forming, now there's a very high chance that the next candle is going to be bearish as well. So now you can say, okay, the next candle was bearish. It made a lower low and lower high. The next candle was kind of like a weak bullish candle, but it also made a lower lower and lower high. And then eventually we had a candle moving down, right? So there's a big difference when candles are trending bullish and when candles are ranging and when candles are trending bearish. In ranges, candles will move sideways, where you see candles print side by side by side by side. When candles are moving bullish, you will see candles will make higher highs and higher lows. And when candles are moving bearish, you will see that they will make lower lows and lower highs. So we talked about market sessions, different market sessions, how pairs are correlated. We talked about what times to trade, and now we're talking about what different ways does the market move. This is the first thing I really, really start to focus on. I start to focus on that, okay, if I'm going to come to the charts, right, I want to see something making a high. Or I want to see something making a low. There have been a lot of times, when I come to the charts in the morning time and I see that the GPJPY in New York is just falling down, is extremely bearish, is falling down. And I look at that as a good thing. Because if I see something is falling down, I know the trend is down. So now I'm not going to try to sell when something is falling down. I'm going to wait for price to create like a minor resistance, and then I'm going to try to sell to retest the low. This is really important. When you come to the charts and you see that price is just like forming side by side candles, this means that price is just ranging. Ranging does not help you. This is a bad way to trade. This is a big no-no. Someone asked a question, even though I said that all the questions are going to be answered, the question is, oh, I guess I lost the question there. So anyway, so we're going to answer all the question in the very, very end. Save all your questions. All the questions are going to be answered as we move along. If there's something left, you can ask them in the very, very end, right? Because these presentations are made based on the fact that everyone is very, very new. Okay, let's move to the next topic of interest is going to be support resistance. I have the amount of trades I have won perfecting support and resistance is incredible. It blows my mind. Every day we come on the live streams, I plot support resistance, I look at the candles, and I tend to see that, okay, if this is going to get respected, how can I have a profitable trade? How can I have a profitable morning by just trading support resistance? This is a very simple concept, but it is overlooked a lot. And this has been my bread and butter for the past 2-3 years. So we're going to divide this into two columns here, support and resistance, right? A support is an area on the chart from where the candles are most likely to reject, which also means there's a higher chance for them to finish bullish. Right now, if you remember, we talked about time frames, right? We talked about how the 15-minute and the 5-minute is a weak time frame. So when you're drawing a support on the 15-minute time frame, there's a low probability that that support is going to get respected. Because that's a excuse me. So that's a because that's a very weak time frame. So when you're looking at supports, you're looking at a higher time frame, like the 30-minute time frame, the 1 hour time frame, because those time frames are much more prone to get respected, right? So support is formed at the low of the particular time frame. For candles to move bullish, they have to create higher highs and higher lows. This is very important. So now when we go back to the time frames example, if you look at the 15-minute time frame, sometimes you'll see that even though the 15-minute is moving up, sometimes candles, they don't make higher highs and higher lows. They will break the lows of the previous candles. They will do those funny things. So it's always important to look at the 30-minute time frames where candles are making higher highs and higher lows. In the same way, when we're looking at this example right over here, we have a support, right? So let's say we have a support down over here, and let's say this is the 1 hour time frame. We're looking at the 1 hour time frame, and we see that the 1 hour candle at the bottom, right over here, has closed bullish, right? So if this is a 30-minute time frame or if this is a 1 hour time frame, there's a very high chance that the next candle is going to continue moving bullish, right? Just like the candle did right over here. So the next candle moves bullish. It makes a higher high, which is right over here, and it makes a higher low right over here, right? So if we continue on moving, for price to continue moving up to the next resistance, which is going to be right over here, because whenever candles are moving, the candles are always looking left. The candles are looking left to see that, okay, what did my buddies do previously, right? So whenever candles are moving, they're always looking left to see, okay, maybe I'd want to move up till this point right over here. So for price to continue on bullish, it has to make higher highs and higher lows. So if you see here, the candles will make higher highs and higher lows, and so on and so forth, right? So whenever price is at a support, you're looking at a higher time frame, like the 30-minute time frame, 1 hour time frame, and if you see that the candles are closing bullish on the 30-minute or the 1 hour, there's a very high chance price is going to continue moving up. So when you're taking a trade, what sometimes happen is that guys are going to say that guys and gals, because we have some gals here too, guys and gals are going to say is that, okay, well, since this candle closed bullish, I'm going to wait for a confirmation, right? Someone who likes to take on risk, they might say, well, this one bullish candle is enough for me to take a trade. So they might take a trade, and this candle will be their trading candle, and the next one is going to go up, and they'll be like, okay, perfect. Now, someone can say that, okay, I'm going to wait for this confirmation to close. Right now, you're waiting for the next confirmation to close. What might happen is that you might miss some pips here, right? You might miss some pips over here. So when you're waiting for this to close, now you might want to enter on this candle. Now, when you're looking at candles, your trades are not big moves. You have to understand this. A lot of people, they're coming in from a swing trading perspective. Some have had like great success. Some have had maybe not so much success at all. So when you're looking at moves to catch, you're looking at, okay, what candle can I catch? Right? Your trades are your 30-minute candles, your 1 hour candles, your 4 hour candles. Like, just imagine a day, right? You wake up, you come to the charts, and you're like, okay, my aim is to catch one 1 hour candle, and that's going to be my trade of the day, right? If you can wake up every morning and come with the mindset that, okay, I'm going to try to catch one 1 hour candle and that's all what I'm going to do, man, you're going to have a lot of success. There's going to be no anxiety, there's going to be no pressure, no stress at all. But if you're going to come to a chart with the mindset of, okay, I have to catch a huge move to make my losses back, man, trust me, it's not going to end well at all, because now you're going to be trading under pressure, right? So whenever you're looking at the charts, you're looking to see that, okay, where is the support being formed? Right? And if you have a support being formed, what time frame is that support on? Is that on a 30-minute time frame, 1 hour time frame, 4 hour, much better, daily, excellent. Weekly, perfect. Monthly, I don't even know someone who trades on monthly here. But you get the point, right? Um, let's move on to our wonderful resistance here. Now, some people like selling, some people like buying. I like buying more, so when I first started, I would be more prone to buying than selling, because I would like price going up. I wouldn't like price going down. So I really had to change that mindset. Some people have these issues. Some like selling, some like it easier that price goes down, and some like it easier that price goes up. But as you move along, as you get more consistent, as you start looking at price from a perspective that, okay, I'm only going to trade in this one session, you start to notice that price basically moves the same way moving up or moving down. That's a very like a hard psychological thing to get over, but eventually you will. So now we're talking about resistances, right? A resistance is an area on the chart from where candles are most likely to reject, which also means there's a higher chance for them to finish bearish. right? In the same way, when we're talking about time frames, resistance is found at the highs of the particular time frame. For candles to move bearish, they have to create lower lows and lower highs. Now, throughout the presentation, we're going to talk about lower lows, lower highs. We're going to talk about higher lows and higher highs. We're going to talk about price making a high and retesting the high, or price making a low and retesting the low. I'm going to talk about this over and over again, because when you're looking at, let's say, different patterns, you look at different patterns, you're like, okay, head and shoulders. How are the head and shoulders formed? They're formed when candles are moving, and those patterns, they're formed when candles respect supports, when candles break resistances, when candles go through zones. That's how those things are formed, and when you can really understand what stories the candles are telling you, man, you can ride those candles, which means you can trade those candles. So the candles were built for us to trade on, right? First, let's say that this is a 1 hour time frame. So when we're looking at this chart, this piece of chart right here, the first thing that we notice is that, okay, we might be creating a support down here, right? And there was a resistance to the left, so price may be acting in this area. So when price is acting in this area, there's no sell, and also there's no buy at this point, because we don't know where price is going to go, because it's true we're at resistance, but we don't have a bearish candle forming at resistance. We have a candle that's closing doji, so we wait a little bit, right? We wait, and once we see a bullish candle forming at resistance, it's still not a sell. Now, the main problem that people have, that when price starts to move bullish towards the resistance, they start anticipating a sell. It's true that the sells are going to happen, but there's no confirmation yet. The candle has not flipped in your direction, so you really have to wait for candle to flip in your direction. I can see some people are closing their eyes. They're kind of like dozing in and out. Just go wash your face, and it's going to be all okay. All right, so now when you have a candle closing bearish at resistance, this is where you can see that, okay, now I have some sort of confirmation. Now the candles have flipped at resistance bearish, so now I can possibly maybe take a trade. Maybe I can say that, okay, if I take a trade here, and if I keep my stop loss above the candle, now I want candles to make lower lows and lower highs, and then you will have lower lows and lower highs, and price will continue on down, right? So whenever you have candles at resistances, there's going to be a very high chance, if you're looking at the 30-minute, 1 hour, or the 4 hour, that you will have a bearish candle printing at resistance, right? And that's going to be a very high probability that the preceding candles are going to start making lower lows and lower highs. Even in the same way, if you have candles closing down at support here, there's a very high chance candles will start making higher highs and higher lows, right? So that's something that you have to be very cognizant about. Like, those things are very, very important. Let's continue on towards, let's see. So next we're going to talk about risk management 2.0. We're going to talk about risk management 2.0. Before we talk about risk management 2.0, I think Ted is trying to enter, but he's having some issues, just like some people as well. So we're going to talk about risk management 2.0, and then Ted is our guest here, and he's going to talk about some sort of psychology. So we're going to go about that. So first we talked about risk management 1.0. 1.0 was like basically calculating your risk. Risk management 2.0 is actually a little advanced, right? So what we're going to do is, how do you define a stop loss? So in these slides we talked about, okay, like you have candles closing at support. When candles are moving bullish, you're taking a buys, you're making sure the candles are making higher highs and higher lows. When you're taking sells, you're making sure candles are making lower highs and lower lows. But what about your stop losses? That's what we're going to talk about now. What about your stops? Where are you placing your stop losses? So a stop loss, it's a level on the chart which, once broken, it nullifies the trade. Identifying that before executing a trade is the first step. This means that whenever you're trying to take a trade, you're making sure that you know where your stop loss is going to be. You're already identifying your stop loss first. The first step before you take a trade is to identify where you're going to place your stop loss. Um, for example, when candles are trending bullish, they make higher highs and they make higher lows. Best practice is to place stops below the lows of the candles, usually the 30-minute or the 1 hour, which we talked about. When executing a buy, candles have to respect the lows of the previous candles. This is very important. Whenever you're taking buys, you're always putting stops below the previous candles. You're always making sure the candles are respecting the lows of the previous candles, right? In the same way, oops, let's say we have a support down at the bottom. You have a support and you have a candle that's closing bullish at support. Okay, and then you have the next candle that's closing bullish at support. So let's say you had the first one. Now, when this is a 1 hour time frame, and if this is something that you could see that, okay, maybe this 1 hour time frame now basically means now there's a high probability for the next candles to move bullish, you might want to place your stop below this bullish candle, right? Because when you place a stop below the bullish candle, you're making sure that, okay, the next candle has to make a higher high and a higher low. So the next candle moves bullish, right? Now you're protecting your stop loss down there. Now you're expecting the candle after that to continue on making higher highs and higher lows. So when candles are making higher highs and higher lows, this is where you can say that, okay, maybe I want to move my stop down over here, right? Or now I want to I'm going to trail my stop down over here because now I expect the next candles to continue on making higher highs and higher lows, right? So now when we move on, next one, now once the lows are broken, that's where you say that, okay, maybe now I made a good decision. Because once you're trailing your stops below the lows of the candles, you're expecting candles to make higher highs and higher lows. But once the previous low is broken, now you're out of the trade. Now this basically means that, okay, maybe now price is going to start reversing. So risk management in this sense is really, really, really important. Whenever you go in profits, you're moving your stops below the lows of the candles if you're taking buys. Sometimes, what guys do is they say, okay, well, if let's say price is going to come down and break the low of the previous candle, what I want to do is I might want to close off percentage position, which we're going to talk about later on in the slides. So what we have here, when the candle is breaking the low, someone asked, when the low is broken, is it means the body or the wick? It means the wick, because this is the candle, this is the high of the candle, and this is the low of the candle, right? So it basically means the wick. Um, in the same aspect, when candles are trending bearish, they will make lower lows and lower highs. What's this? I'm in, but my screen is black. Zoom is messed. I can hear you, just can't see. Okay. Maybe try updating the Zoom. Maybe. Okay, that was basically Ted. Okay. So whenever the candles are moving bearish, they'll make lower highs and lower lows, right? So this basically means is best practice is to place stops above the highs of the candles. Above the highs of the candles, usually 30-minute or the 1 hour. When executing a sell, candles have to respect the highs of the previous candles. So when we look at an example here, let's say you have a resistance up over here, and you have a candle that's moving bullish at resistance. So this is when we don't want to take a sell because candles are bullish right now. So what we want to do is we want to wait for a bearish candle to form. Once you have a bearish candle forming, now you can say that, okay, now there's a higher chance if this is a 1 hour chart, or let's say if this is a 30-minute chart, at this point you can say that, okay, maybe now there's a higher chance for the next candle to continue making lower highs and lower lows and continue moving bearish. So at this point, you might want to say that, okay, maybe I want to put my stop loss above the previous candle, expecting the next candle to continue moving bearish, right? So let's say the next candle now starts moving bearish. So what someone might do is someone might say, okay, maybe now I'm in profits. I might want to secure profits and move my stop below the high, no, above the high of the previous candle, and as price starts moving, now you want to further trail your stop above the high of the previous candle. Oh, we had an audio problem. Okay, perfect. So now, since you're trailing your stops, now when candles are moving bearish, you're seeing candles are making lower highs and lower lows, right? Now, for this, for the downtrend to be neglected, you want candles to break the highs of the previous candle. So let's say, for example, if the next candle continues moving bearish, and now even though you're trailing your stop down to the highs of the previous ones. And once you have a candle that breaks the high of the previous candle, now you're like, okay, maybe there's going to be a change in trend. If you're looking at the 1 hour time frames, or if you're looking at the 30-minute time frame, then if you're seeing candles are making lower highs and lower lows, but if that one candle breaks the high of the previous candle, that might be a cause of concern that, okay, now you might say that, okay, maybe it might stop me out. Maybe because if this is a 30-minute time frame, we might see that the next candle may start moving bullish, right? So it's very important. So the basic concept here for risk management 2.0 is like looking to see how candles are making lower highs and lower lows, or how candles are making higher highs and higher lows in uptrends, so that you're trailing your stops below the candles. It's very important. Some people, what they do is you'll take a buy, let's say you'll take a buy down over here at this wick, and you're going to keep your stop down over here. Now price moves into profits, and you haven't moved your stop. When you don't move your stop loss, what might happen is that the next candle might come down and you haven't moved your stop. It might continue down and stop you out in a loss. So this is why risk is really important. You're continuously moving your stop below the lows of the candles in uptrends, and you're continuously moving your stop um, above the highs in downtrends. Because if you get that one candle that starts moving bullish, you want to be stopped out in profits, which is why your stop is always going to be at this point right over here. I hope my pace is okay. My pace is not too fast, not too slow. It's pretty good. Audio is clear. Okay, perfect. All right, I want to see if Ted is here. If Ted can raise his hand. We will. Do you recommend beginners to dabble in that trade management? Yes. Ooh, I don't think Ted. Oh, Ted's here. Um, if Ted can raise his hand, we can bring him on as a guest speaker. Um, yeah, I think it's getting some things right. Use the 30-minute candle, 15-minute controls. Um, we're going to use the 30 minutes, 30 minute only, not the 15 minutes. So yeah, I guess we're just gonna wait here to Ted to come in. I think he's having issues with the Zoom. Nope, still waiting, still waiting. Uh, Someone asked, doesn't the 30-minute and 1 hour tend to have a big stop loss? It depends. Everything depends. What we're doing here are general examples. The charts are going to be very, very different. So all the questions you have to wait for the questions. Everything will be answered later on. I'm just trying to make sure if Ted is available here, but I guess. Oh, oh, he can't. Oh, Zoom won't let you. Oh, why not? Um, let's see here. What can we do? What can we do here? Let's make him. Oh, someone said join as mobile. No, he has some slides. And someone said to restart the computer. Okay, let's just restart. Search my name. Yeah, yeah, we see you. We see Ted. We see Ted here. Okay, let's do this. Hello? Oh, perfect. Perfect. Yeah. Yeah. Oh, yeah. Yeah. I had to make you host. I had to make you host to get this. Yes. Oh. Um. No. Oh. Some people can see them. Yeah. Some people can and some people can't. Yeah. 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 Let's do that. Man, tech issues. I think we broke Zoom today. Okay. Okay. So if we do this, and then can you stop sharing your screen? Okay. All right. All right. Just make me host again. Okay. Hopefully this doesn't end the meeting. It's a 50-50 chance. It's a candle with no wick. Wow. Yeah, it's yeah, it's not working. Let me just do this. Share. Um, yeah, it's basically not working at all. Try restarting again. Yeah, it's not letting me. Okay, so let's take a break here for 10 minutes and we'll be back at it's 9:53 right now. We'll be back in 10 a.m. and I think by that time we're gonna have this issue resolved. Yeah, by that time we're gonna have this issue resolved. It's still recording, so what we will do is
essentially being self-aware. I think that's the biggest flaw in trading is if people aren't self-aware, then you start making critical mistakes and you don't know why you're making those mistakes. So really, psychology and trading, we're going to talk about, obviously what is psychology, understanding yourself, and understanding yourself with trading. So just bringing it into the specifics of that. So if you want to jump on to the next slide there. So psychology, I mean, this is directly from Wikipedia. It wasn't something that I wrote. Is the science of behavior of mind. Psychology includes the study of the conscious and subconscious phenomena, as well as feeling and thought. So really, this is going to dive into why we do things, how we do things, and what's the purpose behind what we do. A lot of people are intimidated by this because it's really diving into who you are as a person. But I think the more honest you are with yourself as who you are as a person, the easier it is to detect where you're going to have trouble spots and where you're going to find that you can get help. But also at the same time, too, you're going to be able to find where you are strong. Everyone's psychological makeup is different. So I think it's really important that you do understand certain things and you do start to realize why you're doing certain things. And I think once you start doing that, you then can excel in almost anything that you do because you're going to be more self-aware of who you are. So let's go into the next slide and talk about just factors that affect your conscious. You have family, your friends, outside environment, past experiences, education. So each one of those ideas, I think a lot of people overlook. When we talk about psychology and trading, and when we talk about why we do certain things, there are a lot of outside factors that come into play as a trader that maybe you aren't aware of. And this is something now that as a trader, when you start to look at your environment, whether it's external or internal, so external being factors that are affecting you, directly, internal are things that you manifest, you will start to see that there are things that are around you that maybe you just weren't aware of. So say, for example, with your family, and we talk about this, you're learning how to trade right now because you want to support your family. Well, indirectly, you're putting pressure on yourself to succeed because you want to support your family, you want to give them a future, you want to retire your parents, the different elements of that. On the opposite end, now you have family telling you not to trade because people aren't successful at trade. It's too difficult. No one can do this. It doesn't make sense. Why are you doing this? Go be a doctor. Go be a lawyer. So now you have a push and pull from the family element that is creating pressure on you. Because if you have people that are talking to you and telling you that you can't do this, suddenly now that becomes a reality. And maybe that they are right. Because what we see is we see family that haven't traded before. You are forging that new path, and that path is unknown. So when it's unknown, it's scary, and your family in general don't want you to have difficult times. They don't want you to be scared of things. So what they're going to do is they're going to tell you all the reasons why you shouldn't be. Same thing with friends. Friends that don't trade don't want to see you lose money. They don't want to see you put yourself in this position. They rather have you get a job, do something safer, keep doing what you're doing right now because it's steady income. They don't want you taking those risks. When you look at your outside environment, it can be easily in the fact of, hey, I don't have the finances to trade, so now I'm putting pressure on myself. I don't have the time to trade as effectively as I want to. So I have to realize that it might take me a little bit longer to grasp some concepts, to build some experience, build some education, because I just don't have the time. You look at what people have done in the past, their past experiences. I failed at a lot of other things. So what makes me think that I'm going to succeed in this idea? What makes you think I'm going to be a good trader when I haven't finished school, when I haven't done any finance classes? There's these pressures that you put on yourself from all these exterior influences that can really cripple you even before you actually start trading. So you've already taken that approach and you said to yourself, hey, listen, I have all these pressures that I've put on myself. So now when we look at that and we continue on, if you go on to the next slide, you now have to be be a little bit of, you have to be self-aware. And the main reason why people trade, obviously is for financial freedom, for money. They want to better themselves. But where are you getting the ideas to trade from? Where are you looking as, trading to be something that what you think it is, right? And this is once again where we come into self-awareness. They talk about the seven deadly sins. You have lust, gluttony, greed, envy, and not certain comparisons, but that's something I added to this list here. These are part of the seven deadly sins, and this affects who you are as a person. How many times do you go up and you look at somebody at what they have, right? You lust for what they have, and you start to project to be greedy, to be envious. It's a perfect um, idea. You should not beat yourself over the head if you're greedy. What you have to do if you experience these feelings is you have to figure out where the triggers are coming from. So if you're lusting after something, why are you lusting after that object? Why are you lusting after that person? These are the questions you have to start asking yourself, and this is part of self-awareness. So now, when you look at these particular items, you know deep down inside that you are affected, right? So let's look at greed as an example. Why are you over trading? Because you need money. So now the question becomes, why do you need money? Well, my parents are poor, my family is poor, I need to support my family, I need to do certain things because I need to make sure that we have the finances to pay for food, to pay for rent, to pay for a mortgage, whatever that's going to be the case. So now when you look at trading, trading becomes an opportunity for you to generate income. And what happens is you start generating income and you say, well, can I have a little bit more? Not realizing putting yourself out there to get a little bit more can be detrimental to your overall process. As an example, if we take one or two trades a day, or we focus on one pair, we are limiting our exposure to the market. We're making money. We're not making as much money as we think we can, but on the opposite end, we're not losing money that we should be losing. We are not exposing ourselves to extra losses by putting more money out there, by trading more, and we're starting to understand that this is going to take time. At the end of the day, when you look at these factors, the lust, the gluttony, the greed, the envy, we're making comparisons. That's where it comes from. That's where it stems from. You started trading because you saw someone else doing well. You started trading because you joined the live stream and you thought how easy it was to do what people are doing on the live stream. You saw other people making money. You saw people purchasing things that you think you would have. But what you're forgetting is a very, very simple thing is you aren't that person. You are your own individual. And when we start making comparisons to other people, that's where we start to get in trouble. Because you can't just take the good with something. You also have to take the bad. So a lot of people will turn around, and this is from personal experience, people will turn around and say, well, um, Ted can, I want to be like Ted. Because if I'm like Ted, then I know that I'm successful. But in want to be like Ted? Do you want to go through the struggles that I've gone through? Sure, I'd go through the struggles that you've gone through to be successful. Okay. Are you my age? Do you have the education that I have? Were you brought up in the household that I was brought up in? Did you live where I lived? Did you experience what I experienced? So suddenly now, when you start making that list and you say, hey, I want to be like Ted, there's a lot of boxes you can't check off in that comparison because you didn't live where I lived. You're not the same age as me. You didn't have the same parents I had. You didn't have the same upbringing I had. So how can you identify with me when you're nothing like me? So why are we comparing ourselves to other people? You can't compare yourself to other people and only take the good. You're going to have to take the bad as well. And when you look at that as an individual, you start to realize that, hey, maybe I don't want that lifestyle. I don't want the bad part of that. But in actual fact, we take it a step further, maybe you're only seeing one aspect of that person's lifestyle. You know, a lot of people, especially on social media, will only show you one aspect of who they are or what they're doing. And you automatically assume that it's all roses. And that is the biggest problem that you're going to face as a trader is making comparisons to other people. Well, I joined this webinar today on May 17th. How come there's 5 people ahead of me? How come 5 people are making money and I'm not making money? You can't do that to yourself. You can't make those comparisons. Everybody has their own individual journey. Everybody has their own ability to work at their own pace. The more that you focus on yourself as an individual and understand who you are, the better off you're going to be. And now when you look at focusing on yourself, what are things that we have to remind ourselves of? We have to remind ourselves of what are our triggers? Where do those triggers come from? If I know that I have an addictive personality, I have to maybe control how I trade. Otherwise, I'm going to just start over trading. If I know that I want certain things in my life, I have to look and I have to say, why do I actually want those things? What voids are those things filling that I'm missing in my life? Where does my greed come from? Where does my envy come from? It comes from voids that are in my life. And now I'm using trading to potentially fill those voids by earning money to purchase things that maybe I don't need. Do you really need to have 6 cars when you can only drive one at a time? You may think you need that, but you don't. You want that. So when you decipher between your wants and needs, suddenly you'll realize what you actually need isn't necessarily, or what you actually want isn't necessarily what you need. So this is a very, very big topic that is overlooked because of the fact that people don't want to be honest with themselves. People don't want to take this down and list these things and write down on a piece of paper or sit on a computer and say, why am I actually learning how to trade? What is the reason I'm learning how to trade? Do I actually like trading? Do I actually have a passion for it? Or is it a means to an end? Do I think that trading is going to solve all my problems? And when you take a deep dive and you start looking at this, you're going to come to the realization that maybe trading isn't for you. But that doesn't mean that you can't trade. It doesn't mean that you can't do what you're doing right now. It means that it might not be a full-time profession. You might still work part-time. You might own a business part-time, and you might use trading to supplement your income. Maybe you don't make 100,000 a month or 100,000 a week. Maybe you only make 5 or 10,000 a month extra. Are you telling me that you wouldn't be satisfied with that extra money? This is where you have to be realistic with yourself. You have to be honest with yourself, and you have to identify where the triggers are in terms of why you are actually learning how to trade and what is the rationale. The more honest you are in the sense of why you're doing this and why you're doing what you're doing, the better off you're going to feel and the easier it's going to be for you as an individual to then trade. Because you're going to realize that, hey, if I only have 12 or 15 hours a week to devote to trading, I'm not going to be a superstar trader in the first 6 months, but I'll eventually get there. I'm working part-time or I'm working full-time to give myself opportunity to generate income, to support myself, and this is going to be income replacement. I'm going to make an extra couple $100 a week. That's going to pay for my cell phone, that's going to pay for my cable and my internet, and then as that grows, so will my savings, and then suddenly now the passion will take over because I'm starting to realize progress. So going on to the next slide there, this is a very interesting little, I guess, what can I call it? I guess equation that I coined about a year and a half ago, 2 years ago. And this is also part of self-awareness, and this is something that you're doing right now. It's education plus experience equals confidence. Okay? And when you see this, you start to realize, why am I not holding trades long enough? Why am I second guessing my analysis? Why am I trading on a day that I'm losing money? Why am I trading pairs I don't understand? Everything related to trading can be broken down into this equation. And people ask me all the time, and you'll ask the same questions too. How come I didn't hold my trades longer? How come I didn't follow my analysis? How come I got stopped out and then the trade went my way? Each of these little pieces of this equation are going to be your keys to your success. Right now, you're on the first component of this equation. You're on the education side. So today, you've taken your step, you've watched live streams, you've interacted with people, you're learning about trading, you're learning how to start trading, how to build out a plan, you're going to start to understand the chart, and that's the first component. The second component comes the experience. Maybe it's going to take you 6 or 8 months before you start to understand where your analysis is. Maybe it's going to take you a couple of years to get to that point. But as you execute more, suddenly your confidence increases. So now, because you have experience, that's giving you confidence, but that's also increased your education. Because you've increased your education and you've increased your confidence, you have more experience in the markets. So when you look at this equation, write it down. And any time that you are struggling with trading, it's going to equate to one of these items. I don't know why I don't hold trades long enough. Well, you don't have confidence in your trading. Where does that confidence come from? Experience. Where does the experience come from? The education in the chart. The education in meeting people and reviewing charts. The education in understanding how your market method checks. So now when you look at every little element of your trading and every element of who you are as a person, it can be broken down by this equation. So anytime that you're feeling a little lost or you don't know why you're doing something, look back at this equation and you're going to start to realize there's an element in the question that you're asking that's missing right now. So why am I over trading? Why am I missing trades? Why am I not taking the right trade? All these questions have an element in the equation, whether it's confidence, whether it's experience, whether it's education. You're going to have an element of this equation in any sort of gap in what you're doing when it comes to trading. So when you look at that and you are self-aware and you start to realize that, hey, the reason why I can't hold trades, it has nothing to do with my education, but it's just my experience. I haven't traded long enough to get the confidence that I need to hold trades into a 4-hour candle, into a daily candle. My strategy isn't strong enough. I'm not winning enough trades because I don't have enough experience with that strategy to determine if it's effective or not. So I have to go and educate myself and experience more of the charts so that my confidence will go up with my strategy. So this equation for you now becomes an element to your trading success. Because, like I said, everything related to trading can be related to this equation. And this equation can be manipulated. You can say confidence equals, confidence equals education plus experience. You can say education equals experience plus confidence. You can say experience equals education plus confidence. So these variables can be interchanged to give you the outcome that you're looking for at that point. And when you continuously review that, you use this as a base for who you are as a person, you're going to start to realize that trading becomes very logical and very analytical. I can't hold trade because I don't have confidence. It has nothing to do with my trading plan. It has nothing to do with my education. It has everything to do with my experience in the market. How do you expect to have a long-term swing trade when you've barely executed a regular trade? When you've barely won a trade? You have no experience. You have no confidence. So you have to let time do its thing. And that's self-awareness. Being aware of the gaps in what you're doing and understanding how to correct those gaps will ultimately bring you the success that you need. And then finally, my last slide is, going back to the topic that we had here in terms of, the final point of self-awareness is, these little tips here. Why are you learning to trade? What is your current situation? What's your current background in education? And how do you apply yourself in any other discipline? So when we break these topics down and we start looking, first of all, at why are you learning to trade? What's the rationale, truly, on why you're learning to trade? Do you like trading? Have you been interested in the financial markets? Is this something that you want to learn? Or is this something you're trying to do to make money? If this is something that you're trying to do to make money, you're going to have a tough time because trading's boring. Trading isn't exciting. Trading isn't every day. Trading isn't going to make you millions of dollars in the first month. Trading isn't probably going to make you anybody in the first month. So when you start to look at the ideas on why you're learning how to trade, you have to be very careful in terms of what your actual intentions are. Because if your intentions are just to make money, I'm sorry to say, you're going to fizzle out. Because when going gets tough, you truly don't have the passion for it, you're going to quit. Because you're going to realize that this is a very, very hard way to make an easy living. You're going to realize that waking up in the morning to trade a London session, to trade a North American session, is very difficult day in and day out. When the novelty wears out, are you still going to be here? So you have to be very, very careful and very conscientious of why you are doing what you're doing with trading. Why are you here? And it's okay not to have passion with what you're doing, because now you're self-aware and you realize that, hey, this is going to be a hobby of mine, this is going to be fun, but I'm not going to be giving it 100%, so I can't expect to have the best outcome. I'm going to have to take to the fact that if I half-ass this, I'm going to have half-ass results. And it's not going to be anybody's fault but my own. And that's the thing that you have to realize, is that nobody's ever going to force you to trade. Nobody's going to force you to be here. You have to show up. No one's going to ring your doorbell in the morning and tell you, hey, you got to wake up. No one's going to give you that call. No one's going to ask you how you're feeling or how you're doing. No one's going to ask you for charts. You have to take the initiative, and you have to put yourself in that position to win. That is the bottom line. This is a very, very solitude industry. You're working on your own a lot of the times, but you know what? There are resources out there to help you. You have a community here that's been built to bounce ideas off of other people, to chat with other people, to get you that support. But in the end of the day, you're the one that's executing, you're the one that's doing the analysis, and you're the one that's either reaping the rewards of your analysis or being punished for the lack of work that you're doing with your analysis, or the over trading, or the over leveraging. At the end of the day, it doesn't hurt myself, it doesn't hurt Raja, it doesn't hurt anybody but yourself. That's what's going to end up happening. The next topic in terms of what is your current situation? If you're in school, you're working full time, you've got two kids at home, you're struggling to pay bills, is this something that you can devote time to? You have to really balance your time. Maybe you're not able to wake up and trade the North American session because you work all night. So you have to now find where trading fits in your life because this is a lifestyle change. You have to understand that now trading is going to take a bucket of your life. It's going to take hours out of your day. And if you're not ready to sacrifice those hours, you have to rethink how your lifestyle is. If you're working 12 hours a day, you've got kids or you've got other obligations, you don't have the financial means, these are serious things that you have to think about. You have to say, how much time do I actually have to dedicate to this craft? What do I actually have? Like, what can I actually do to make sure that I have this availability? Maybe I don't have the availability right now, or maybe every few months I'm booked fully and I can't do trading. That's something that you have to be aware of. That's something that you have to understand what makes sense to you. Because some people have a lot of free time. Some people live at home with their parents. Some people are in school and they have days off from school so they can focus on trading. Some people have graduated school and now they're going to try trading instead of getting a full-time job. There's a lot of different elements, but you have to be realistic with your situation. And when you're realistic with your situation, you can set yourself up priorities and you can set yourself up with a plan that makes sense for you because everyone's plan is going to be different. Another item here is, what is your current background in education? As much as people say you don't need education to trade, you need an education in some respects. This is the biggest fallacy I hear a lot of people on the internet talk about is, well, I can drop out of high school and become a successful trader. There's no doubt in my mind that there are 1 to 2 to 3 to 4 to 5% of people that can trade with no education. They can come out of they dropped out of high school, they figured out trading, and now suddenly they're savants when it's when they start out trading. But the majority of people need some sort of education, and not necessarily education in finance. That's a nice to have. It's a great feeling if you're taking finance right now in university or college and you learn how to trade because you're going to start to see how a lot of things can impact your trading, which are related to the topics that you're learning in school. But the idea behind school is they teach you how to learn. And this is a critical skill that you need when it comes to trading. If you have bad study habits to begin with, do you think trading is going to be different? It's not going to be different. It's going to be the exact same situation that you had in high school, that you had in university. You're going to look for shortcuts. The only difference is in trading, those shortcuts are going to penalize you in terms of monetary gain. Where you took shortcuts in university and high school just to pass, if you do that in trading, you're going to see that your just pass in university and high school is going to be barely any profit in trading. So don't overlook education. Don't balk at education saying, well, I don't need this because I'm going to be an entrepreneur or I'm going to do stuff because school doesn't teach me anything. It may be true that school does not teach you something that you can't learn on Google or that you can't learn on YouTube or you can't read a book about, but what they do teach you is they teach you the skills necessary on how to research, on how to analyze things, on how to use critical thinking to come up with solutions to problems. And that's what you're going to be doing every day when you're trading, is you're going to have to solution out ideas to complete problems with trading. And if you're not good at problem solving, you're not going to be good at trading. It's just a fact. You have to understand that trading isn't a formula. Trading isn't just inputting a formula every day and getting an output. It constantly changes. It constantly adapts. So you have to be able to adapt with that. So if your education was very rigid in the sense that all you did was memorize a textbook and spit out the answers just to pass that class, and you didn't actually adapt and absorb information so you can then, apply it to the course that you're taking, you're going to have a very, very tough time here. And truthfully, in my experience, a lot of people that are very, very smart aren't good traders. They're not good traders. Why? Because what they've been taught is to memorize a book so that they can just regurgitate answers. And as soon as the variables change, they can't figure out the answers at that point anymore. So when we look at this and when we look at what we're doing, we have to be very conscious of who we are as a person and how we did school. How were we educated in school and how did we apply ourselves in school or in any element that required some sort of learning? Okay? And finally, how have you applied yourself in general? You know, if you've looked at working out, have you stuck to a routine? If you've been dieting, have you stuck to a routine? Where does your willpower come from? Where does your sense of strength come from? Because if you fail to keep discipline in anything that you've done, whether it's quit smoking, like I said, dieting or working out, do you really think that you have the willpower now to trade? Trading is a lifestyle. Trading is something that you have to give your attention to 100% when you're actually involved in trading. It doesn't mean that you have to focus on trading every single minute of the day, but when you're in your element, you have to make sure that you're not breaking those routines. You're not hurting yourself in that respect. You have to be able to make sure that as you continue in trading, that you remain disciplined, that you constantly do the same thing over and over again. It's boring. It's repetitive. It's something that you're not used to. But it's the same thing like going to the gym. Some people love going to the gym. They'll spend hours in the gym, where other people, it kills them to go to the gym. So you have to look at how you've approached other disciplines and how successful you were there. I can tell you from experience, a lot of athletes, a lot of people that are, that have taken courses, that have applied themselves in specialties, become very successful in trading because they understand what it takes to become successful in a specific discipline. If you become a professional athlete or you become a professional accountant or a professional lawyer or whatever it has where there's a specialty involved, chances are you're going to apply the same disciplinary approach to trading that you did because you understand the work ethic involved. So if you've never really succeeded in anything, it doesn't mean that you won't succeed in trading, but you're going to have to understand that the work that you're going to put into trading is going to be probably something you've never done before, and you have to be prepared for that mentally. And if you're not, maybe you have to gradually build yourself up slowly to that point so that you can perform at that level. But I'm telling you right now, if you've never played a sport, if you've never gone to the gym, if you've never built out a plan and executed on a plan, you're going to be, uh, it's going to be very difficult for you to manage this and manage trading effectively, if that makes sense. And I think that's pretty much what I had to talk about tonight.
Well, thank you.
Yeah,
Yeah, thank you. No, that was pretty amazing. Apart from the audio, but we're gonna fix that in post production.
we'll
Yeah,
have an editing team now.
yeah, yeah. We'll try to see what we can do. But yeah. So we had some people join in from YouTube and someone join in from Zoom. Zoom is having a worldwide crash right now. I mean, it's just bad.
We might have to do this on another day on a live stream or something.
Yeah, probably. So let me just do this. Okay, perfect. Thank you so much, Tad. Man, I really appreciate you
No problem.
took the time here
No
to
problem.
talk to us.
Yeah. No, appreciate you bringing me in, and hopefully you guys continue what you're doing, and we will chat tomorrow.
Yeah, perfect. Awesome. So I just want to confirm that if the audio is fine here from my end for everybody here, so we can continue on. Okay, perfect. YouTube also perfect. Awesome. So if you are having problems with the video on Zoom, if you're having problems with video on Zoom, just strictly go to YouTube. I'm gonna post a link of the YouTube here in the chat for Zoom chat. There you go. If you're having problems with video on Zoom, just go listen to YouTube. It's working perfectly fine. Okay, awesome. So we're gonna continue on over here. Let's see here. So we did risk management 2.0. So we're gonna continue on towards momentum, volume, and volatility. Now these words have been passed around for like a lot, right? So we're going to see what they basically mean. Let me see here. It is everything systems are perfect. Awesome. So when we talk about volume, volume is determined by the time of the market you are in. So basically price moves much faster when there's volume in the market. Ideally, that is the best time to trade. So whenever there's volume in the market, that's the best time to trade. So again, people are confused, they're asking questions. So you need to go to either YouTube. Oh, you can still see Ted's screen. Okay, let me just see here. Let me fix this. Okay, now you should be able to see the momentum versus volume screen on Zoom. Okay, awesome. So if you are on Zoom and YouTube, I would recommend to just go on one. If you can't see video on Zoom, just go to YouTube. It's perfectly fine over there. And it's also being recorded, so don't need to worry about that. Perfect. So when we're talking about volume, you need to understand when there's going to be volume in the market, right? So there are some times when there's going to be volume in the market. So the first is when markets open. Whenever markets open, there's going to be a lot of volume in the market. Whenever markets close, there's going to be volume in the market. So when we talk about market opens, we basically talk about that, okay, maybe there's going to be a lot of volume at New York Open, there's going to be a lot of volume at London Open or Asian Open, which is why some people say, oh, hey, like, you know what, I only trade the market opens. And you ask them why, and then say, well, the reason is because there's a lot of volume at that time. When there's volume, you have bigger candles. And when you are in trades, you need bigger candles to run your trades. So that's why we focus on market opens, market close, their news events. News events also have a lot of volume, right? Next you have breaking news. Breaking news also have a lot of volume. Now, and next we have speeches, etc. So when we're talking about news events, it's not necessary that you should be trading news events because it's very risky. There's a lot of volume. They're they're like very volatile. So we're going to talk about volatility here in a second here, but trading news is a big no-no. This is basically programmed in Forex Factory. When you have breaking news is news which is not programmed, which is not expected to be released, which just comes out of nowhere. Like, if someone talks about OPEC, or if Trump talks about something very controversial that may move the economy, or if you have, I know, like in 2018 and 19, we used to have a lot of breaking news on Brexit. So those were unplanned news. So those news events also bring a lot of volume in the market. So the best time to trade is when there's volume in the market. And the best time when there's volume in the market is basically when the markets open, when markets close. Especially one thing is missing here, the London and New York overlap. There's going to be a lot of volume in London and New York overlap as well, which we talked about in market sessions. Next, we have volatility, right? Volatility is defined by the uncertainty in the markets. This means that it's really tough to know which way the market will move, right? Whenever there's a lot of volatility, it's like during this time, you may notice candles move haphazardly on the charts, which is a sign to stay away till the market calms down. What this basically means is now sometimes, when you have news events, like you have NFP. Whenever you have NFP or interest rates or let's say you have FOMC, you see that the candles, they break highs and lows of the previous candles. Like the candles move up and down. That's a lot of volatility in the market. That means the price does not know where to go. There's a lot of volume, but it's very volatile. Volatile means it's very unstable. We don't know where it's going to move. When you have market open and when there's volume in the market, you'll see that the candles will make higher highs and higher lows, so like we talked about earlier, and they will make lower lows and lower highs if the trend is going down, which we also talked about earlier. But when there's volatility involved, you'll see that the candles just start breaking the highs and lows. It starts acting in a very haphazard manner. So when there's a lot of volatility, it's very difficult to trade. And volatility comes when there are a lot of high impact news. You have dead market hours. Sometimes when it's the afternoon session on when it's late in the Asian session, you might see some volatile market. Like there might be something happening in the background that may move price here and there, like with a lot of volatility. So it's very difficult to trade at that time. Sometimes, I know at London Open, when London opens, there's also some sort of volatility where candles they throw wicks up and down, and that's very difficult to trade as well. And then I remember in the past 1 to 2 years we had Trump tweets. Trump tweets was also causing a lot of volatility. Sudden change in economy also causes a lot of volatility. So these are the things that you have to be very careful about. I remember in 2018, 2017, and 2018, Kim Jong Un used to drop bombs. Like he used to test bombs in the Asian session, and that would cause a lot of volatility in the Asian session. Asian session will move a lot, but there would be a lot of volatility mixed with a lot of volume as well. So it would get really hard to trade. So I would say whenever you're trying to trade and you see that there's high impact news coming on, like maybe in half an hour or 15 minutes, it's a great idea to just stay away from the charts because we don't know where the volatility is going to go. Of course, we're going to have volume, right? We're going to have volume to trade, but when there's going to be volatility, we won't know where price is most likely to go, right? So let's talk about momentum. Momentum is the byproduct of volume and volatility in the market. Without any surge of volume, price cannot be in momentum, right? This is very important. You need to have volume in the market. You need to have volume in the candles in order to have momentum, right? You cannot see momentum in the market. You can feel it with experience. With momentum, you expect certain things to happen in the market, such as break off support resistance zones. Like, if price is approaching some sort of a zone, then okay, there's a lot of volume in the market, and now price is most likely to approach that certain zone. So when you see prices moving towards a certain zone, now we're going to talk about this momentum and volume later on in a lot of examples we have. So when price is moving towards a certain zone, you know that it's moving because there's volume in the market, and that movement is defined as momentum. You see it, you see, okay, man, like, look, there's a lot of volume in the market, price is in momentum, which means it's on its way to a certain zone, right? And the only reason when your support and resistance zones are broken, when there's a lot of volume in the market as well. Because for your 1 hour, 30-minute, and 4 hour zones to break, price needs a lot of volume in the market. It needs a lot of force. It's like when you're trying to break down a wall with a hammer. You need a lot of force applied on the wall to break it down. It's the same thing here. When you have dead market hours, let's say when there's no volume, support and resistances, they may not break. Like the minor ones, the 15 minutes, sometimes the 30 minute, they may not break. So you need time when there's a lot of volume in the market. So like you have trend changes when there's a lot of momentum. You might see some trend changes happen. You might see formation of larger candles as well. When are larger candles formed? When there's a lot of volume in the market. So that's what you need to see, that okay, if you're going to try to trade, what time are you trying to trade? Are you trying to trade when there's going to be volume in the market, which is when you will get larger candles, and those are going to be your trading candles. At the same time, like we talked about, as price is approaching, let's say, a support, you know that there's almost like 20, 30 pips left for price to approach a support. You look at the time, you're like, okay, this time there's going to be a lot of volume in the market, and there's also a lot of momentum. So price may reach that support because it's in momentum. It's in momentum because there's a lot of volume in the market. Why? Because maybe it's the New York Open. or it's the London Open, or it's the London close, or it's the Asian Open, or we just had the news and price just wants to move along. So these things are very important when you're looking at, like momentum, volume, and volatility. I just want to make sure again my audio is fine, video is fine, my pace is not too fast, not too slow. Um, okay, everything good? Everything, everything also good. Okay, people in YouTube is also good. Okay, perfect, awesome. Okay, let's move along to the next section here. I think next section we will have is for a little bit technicals. This is going to be a wick fill. You know, so now we're going to slowly move into market structure. What is market structure? How do you trade market structure? What's the wick fill? How do you trade a wick fill? These little things which you can kind of like identify to have profitable trades. And this is really, really important. This has been my bread and butter for a very, very long time. So for simplicity's sake, wicks are filled whenever price is in momentum, right? Just from a very, very simplistic standpoint. Wick fills, they start from lower time frame structure, which leads to higher time frame wick fills, which also means is that if you have a daily candle, right? Let's say if you have higher time frame candles here to the left hand side and you have lower time frame to the right hand side. And if you have a daily candle which is closing bearish, now you see the top is a liquidity wick on the bearish candle and the bottom is a range. Now, when a daily candle leaves a wick down over here, this means that it has the ability for the next candle to fill this wick. Right now, it's really easy to look at the higher time frame and say, okay, it's going to fill the wick. But then you have to ask that how? What kind of confirmations can we look at on the smaller time frames to see that okay, maybe now it's going to fill the wick, right? So let's break this daily candle down into smaller time frames. Now we know there are six 4-hour candles in one daily candle. So let's say the 4-hour candle started right over here, right? 4-hour candle was bullish, it went up, which means the daily candle went up to make a liquidity wick. Makes sense? This is going to be, I'm going to go really slow on this and then I'm going to repeat it again, right? So 4-hour candle first went bullish, and then the daily candle went bullish to make a top wick, right? And then the 4-hour candle went bearish. When the 4-hour candle started going bearish, you had the top wick formed on the daily candle, right? And then we had candles moving bearish. We had another candle moving bearish, making this low over here on the daily candle. And then we had a candle moving bullish, right? So when you have this candle moving bullish from here, right? It's like it's creating a support, right? It's creating a low right now, which is a low being formed on the daily candle. Makes sense? So now we have 1, 2, 3, 4, 5, and 6. This is the close of the first daily candle, right? So the daily candle started, we know, daily candle opened right over here, right? Which was the open right over here, because the bullish candles start from the bottom. And then daily candle made a high over here, which was the high created right over here. And then we started moving down and we created a low down over here, which was the low formed on the daily candle. And then the daily candle closed at this point, which was the close at this point. Make sense? I hope I've made myself very clear about how the daily candle has formed, and we're going to go over this again too. Now, for the next daily candle to fill the wick, how would the next market structure look like? Or how would you want to execute based on that, right? So most important thing is that the trend was bearish. We waited for a support to be formed, and then we waited for price to pull back. So now a low has been formed, and now price is pulling back. So now what you want to see is you want to see a candle flipping in your direction, which will mean you want candle to going bearish for you to say that, okay, now we can probably target this wick fill. So let's remove these arrows and we will now see how we can target that wick fill. So wait for the next candles. Now this is how the next daily candle should look like. The next daily candle should make a top wick, make a high. It should open right over here, continue down, make a low, and then close right over here. And this move down will be our trading move. This is where we need to see that, okay, this is where we want to take profits. So this is the trade we want to take. Now how would we know what would happen on the smaller time frames here, right? So let's take a look here. So the first 4-hour candle forms on the daily. So it makes a wick right over here, right? And then someone asked, does a wick get filled? We're about to answer that question again. Please don't answer any questions. Leave all your questions till the end. All your questions are going to be answered. Or that's okay. So now the next candle, now it goes bearish. So when a candle goes bearish, right, now you know that the wick is going to get filled. If you don't see a candle going bearish, this means a wick might not get filled. Right, so now when you have a candle going bearish, based on what we've learned, we know that, okay, now since we've formed a resistance, what's the probability for the next candle to go bearish? And someone can say, okay, well, the probability is pretty high, because if on the daily time frame, if we have to fill this wick, then we want the next candle after this to continue going bearish, something like this. Now the candles are making lower highs and lower lows, and we go to next candle, they keep making lower highs and lower lows, right? So this is where you said, okay, now maybe a wick is getting filled, right? So now, since now the candle is going bearish, we know that, okay, now what's going to happen is maybe the daily candle is making a low right over here, which was the low right here on the left hand side, right? But for the daily candle to close where it closed, we need a bullish candle closing right over here, which is going to be like this, right? So a close of the 4-hour at this point is also the close of the daily candle at this point. Does this make sense? Kind of makes sense. But if we were to say that, okay, if the wick would not get filled, then what would happen? If someone can say, okay, what if the wick doesn't get filled, or do the wicks always get filled? The answer is no. And the only way you would know that is if this was a bullish candle. If you had a bullish candle over here, then you would say that, okay, maybe, price is now starting to move up, and maybe this wick will not get filled. Because for you to know if the wick is going to get filled or not, you need to go to the smaller time frames and you look for confirmations. For this wick to get filled, this bearish candle closing was our confirmation. That, okay, now maybe price may start to go up. But if the next candle, let's say if the next candle goes bullish like this and stops you out, then that's just the probability of price not working out. Because when you have a candle closing bearish at a minor resistance, just like we talked about in the previous slides, there's a very high probability that price will continue moving bearish. So awesome. So let's continue on over here. Let's go to the, I think next we have risk management 3.0. So let's talk about risk management 3.0. So I hope people have been making notes on risk management and all the other things that we've been talking about, because everything is correlated. Everything that we've talked about is going to be used in the next slide. So it's very important you make notes. Now, using dynamic risk versus static risk, how to cut losses short, and understanding lower time frame market structure. This is really important. I have used the lower time frame market structure to my advantage to cut losses short. In the past 3 months, I've increased my lot sizes, but at the same time, I've also successfully cut my losses short as well, and it has worked a lot. It has worked in a lot of good ways. So we're going to take a look at that here. Um, let's say you have a resistance, right? You have a resistance and you have a candle going bullish. Now, if someone is looking at this and they say, okay, well, if we have a candle going bullish, now we're waiting for a candle to go to turn bearish so that we can take a sell, right? Like, the only reason we look at the candles at like certain zones is to know if we can take buys or sells. If someone is having issues on YouTube, I think if you try to log into Zoom, it might work. So basically, now if you have a candle closing bearish, and someone can say, okay, hey Raja, since what I've learned so far, I know that, okay, since now this candle went bullish and now we have a candle closing bearish, there's a higher probability for the next candle to continue down, right? If the next candle has to continue down, something like this, you need to take a sell right over here, and you need to place a stop above the previous candle's high. That's where we place a stop losses, right? We place a stop losses above the previous candle's high. So let's say someone says, okay, well, I'm going to put my stop loss up over here and I'm going to use 3% risk. Now, there are two ways to go about that. One way to go about that is to use static risk, right? If you're using static risk, you're placing a sell over here and you are now saying that, okay, this is my 3% risk, right? If price comes up and hits my stop loss, I'm going to lose 3%. But as you move on the trades and as you get more experienced and as you try to understand market structure more and now you want to get more advanced, you might say, okay, well, I'm going to use a dynamic risk. So what that basically means is that someone might turn around and say, okay, well, if I'm using 3%, I might want to enter the first sell at 1%, right? And if, let's say, price starts moving bullish, I might want to add another 1%. I might want to add another 1% right over here, right? And now you have total of 2% running. This is dynamic risk now. Right now you have 2% running and your stop loss is the same. The benefit of this, I'll tell you what's the benefit of dynamic risk. The benefit of this is, like, let's say if you have 2% running and for some reason the next candle just starts to move up and takes you out, if it hits your stop loss, you've lost 2%. You haven't lost 3%, but you've lost 2%. Now your risk was less. You used risk to your favor, right? But at the same time, what happens now is that, let's say price moves up a little higher and if you're still confident price is going to go down, now you can add your other 1%. Right? Now you've added your entire 3% risk. So once you've added this, and once price starts moving bearish, now you can say, okay, I have 1, 2, 3 positions running, and each position is at 1% risk for simplicity. Now you can say that, okay, maybe I want to close this position, and I want to close this one, and I'm only going to leave one position running. So if you have issues let's say if you use one position and if you want to know the advantage of using multiples with dynamic risk, this is the advantage. Now you can easily close two positions and you can let one run with stops at break even. Now it's up to you whether you want to put stops including the spread, commission, whatever. Me personally, I don't go into those details. I just put stops at break even. I'm willing to eat the spread. It's okay. It's whatever, right? So it's really important. Dynamic risk management is you're breaking down your trade into multiple percentages and then you're taking the trades. In static risk management, you're keeping the risk as it is. It's really important. Now, in the same aspect, when we talk about I don't know if you can or will slow the meeting, but can you explain that again? Okay, so I'm going to explain this again one more time. Now, let's see, or actually, let us continue to the next example and then we might make this concept much more clear. Let's say we have a support, right? We have a support and candle came bearish. Wouldn't you open the position once the new candle passed the previous low? Okay. We're only talking about what we're talking about right now. If you want to talk about some other topics, please, let's just stick to what we're doing right now. This presentation, I've built it with a particular structure in mind to help everybody. So let's not deviate from topics. So let's say you have a support, right? And candle is coming down towards support, it's bearish. And based on what we've learned, we're like, okay, if let's say this is a 1 hour support, right? And someone is saying, okay, if the candle has closed bullish, now there's a high chance that the next candle might continue going bullish, right? So if you think that the next candle is going to continue going bullish, now someone can say that, okay, I might want to take a buy and I might want to put my stop loss below the previous candle right over here, right? Because for price to continue up, we want candles to respect the lows in uptrends and we want candles to respect the highs in downtrends, right? So for this candle to continue bullish, it has to respect the low of the previous candle. right? So that's why if someone wants to take a buy over here, they might say that, okay, I'm going to take a 2% risk in this trade. I'm going to take a buy, and if price hits my stop loss, I'm going to lose 2%. You know, please, if someone is in here who wants to move the stop loss like down over here, don't do that. You know, you're placing stops below the candle lows in order to say that, okay, if price has to move up, it has to respect the low of the previous candle. If the next candle breaks this low, then that means now the buying idea is invalid. That means now price may start moving. Let's say the next candle forms like this and it stops you out. Now this means that the next candle may start moving bearish, right? This is why we have our stops below the lows of the bullish candles, right? So the first risk is static risk. So let's say someone who's new and they're like, hey, I'm not comfortable in opening multiple positions, but what I want to do is I want to open one position with one static risk, which is going to be 2%, and that's it. If price goes in my favor, I'm going to make money. If price goes in my stop loss, I'm going to lose 2%, and that's my plan. But as you go along, like, as you start taking more trades, as you start understanding more of the risk dynamics, you start to realize that, okay, well, instead of using 2%, I might want to open 1%. I might want to open 1% risk right over here, because if price retraces, or if price, let's say something happened that price just goes down and it hits my stop loss, I want to lose 1%. I don't want to lose 2%. I'm going to wait a little bit. Or you can say is that, okay, I'm going to put 1% right over here, and if price retraces, and if I still believe, as long as this low is respected, and I still believe price is going to go up, I might want to add another 1% right over here, right? And now you have two positions opened at 1% each, in total of 2%. Now you're using dynamic risk. Now, if let's say price from here starts moving, let's say from here, price now starts moving bullish basically. So now you are in profit. So now you can say that, okay, now since I have two positions open, maybe now I want to close one position and let the other one run, right? Because if you have a static risk, if you only have one position open, then it's a little bit of a hassle to go to your MetaTrader and right click the position and manually close half. It's a little bit of a hassle. So, I mean, if you're experienced enough, if you think that you can handle risk, I would say go with dynamic risk. We can only use dynamic risk on MT4, right? Can we disable dollar? Yeah, you can use dynamic risk on MT4 and MT5. It's operational on both. So that's how, like, you make sure you're using dynamic risk and static risk. So the idea is to never let price stop you out with your complete risk. That's the entire idea. The only reason slowly you're going to move towards dynamic risk would be that you would never want to get stopped out with your entire stop loss. This method takes experience and practice. Dynamic risk is extremely useful when the probability of the outcome is low and you want to enter with a lower risk. So when you're using dynamic risk, you're breaking down your complete risk. Let's say you're going to risk 4% per trade, right? You see an opportunity and you say, I'm going to risk 4% per trade. But at the same time, you're like, yeah, I'm going to use 4%, but I want to break it down. I want to break it down to maybe two positions of 2%, right? So that's useful. It's always best practice to reduce risk when you're unsure. Um, do we have any question related to this so far? Only this, not breaking lows or highs, just this, what we discussed. Okay, perfect. All right, so let's continue on to part two. Part two of risk management 3.0 is how to effectively cut losses short, right? So if you have a buy, right? If a buy trade is executed on the 1 hour or the 30 minute, right? If a buy trade is executed on the 1 hour or 30 minute, we expect candles to continue making higher highs and higher lows, right? So just understand this concept first. Just understand this concept. If we think price is continuing bullish on the 1 hour and the 30 minute, we want candles to make higher highs and higher lows. in the anticipation that as long as the candles close in our direction, the trade should be valid and vice versa for sell. As long as candles keep on closing bullish, or as long as candles keep on respecting their higher highs and higher lows, this means now price should continue going our way. Now, in the other way, now if a smaller time frame candle starts closing in the opposite direction or breaks the low of the previous candle, then there's a slight chance that the preceding candle might start going against you. What this means is, let's say you have a candle that's closing bullish. Actually, we're going to look at this example here in a bit. This is when you decide how to manage risk by closing a percentage of the position. This will eventually, so when you're reducing risk, right? Let's say if you have a candle open and the candle is going bullish and you're in a buy and it's a 30-minute candle, but let's say on a 15-minute candle you see that the candle has closed bearish, right? So now what you want to do is you want to reduce some risk. What I like to do is I like to take off 50% of the position away from the risk. What this does is this basically reduces your risk in a possible losing trade, right? Let's say if a smaller time frame candle closes against you, then there's a higher chance that the next one can go against you as well, and then ultimately your stop loss might get hit. So if you reduce risk, you can eventually reduce the risk in a possible bad trade, right? In the same way, you can remove some stress. Sometimes what happens is that when your position goes in a drawdown, some people get anxiety. Some people get stressed out that, hey man, I'm going to get stopped out again. I'm in the drawdown. So when you close percentage of the position, you're essentially removing stress. Because sometimes what happens now, this has also happened to a lot of guys here, guys and gals here, is that when you're in a buy and you go in a drawdown and you get afraid. You get afraid that okay, price might hit my stop loss, and you close out. You close out everything, and then price goes into your favor, and you're like, oh man, I should have held my position. It went in my way. I mean, it always happens to me. I don't know how to fix it. So the way to fix it is when price goes in drawdown, and if you still think it's going to go in your favor, but at the same time, if you're still afraid, just close 50%. Let it go. Close it out so that you're still in the trade, which means you're still in the game and you're not worried about losing the trade, right? What something else is going to do is now you're not going to have to worry about the trade as well, because now not only you've reduced the risk, but you've also reduced the stress. Now, even if you've taken off 50% loss away, if price still hits your stop loss, you're going to be okay with it. You're going to say, well, if it goes my way, I'm going to make money. But if it hits my stop loss, it's a good thing it's not going to hit my complete stop loss, right? Makes sense. I mean, you want to really reduce your stop loss. And it's also going to increase your confidence too, because most times this has happened to me. Now, I used to close trades when they would go in drawdown, and I'd be like, oh man, I'm afraid. I'm afraid this might go in drawdown, so I might want to close the trade. And I would be closing 50%, and when I would close 50%, price would go my way, and that increased my confidence. That gave me the confidence to the next time, maybe letting my entire position open based on what I've seen before, because I've seen it work before, so it has to work again as well. Now, looking at some examples, let's say we have high time frame here on the left hand side, and then we have the lower time frame on the right hand side. So when we have these two issues on the left and the right, what we want to do is we want to see that, okay, let's say we have a support, right? We have a support and we have candle that's going bearish. Let's say this is the 30-minute candle, right? The 30-minute candle is going bearish and the next 30-minute candle goes bullish. Now, based on what we've learned is that since if the 30-minute candle encounters a support and is closing bullish, there's a very high chance the next candle is going to go bullish as well. So we take a buy. Let's say someone says, okay, well, what we're going to do is we're going to take a buy right over here, and we're going to anticipate the next candle to continue moving bullish. Makes sense, right? This is what we learned. Now, when we look at the smaller time frame and we break down this bullish 30-minute candle into two 15-minute candles, just say yes, that this is what we will see, right? Based on the 15-minute, if we break it down to 30-minute. Yes? No? Yeah? Yes. Okay. Perfect. Yeah. Yeah. So that's what we're going to see. Now, when you see this, now you're like, okay, well, maybe if the next 15-minute candle goes bullish, that will mean that the 30-minute candle has to go bullish. But sometimes what can happen is that you might have a 15-minute candle that starts breaking the low of the previous candles. So what we learned in an uptrend and downtrend was that for an uptrend to continue, for these candles to continue moving bullish, you need the next candle to start respecting the lows of the previous candles. But if this 15-minute candle has broken the low of the previous 15-minute candle, this means that maybe the next 30-minute candle is starting to form like this, bearish. So if it's starting to form bearish, and if your stop loss is down over here, now you have to decide whether you want the position to be open or you want to close a portion of that position, right? Now what you have to do is, now you're going to say that, okay, what do we have to do now? What do we do now? Do we close a percentage to make sure, like, let's say if the next candle, let's say the next 15-minute candle forms like this, right? Just because the one before that broke the previous low. So now what if this happens, right? So at this point, if you would have closed 50% and if it hits your stop loss, you've lost less than what you plan to lose, right? But if you haven't closed 50%, now you've lost your entire stop loss. Let's say your risk was 2% and you were risking $50, then now you've lost $50. But when the candle closed bearish like this over here and you close, let's say, partial, and it hits your stop loss, now you've lost maybe $30 to $35 instead of losing $50. Make sense? This is how you're reducing your losses, right? You're not giving price the opportunity to hit your stop loss at the entire position. You're letting price hit stop loss at a portion of your position. This is really, really extremely important because I get too many questions saying, hey man, I'm getting my stops hit, and like, when my stops hit and when I make profits, I'm at break even. What do I do? Like I have a good win rate, but my wins are just a little above my losses. Like I don't know what to do. So this is what you need to do. Whenever you're taking losses, you're taking 100% losses. You're not taking a portion of the loss. So you always take. I always take a portion of my loss out, because if I'm using a 5 lot or a 10 lot, I don't want to lose $1,000. I want to lose maybe $700. Or if I'm using a 5 lot, I don't want to lose $500 based on a 10 pips stop loss. I want to lose maybe 300 or 250. Because I want to close percentage when I see that, okay, there's an opportunity that price may start going against me. So really important. There's a question here, but let's say if it goes on drawdown and we close 50%, but then it comes back to our entry and it might in profit, should we enter again with position? So basically the question is, what if we close 50% in drawdown and then price starts going our way? Can we enter another position? That is an advanced concept, and we're not going to talk about that right now. We're going to talk about that next weekend because that's a little advanced. I'm still working on how to correctly present that. But the one thing I'm really focusing on is how to cut your losses short. That's really important. Should we wait? Should we wait for the candle to close and once break the 50%? No. So I hope this makes sense on how you're cutting your losses short. You're basically looking at the smaller time frames, the 15-minute time frames. You're looking to see if they're breaking the lows or not. If they are breaking the lows or the highs, then there's a very high chance that the price may moving against you. So whenever you're in a trade based on the 1 hour or the 30-minute, you're constantly looking at the smaller time frames to see if they are turning against you or not. If they start turning against you, me personally, I'm taking percentage positions off. So points to remember is basically there's no rule on how much percentage to close. It's personal preference. It's up to you whether you want to close 25%, 50%, 75. That's totally up to you. My rule of thumb is I close 50%. With practice, you will reduce losses significantly, and I can promise you that. As you practice more, I would say if you're a new trader, just keep this in the back of your mind. Whenever you see a smaller time frame candle going against you, Whenever you see a smaller time frame candle going against you, just look to see that, okay, how can you reduce the loss, or how can you maybe alleviate some stress? Because drawdown is stressful, man. Like when you're a new trader and you have $1,000 account and you're in a $15 drawdown, it's stressful. So you want to take off some percentage, 50%, 75. This is really important. Trading is all about how to conserve losses. Trading is not about buying and selling. Trading is about how can you reduce your risk. Risk mitigation is really important in trading. That's one of the main cornerstones of trading. Always be aware of candles closing against you or breaking the lows or highs of previous candles in uptrends or downtrends. Right? Always understand, are the smaller time frame candles are still in uptrends or downtrends? Are they still respecting the lows of the highs? If they start breaking the lows of the highs, then you need to be very careful. Then you need to say that, okay, well, maybe price is not doing what we expected it to do, so maybe we want to close something here, or we maybe want to secure some risk so we don't take a whole loss. This is really important. It's going to help you with your psychology a lot too. The goal, again, is to conserve capital. Keep it safe and don't fuck up. A lot of people, what they do is when price goes in drawdown, they add a higher position, they add more risk. At that point, you are fucking up. You don't have to fuck up, trust me. Don't use higher risk when price goes against you. When price goes against you, look to see how you can reduce the risk rather than increasing the risk. These are really important things. Two very different ideas. When you're new, you want to add risk, saying that, oh, no, it's still going to go up. But when you're experienced, you start to look at, okay, it's coming against us. How can I reduce this risk? If it hits my stop loss, how can I reduce this risk? If it hits my stop loss, how can I make sure I take a less of a beating rather than a heavy beating? Um, do you cut your losses based on the 15-minute? Yes. So your rule 15-minute breaks the high or low? Yes. If you are using dynamic risk and price never puts you in a drawdown, but instead instantly in profit, how would you add more positions? I don't. Sometimes, price does what it does. Sometimes, if I'm using dynamic risk, sometimes, I've used a one lot on a buy and that has just shot up 30, 40 pips. It is what it is. You can't do anything about it. So we only trade on the best possible scenarios, and the best possible scenarios are where candles will, let's say you have a bullish candle right here. It's not letting me draw a bullish candle here. Let me see if I can. Okay, so if you have a bullish candle like this, oh, let's say if you have a bearish one, right? Let's say if you have a bearish candle like this, a perfect scenario is going to be that you would take a sell over here, price will retrace, create a wick, you will have another sell over here, your stop is going to be up over here, and then you're going to have a wick fill and a continuation down. This is the perfect scenario of a trade. This does not happen all the time. So sometimes what may happen is that you might take a sell right over here and candle just drops. It is what it is. You never got a chance to enter more positions. It's just how it is. Um, didn't you say add another percent if you still believe your trade will work out? Yes, you can still add, but that's advanced concept. You have to watch it happen over and over again. You just can't do that. So what I would recommend if you're a new trader, I would recommend just using one position. It takes a lot of experience using dynamic risk. I'm going to say it again. I wasn't going to add this topic because there are a lot of new people coming in, and I wasn't going to add it because it's a little advanced. So this will take experience of you watching charts, watching candles move, and then slowly you're going to start to learn that, okay, how to use dynamic risk. It's like riding a bicycle with training wheels, and then when you see your buddy riding the bicycle without training wheels, and you want to do the same, but at this point you're not at that level to do that. So it will take you time. So for now, we will just focus on how to cut losses short when the smaller time frame candles they start moving against you. Um, so after we're done with with the webinar, you can watch it over and over again, because once you watch it 3 or 4 times, you start understanding things much more better. So let's move on here. We have a little break time. I actually need a little bit of a break here. So let's answer a little question here. You did dynamic risk makes much more sense. Candle close against you. Okay, perfect, awesome. So let's take a break for like 5 minutes. It's 11:30 a.m. Eastern, and we're gonna be back at 11:35 a.m. Eastern. I hope my pace is good and it's not too fast or it's not too slow. Perfect. So we will see you in 5 minutes. Welcome, welcome. We are back. I hope the audio is good on Zoom and the audio is good on YouTube as well so far. Awesome. Okay, so we're going to continue our journey here and we're going to move into some really heavy technical analysis now. So, first of all, what we're going to talk about is support resistance zones, right? Support resistance zones, they're basically a support. It's the level on the chart where candles are most likely to reverse after dropping. You know, usually a bullish candle on the 30-minute time frame or higher after a bearish candle can signify formation of a support. So whenever you have candles moving bearish and you're looking at the 30-minute time frame or higher, if you see a bullish candle forming after that, that's a support formed. This is really, really important to understand. When you're looking at supports, I hope guys are making notes. If you're looking at supports and if price is moving bullish, and when you have a retracement, you need a support formed, which is going to be a bullish candle forming after a bearish candle, which will signify a support has been formed. In the same way, when you have resistance, it's a level on the chart where candles are most likely to reverse after moving up. When price is moving bullish, it's going to encounter some sort of a resistance and the candles will be bullish candles. So you need to see a bearish candle forming after the bullish candle on the 30-minute time frame or higher to signify that, okay, now a resistance has been formed, right? This is a very simple concept. Now, when you're talking about zones, all support resistance zones are just zones. It's never a specific price. It's always a collection of prices. So whenever you sometimes, so back in the day when we started, we used to draw lines as support resistance. And when we used to draw lines, we'd say, okay, well, let's say if you're looking at price at 100, someone would say, oh, my support is at 100. How come your support is at 102? So what we realized that those support resistances are just range of prices. They're just collection of prices. So that's why we just signify them based on candles. So let's say, for example, now we have range, right? What's a range? Range is the distance between two zones, support and resistance. The bigger the range, easier it is to execute a profitable trade. So what I mean by that is, let's say you have a resistance and you have support, right? These are very basic concepts, and these are the exact things I use to execute trades. No problem on the higher time frames, the 4 hour daily. This past week, I executed a trade on the daily on GJ, on the lower time frames as well. They always work. So let's say you have a support and you have resistance and you have a candle, bearish candles that are coming down, right? You have a bearish candle coming down to a support, and then you have a candle closing bullish. When you have a candle closing bullish, now you're like, okay, well, if a candle's closing bullish over here, maybe this is a formation of a support, right? If this is the formation of a support, you need to look at two things. Number one thing is going to be your stop loss. So your stop is going to be somewhere down over here. And the number two thing is what you're going to look at is that if you're going to take a buy, do you have enough range? Right? Do you have enough range here? So you have to measure this range. You have to measure this distance. So if you're going to take a buy, you're expecting price to continue moving bullish to the next zone. So you need to see how far is that zone? Is there enough pips to that zone? So if you measure and this turns out to be 20 pips, someone can say, well, it's only 20 pips and I don't think it's enough. I don't think it's enough range for me to trade. Because if you take a buy, let's say if you take a buy down over here, or no, actually, let's say if you take a buy over here and you expect the next candle to go up, now you maybe have a 15 pip range, so you can maybe get like 8 pips out of it. So it becomes very risky to trade in a smaller range. This is why it's always important to measure how big is your range, how much distance you have. Let's say, for example, that instead of 20, this is a 40 pip range, right? If you have a 40 pip range, now it becomes much more easier for you to say that, okay, if I take a buy, there's a very high chance I can maybe get 15 to 20 pips, because it's not important that price will go all the way up to the zone. It might go halfway through and then start coming down and start ranging or whatever. So you need to be really cognizant of the fact that, okay, how big is my range? If it's a 40 pip range, you can easily get 20 pips out of it, 15 pips out of it, and let the rest run. If you're looking on the daily, on the 4 hour, and if your range is, let's say, 100 pips, then you can say, okay, well, in this 100 pip range, I can basically get maybe 50 pips out of it, 60 pips out of it, but not the whole move. You'd want to let a runner running, right? Which means you will need to leave a position at break even to see if it does continue that way, right? So that's support resistance is just based on the fact that, okay, if you do see a support formed, how are you looking to see that price is going to continue to go up? Or if you see a resistance formed and you have candles closing bearish at resistance, how big is the range here? How much room do we have for price to come down? If it's a bigger range, then then the candles are going to have a much easier time going bearish. But if the range is smaller, then it's going to get very hard. So you have to really choose your battles. And a way to say, you need to put yourself in the best position to win. Ted used to say this all the time, and the best position to win is to wait for price to come up to a resistance and print a candle in your direction, or wait for price to come back down to a support and wait for a candle to print in your direction. Then you're going to have a much better chance of winning the trade. This is really important. A lot of people, they don't wait. They take sells when candles are bullish. Let's say if a candle is moving bullish like this, at resistance, they will try to take sells, anticipating it to go down. You can't take a sell at this point because candle is bullish, man. You have to wait for a candle to flip bearish in your direction and then take a sell. This is like, couldn't this be seen as trading in consolidation? Yeah, but we're talking about, this is a very generic example. I'm giving very generic examples for means of understanding, right? So this is like saying if you're standing at a bus stop and you want to go left and all the buses are going right, are you going to get on the bus that goes right, anticipating that it might go left? No. You're going to wait for a bus that goes left, and then you're going to get on that bus, and then there's going to be a higher chance for the bus to go left. Just like if you have a candle closing bearish, then you're going to know that, okay, if the candle has closed bearish at resistance, there's a higher chance for the candle to continue going bearish. Resistances are more likely to get broken in an uptrend than in a downtrend. Support are most likely to get broken in downtrend. Yes, that's correct. A 40 pip range can easily give you 10 pip move. Yes, that's also very correct. Okay, perfect. Let's keep moving on over here. So let me just remove all these. So also, if you have some questions, just wait for your questions till the end of the presentation here. When it approaches support resistance, shall we wait for 15-minute or the 30-minute? Okay, Basit, someone asked this question. It just seems to me someone hasn't been taking their notes properly. We've talked about how the 15-minute is a weak confirmation time frame. We've talked about how the 30-minute is closing. That will give you a much better confirmation for price to move. This is why, guys, listen, take notes. Take notes, and before asking questions, look at your notes. Because when you ask questions on the fly, your questions are going to be answered in your notes. Trust me, I've built this presentation in a way to answer all your questions. All right, so let's continue on towards identifying support resistance. So basically, most recent rejection areas will be regarded as the most probable zones, right? These areas are also called fresh zones. These are zones where price reached and had a reaction to it. What this basically means is, now let's say when we're looking at this chart, right? For example, let's say that we don't have access to all this information here, right? We don't have access to this information here. And when we're looking at price in this level, we see that there's some sort of a resistance form. So now someone can ask me, okay, well, how are you able to draw a resistance? How would you know where to draw resistance? So the best way to draw resistance would be based on the wicks, right? Maybe like you're taking into account like the average length of these wicks, and then you're drawing a zone. You're like, okay, you're looking at once you see that these candles are respecting this area, you look left and you see that all the other candles were also respecting this area. Now, drawing a zone like this comes with practice. The more you look at the charts, the more you draw zones on your charts and you post them in the chat, the better you're going to get. Because what's going to happen? You're going to get feedback. So I don't expect anyone who is new here to get these zones right off the bat. I don't expect that at all. I expect you to mess up. I expect you to have bad chart analysis. I expect you to draw bad zones. And over time, together, we're going to get better at the zones. And ultimately, then we're going to start executing and having profitable trades. So just take your time. Now, fresh zones are basically zones which have been recently rejected, right? So this example was just to show you how you can have like, a resistance here. Let me just get the other one. So yeah, so you have a resistance here, and then price came down. It formed a support right over here, and then price continued to go up. And since price was continuing to go up, we had this candle that moved with volume. There was a lot of volume in this candle. It moved up and it encountered. So when candles are looking left, it looked left and it saw that, okay, there was a resistance up over here too. So it kind of uh, reacted to this resistance and then it continued to come down. So look at how the candles are closing. So this one candle, this closed bullish above this resistance, then we expected this continue to go up, but it went bearish. Maybe it went bearish because it saw resistance here to the left hand side. So it went bearish, and then we formed a bunch of we formed more resistances here, which price started to respect, and then eventually price started to range here. Um, if a zone is formed above a resistance or below a support, does that make you hesitate on entering? That makes no sense. I mean, that makes no sense if a zone is formed. I just don't understand. Because support resistances are a zone. So let's say if you have this resistance zone and you have this support zone, and now what you're doing is you're basically eyeing the fact that, okay, once we have these two zones, where is price most likely to go? If price breaks this support, where is price most likely to go? So you look left and you're like, okay, well, maybe price may continue down to this support. Or if price breaks above this resistance, then maybe price may go up to this resistance, right? So whenever you're looking at the chart and whenever you're plotting out your charts, you're plotting out, please make a note of this, you're plotting the most recent support and resistance zones. Right? Once you have those plotted, then you're plotting out that, okay, where's price most likely to go if it breaks up, and where's price most likely to go if it breaks down. That's it. And then you're waiting for candles to, like, maybe break up. If you have a bullish candle forming, in this area right over here, then you know that. Let me just get my bullish candle. Let's say if you have a bullish candle forming right over here, and you're like, okay, if this is a 30-minute time frame, or if this is a 1 hour time frame, then this basically means is that now this is a higher confirmation time frame, right? So you're drawing these zones based on the 1 hour, maybe the 30-minute, right? Sometimes the 30-minute, not on the 15-minute. 15-minute is a weak confirmation time frame. 15-minute is not going to work all the time. If you want things to work, you have to excuse me, guys, I'm having a little bit of a language barrier. Perks of being an immigrant. Yeah, so you have to focus on the 30-minute and the 1 hour because those are higher confirmation time frames. So when you have a candle closing above here, then you know that, okay, now there's a higher probability for the next candles to continue going up. Or let's say if the next candles don't go up, then you might say that, okay, if we do start to go up a little bit, then there might be a probability that we might get candles coming down over here. And when candles are coming down and you're looking for buys, you're looking to see if candles are going to close in your direction. You're looking to see if you get a something candle forming like this, which now becomes a support. And now you can see, okay, since we have a support formed, there's a very high chance next candle can continue moving bullish. right? So this is what you're doing on the 30-minute time frame. As you start to do this more and more, you will start to understand that, okay, this also makes sense on the 15-minute as well, but that's a far-fetched idea. That comes with experience. Dynamic risk comes with experience. Executing on 15-minute candles also comes with experience. So if you're a new trader, I would focus on the 30-minute, the 1 hour, and that's it. And I promise you this will continue to work. Um, okay, so is there a certain time during the day where we can straight execute when we get a break and close above level? Yeah, it depends. So someone asked the question, is there a time of the day when we can just execute without waiting for a retest? That's very subjective because we don't know if there's going to be a retest. We don't know whether price is going to continue moving up or not. But what we do know is that based on experience. Now, if I look at, let's say, GPJPY, if I look at GPJPY, I have seen that pair for 3 years, every day, every morning, and I know for a fact that sometimes when it breaks out of a, let's say, resistance, sometimes it may not do a retest. So I might enter knowing that it won't do a retest. That came from me watching it over and over again. Someone who's new, please don't take this as a sound advice to take a trade. You need to choose your pair and you need to watch how it moves. If you don't watch how it moves and you start taking trades like a cowboy, it's not going to work at all. Trust me, I've been down that path. I've seen people go down that path. I've experienced a lot of dark memories from trading and it doesn't work. Should we always wait for a minor support resistance to be formed? We're going to talk about that. When analyzing on lower time frames and putting zones, aren't you scared that you will trade against the higher time frame bias? We're going to talk about that. So we're going to talk about all of that. So again, I'm not sure if everyone's listening or audio cuts out when I say that all questions are going to be answered. They will be answered without you asking, obviously. So so this is a concept, the apartment complex concept, right? This is used best to describe your support resistance. Someone asked, is the support resistance the same as supply demand? Yes, supply demand, from what I see and believe, is supply demand was created based on like stocks, futures, equities. Like when you had trading of like grain and corn and soybeans. That's where the word supply demand came from. When you're looking at currencies, you're looking at support resistances and zones and stuff like that. So they're basically the same thing. There's actually not much of a difference at all. So for simplicity purposes, I just look at them as the same thing. So apartment complex. Let's say you have an apartment complex right over here, and let's say this is your apartment right here, right? In this apartment, you have different levels. So you have one level up over here, you have another level down over here, and then you have a second level, and then you have a second level over here, and then you have a third level, and then you have a third level over here, and then you have another level, and then you have another. So a level you have in the middle, this is the middle level you have right over here, right? So now for simplicity purposes, let's say this is your roof, which is your weekly time frame, right? And then this is your floor, which is also your support, and this is the weekly time frame. And then you have your daily over here, and then you have your daily right over here. Then you have your 4 hour, 4 hour, you have your 1 hour, you have your 1 hour, and then you have the 30-minute, and then you have the 30-minute over here. Right? Perfect. So these are like your support resistances line. This is the easiest way to manage support resistance here, right? So let's say you have a ball in the middle of this apartment complex, and let's say this ball is bouncing up and down, right? So let's say once this ball bounces and breaks above the roof on the 30-minute, right? If it breaks up, there's a very high probability that it might continue going up, right? So if it breaks above this resistance, it's going to continue on to the next resistance, and then it will start bouncing up and down. Now, since it moved to a higher resistance, it's going to need a lot of force to break above this higher resistance. So let's say if it breaks above here, you know that the next place where the ball is going to go is probably going to go to the next one, the 4 hour one, and then it's going to start bouncing in the 4 hour resistance up and down, up and down. And if there's enough volume in the ball, it might, break down the floor and come down to the lower time frame, start ranging, and once it breaks above the 4 hour, goes up. And if there's volume, it might break up into the daily floor here too, right? Now it's bouncing into the daily floor. So as it starts moving up a level, you will notice that the ceilings of this apartment complex, they become tougher to break. A time comes when it comes towards the roof here, and when it starts to break above the roof, the security guard comes. They're like, "Oh no, man, you can't come on the roof. You can't play on the roof right now, son. So you got to go back down." So then the ball says, "Okay, well, since this is a very, very strong zone over here, I might want to reject this zone and go back down to the lower zone right over here." Now it starts bouncing down. So subsequently, if price breaks below the floor, goes down to the next floor, the support is going to be the 1 hour one, right? So you get the idea how price moves between support resistances. It's like floors and ceilings. If the floor gets weaker, it's going to break down to the next floor. So now when price is bouncing between these floors, you have the most recent resistance marked and you have the most recent support marked down over here. So if it breaks the support, the next support for to go to is down here, and it's going to keep on bouncing, right? And if it comes down to the basement, again, the security guard comes and they're like, "Oh, son, what you doing in the basement, son? You got to go back up." And you realize that this is the weekly time frame, and this is very, very strong. So you just go back up the room, and you're like, "Okay, let's just keep bouncing up over here." So this is how price moves between supports and resistances. This is really, really important. Whenever you have price and you have the most recent support and resistances drawn, we're going to go over a lot of examples here soon. So whenever you have support resistances drawn, you know that if we break above a support, if we break below a support, where's the next area that we're going to go, right? If we break above a resistance, where's the next area where we're going to go? So this is really important to understand. All right, let's just remove all this and let's go towards. I hope my pace is not too fast, not too slow. It's okay. All the questions are going to be answered as we go along. All right, let's see here. Let's move towards higher time frame candles versus lower time frame candles. Right. So this is really important when you're trying to execute trades, right? This is important in a way that, let's say when you're looking at the 4 hour candle, you're looking at the 4 hour candle and you're like, okay, well, I expect the 4 hour candle to continue moving bullish, and now I want to jump down to the smaller time frames, and I have to figure out what do I need to see in the smaller time frames to execute on the higher time frames, right? Or how does the smaller time frame candles, they create the higher time frame candles? This is the most important part of trading which you will face. Now, once we go into these examples, please don't ask what if this, what if that happens, or what if this happens, and because those are, then once we start talking about what ifs, then there are infinite number of outcomes. So we're just going to talk about what's presented to us. So let's say we have a 4 hour candle right over here, and this 4 hour candle is broken down into four 1 hour candles, right? So for the 1 hour, for the 4 hour, we made a low, we continued going up, and then we made a high, right? For the 1 hour, so you had four 1 hour candles, one, two, three, four, that formed the overall 4 hour candle. So the 1 hour candle started from the bottom, and now we're here. So started from the bottom, it went up, right? So you see how this was the main volume of the 4 hour candle, right? This is the main volume of the 4 hour candle, and after this, the 1 hour candle moved up. You saw that, so you would expect the next 1 hour to continue moving bullish, and you would say, okay, the 4 hour has to move bullish. But since you're waiting for the candles to close, you're looking at the candle here. This candle closed a weak bullish candle, right? What does this mean based on volume? We talked about volume. If you guys have been making notes, I want to know what this means based on volume. Leroy said low volume. I hope he's correct. Well, I guess only Leroy knows the answer out of 300 people here. Awesome. Perfect. Indecision, low volume. That's good, right? So guys, listen, I need some interactivity, So now when we're going to go in examples, I'll need a lot of interactivity to keep me engaged, or I'm going to get bored. Perfect. So you had a candle close like that, which meant that there's going to be less volume here now, right? So you're like, okay, we're going to wait for the next one. Next one also closed with less volume. Like, okay, and then the one after that, it made a high, but it closed like this. I don't know where to message. Oh, if you're in YouTube, you can just measure it in the chat in YouTube, or you can message in the or you can message right over here. Yeah, there are a bunch of questions in the question answer box here on Zoom. I'm probably going to answer them at the very end. Okay, so perfect. So this is how the 4 hour candle closed. So you had a high over here, which was the high over here, and the low down here, and which was the low down here. So we're just looking at how these candles are formed. So let's move on to our next example here, and let's see what we have in store. So next we have, this is the 4 hour candle, and this is the 1 hour candle, right? So just by looking at the 4 hour candle right now, can someone where's the chat box? Okay, right here. Right? So can you what's the probability of the next 1 hour candle to go down? It's pretty high, right? Because the 1 hour candles, they kind of like they kind of like it was bearish. This was kind of like this. This was like a doji candle. This finished bearish like this, closed below these candles, and the 4 hour candle is bearish. So if we're expecting the next 4 hour candle to continue down, which means the next 4 1 hour candles need to form in a way that they will continue moving bearish as well. So if we move forward, we'll see that, okay, 4 hour candle did indeed move bearish. Now we want to see, what did we want to see on the 1 hour for it to move bearish. So this is how the 1 hour candle formed, right? So if you notice, the first 1 hour candle, it went all the way down over here, and it retraced and went and came all the way back up. The most important thing to note about this is that how the candles were making lower highs and lower lows. Right? Can you guys see the lower highs and lower lows? It's very important. For price to continue moving bearish, it has to make lower highs and lower lows. So this candle eventually closed like a doji candle. So this means that candle opened and closed at the same point. But if someone entered sells over here, they probably took profits here and would have left a runner. Now we see the next candle, 1 hour candle. Notice how it has no wick on the top, right? So when a candle is bearish and it has no wick on the top, what does it say about volume? Is there a lot of volume in the bearish sense, right? Yeah, it's very high volume. Now I see, like, guys are interacting, and I'm loving it, because that's what we like, interactivity. And then you had two 1 hour candles. This had a lot of volume. This closed like a doji candle, and this closed like a small bearish candle, right? So now we essentially broke down that one solid 4 hour candle into multiple 1 hour candles. This is where, if you're in a 4 hour candle trade and you see a 4 hour candle go down and then go up, because when this 1 hour candle formed, this went down and then it went up. So what it meant with the 4 hour was that the 4 hour went down and then the 4 hour went up. So if you were only looking at the 4 hour, you must have been like, oh man, like this candle, man, this candle went down and now it's coming back up. So I don't know what's going on. But when you're looking at the smaller time frames, you're like, okay, well, it's still making lower highs and lower lows. So for the 4 hour to continue bearish, you want the lower time frames to continue making lower highs and lower lows. Could you look for support? No, we're not talking about supports, resistances. We're not talking about Fibonacci's, harmonics. We're not talking about. No, we're only talking about what we're talking about right now, right? This is very important. We're just talking about this instant right now. That's it, you know. So So this is how you're mainly breaking down the smaller time frames to see how the higher time frames are building up. If you think the higher time frame will continue moving bearish, then you need the smaller time frames to continue making lower highs and lower lows. If you think that the higher time frame is going to go bullish, you want the lower time frames to continue making higher highs and higher lows. Someone asked, isn't the long wick a price rejection? It is. It is a price rejection. But if we're looking for price to continue going bearish, we are looking for this candle to respect the high of the previous candle, which is why you're placing your stops above the candles. Once you took a sell when this candle formed, your stop is up over here. This candle moved down, you bring your stop above the high of the candle. When this candle forms, you're bringing the stop over here. When this candle forms, you're bringing the stop over here, right? Because it's going down, so you're bringing your stops above the highs of the candles. Makes sense because that's the bearish trend. Last four bearish together with different correct beginning trend bearish. Yeah. Oh yes. Look, Juan said the right thing. He said that if there was a support formed, there would have been a bullish candle closed. All right. So let's move on to the next example here. We have a lot of examples. Isn't this the doji we ignore? We're not going to talk about that right now. That's a little advanced concept. I'm probably going to, in 2 weeks' time, I'm going to create like a better, well-versed webinar on doji candles and stuff like that. So we're going to cover those topics then. All right. We have another 4-hour candle and we have 4 1-hour candles, right? So now take a look at this. When this 4-hour candle was bullish, when it was forming bullish. At one time, it went bullish like this, and then you had candles going like this bearish. Now, notice how these candles are leaving wicks, but they're making lower highs and lower lows. This is a lower high, and a lower high, and a lower low. So just based on the 1 hour, it does seem like price can continue moving bullish. Someone asked, how are these going to help us execute trades? Again, all your questions are going to be answered. I don't know why people are asking questions right now. When I announced in Slack, don't ask questions in the middle of the webinar because it's a very streamlined webinar. It breaks my focus. So let's just continue on and all your questions are going to be answered, right? This is just for your understanding purposes. Like, come on, guys. Seriously. Okay. Um, Now, the thing is, you you can't take trades without learning the candles. Right now we're just learning how candles move. Once we start learning candles, then we're going to talk about how you can start taking trades. That comes later on. So right now we're just learning candles. So let's have some patience. This is why, people don't have patience when they trade. You need to have patience. So let's look at the next 4 hour. The next 4 hour went extremely bearish. Now we want to see that, okay, how did this 4-hour candle go down on the 1-hour candles? This is how it went down. So now if you see that candles were making lower highs and lower lows and they continued to move down, right? So whenever you're looking for sells, you're looking to see that, okay, if I'm going to look for sells at this point, let's say if I'm going to look for a sell at this point, I want candles to respect the previous high. So when you're looking to see, okay, how am I going to execute a trade? You are visualizing a trade, right? You're visualizing, you're creating a bias. So before this 4-hour candle formed, you're creating a bias to say that, okay, my bias is bearish because the 4-hour is bearish here. If my bias is bearish and if I want to take a sell, I want my stop to be above the 4-hour candle, and I anticipate the next 4-hour candle to continue moving bearish. But now when you break it down to the 1 hour, let's say if someone trades the 1 hour, then they'll say, okay, well, maybe if I want to take a sell right now, I'd want my stop loss to be above this candle, and I'm going to be executing over here. Executing trades is really, really hard. Why? Because you don't trust yourself. And you don't trust yourself because you haven't seen things happen over and over again. That's the most important part. So you need to get really good at executing trades. If you think that price is going to continue moving bearish, then you would know. If you've been making notes, you would know that, okay, what's the first step? The first step, okay, what's the first step? Can someone tell me what's the first step? The first step. The first step, someone said it is. Someone said identify a trend. That's wrong. First step is to identify a stop loss. First step is to always identify a stop loss. Whenever you're going to take a trade, first step is you're always saying, where is going to be my stop loss? So if you're looking for a sell in this situation, you're asking yourself, where will be my stop loss if I take a sell? If you take a sell, your stop loss is going to be above the candle, because if you're looking for sells, you're anticipating candles are going to make lower highs and lower lows. Basically, because if you're looking for sells, you're anticipating price to continue moving bearish, make lower highs and lower lows. And for price to move bearish, you need candles to respect the previous high, like this here on the 4 hour, and then right over here, lower highs and lower lows. Right? You're always marking down where your stop loss is going to be. Right? If for some reason, let's say this candle here, it starts breaking the high of the previous candle, let's say like this, then your sell is invalid. This is why you're identifying your stop loss the first thing that you do. Whenever you're identifying a trade, you're identifying where your stop loss is going to be. So let's move on to the next example here. We're going to have a lot of examples here on basic trades as well. So we're going to put someone on the spot. All right, so this is what we have, the 4 hour. Now, just by looking at this 4 hour candle, do we know where price is going to go? I don't think so. No, we don't know where price is going to go. We can't really execute a trade. We don't know where price is going to go. But if we look at the 1 hour, can we agree that on the 1 hour we have a support forming here? Right? Because we had a bullish candle here, then we had a bearish candle, and then we have two bullish candles. So you're like, okay, well, if this is the time I'm coming to the charts, we have a support forming here, right? So maybe the 4 hour can go up, maybe not. We don't know, because there's still some sort of a, like a minor resistance forming here, so we might want to wait. So let's see what happens as the next 4 hour candle forms, right? So the next 4 hour candle goes bullish. Okay, so let's say that we went out for a bathroom break, or we went out to get groceries, to stand in a line due to COVID-19, whatever, and we come back and we see the 4 hour candle went bullish. And you're like, oh man, I was looking at the 1 hour, it was ranging, I missed the trade. And now you have to ask yourself that, okay, how could I have caught this trade up? Because the 1 hour was ranging, 4 hour closed like this, and there was no confirmations, right? So you would want to see now on the smaller time frame that, oh, okay, maybe there was this 1 hour candle that just went bullish. Sometimes price is going to go bullish, it will do a retest, and then you will take a buy, and then the price will go up. But sometimes prices are going to shoot up from resistance. There's nothing you can do about it. It's just the way how it is. And if you notice, the one candle went bullish with a lot of volume. Maybe this was some sort of news or market open or whatever, but there was a lot of volume here. And the next candles just started to make, like, smaller body candles and higher highs and higher lows. And then you had this bearish candle and whatever, right? So let's move on to the next example here. So this exercise is just so that you understand how the overall smaller time frames, they build the overall larger time frames. As we go along, we're going to do a full-fledged chart workout where we will, like, do a little exercise and to see, like, who wants to take buys and who wants to take sells and this and that. So there's going to be a lot of information there. Okay, so over here what we have is we have the 1 hour chart. We have over here the 30 minute chart, And then we have here the 15-minute chart, right? Perfect. Now, just by looking at the 1 hour, right? Just by looking at the 1 hour, if we were to say that price has to go down, we're anticipating on the 1 hour for price to create a um, lower high and a lower low, right? On the 30-minute, also, we're looking for price to create a lower high and a lower low. On the 15-minute, we're just a bunch of candles forming whatever. Let's see what happens here. So the 1 hour candle, it went up and then it went down. Now, if you're talking about static risk, a new trader can say, okay, well, I just used 2% right over here, and then my stop loss was up over here, and price went down and took profits, and everything worked well. Uh, Someone who's experienced, they will say, okay, well, I'm going to use a dynamic risk, and with dynamic risk, you're splitting your positions into multiple positions. Like, let's say you are taking maybe 1% here, you're adding another 1% here, you're adding another 1%, a total of 3% now, but your stop is always the same. It's above the previous candle, a couple pips above the previous candle, right? So now let's see what happens on the 30-minute, right? Because we're going to break down this 1 hour candle into two 30-minute candles. Check this out, right? Even though the 1 hour candle had an easier time coming down, the 30-minute candle actually went bullish first before the next one came down, right? So see how on the higher time frame you get much stronger confirmation. On the smaller time frame, it can sometimes confuse you a little bit, right? But the 30-minute also respected the previous highs. Now, if we look at it on the 15-minute time frame, you will see that the 15-minute closed like this and closed like this, and you're like, oh man, I don't know what's going to happen, because if you have only this information available, right? If you only have, let me just get my marker back to blue. Let's say if you only have this information available, you don't know where the price is going to go, right? I mean, we don't know where it's going to go because it's a smaller time frame. It's giving us weak confirmations. This doesn't make any sense. So that's why we're looking at the higher time frames, because the higher time frames will tell us where price is going to go. And then eventually it starts to go down, but like on the 1 hour, it was much, much cleaner. On the 30-minute, it was a little bit dirty. On the 15-minute, it was just like pretty garbage, it was pretty hard. Let's take a next example right over here. Right. So when we're looking at this 1 hour candle, we're expecting the next 1 hour candle to continue moving down, just like all the other examples we've been doing. And the 30-minute as well, but it seems like it's kind of like rejecting. We don't know, we're not sure, because now on the 15-minute, you can see the candle is closing bullish. On the 15-minute, if the candle is closing bullish, it may seem that it may start to go up, because now it's giving us some weak confirmation. So let's say what happens on the 1 hour time frame. So the 1 hour candle closes bullish here as well, right? So if we drop it down to the 30-minute, on the 30-minute, 30-minute actually went down. So take a look at this. 30-minute went down to create a low, which was the low on the 1 hour. And then the next 1 hour, it broke the previous 30-minute high and it continued moving bullish. If you look on the 15-minute, 15-minute was just a mess, right? So this is a great exercise to break down the small time frames into higher time frames and noticing how you're going to anticipate different moves to happen. Let's take a look here. All right, perfect. Things are good. Things are working good. Let's just remove these things and let's go to the next. All right. We have the 1 hour candle that's closing bullish. We have the 30-minute candle here. Now the 30-minute candle, this one closed bullish with no wick on the top, but the next one went up, but it closed bearish with no wick at the bottom. So now there's a 50-50 chance whether the next 30-minute candle will go up or it's going to go down, right? Because the candle closed with no wick. Looking at the 15 minute, maybe it created a support, it went up, it created a resistance, and then it started to reject that area. So now we want to look at the 1 hour and see what's going on. Now on the 1 hour, the best possible scenario could be that it may respect the previous low and continue moving up to fill this wick, right? Which it happened. But it didn't make sense on the 30 minute because the 30-minute candle closed like a bearish candle, like it gets pretty hard. So the 30-minute actually did go up, and the next 30-minute just closed like a doji-ish bearish candle. So looking at the 15-minute, I think 15-minute provided some sort of information, but it was still risky because it's a smaller time frame. So basically, we did create a support over here, and then we continued moving up. But I think this will be based on a lot of, I'd say, experience. Yeah, it's going to be based on a lot of experience here. Right? So on the 1 hour, it made sense. It was clear. 30-minute was a little dirty. 15-minute, it took a lot of candles to form. So it was kind of like difficult here. Could you have entered a trade on 30-minute when it broke the high over here? Yeah, I could have entered a trade right over here, but then I have to see how big my stop would have been. If it would have been a bigger stop, then I would have probably did it. All right. We have candles moving bearish right over here. So, uh-oh, I think we lost a stream here. Let me get this back. And it is right here. And we're still recording. Perfect. So now you have the 1 hour candles that are closing bearish, right? So now when you're looking at this 1 hour candle, it makes sense that it might continue going bearish. So let's see what happens here. Ooh, wow. It closed like a bullish candle, right? It closed like a bullish candle, making a lower high, but essentially also creating a support, right? Let's see what the next one does. Ooh, see the 30-minute? 30-minute is still now 30 minutes creating a support, but the volume of the bullish candles is pretty low. So looking at the next 15 minute, 15-minute just started ranging it. So see how on the 15-minute, it's a lot of information, but it's a lot of range happening there too. But on the 30-minute creating support, this is also a support, so we're not sure what's going to happen here. So the next 1 hour comes down. So now we want to break it down into the 30-minute time frame and see that how you could have caught this move, right? Maybe a position under this wick, who knows? But there was no retest. So let's take a look at the 15-minute here. 15-minute also, because like price did move up, price did move down. Sorry, the candles had no wicks at the bottom, but price still continued to move down, right? So this is an example where when you see candle closing bearish with no wick at the bottom, you're like, well, there's a 50-50 chance price may continue up or down. So this is the battle you have to fight. Now you have to say that, okay, do I want to enter at this point, or do I want to wait because candle closed with no wick, or do I want to be safe? Being safe in trades is very important. Let's move on towards we have the next topic of this. So this was the breakdown of smaller time frames into like higher time frames. Like we were breaking down the higher time frame into small time frames. So now what we're going to do is we're going to move on to another topic called candle trends, and then we're going to take a little bit of break here again. All right, candle trends. This is where we talk about how to take trades, what to look for. Ooh, someone is saying they can still see Ted's screen. Really? Oh no, it's fine. Okay, All right, it's good. That's good. Okay. Candle trends. Candle trends are mostly noticeable in trending markets. It's obviously right. Whenever you're looking at the charts, you're only looking at to see that okay, um, is the market trending or not? So candle trends are most noticeable in a trending market. What this basically means is that a candle trend will either start from a support or a resistance. Either candles are going to start moving bullish from supports or they'll start moving bearish from resistances. Best form of confirmation is on the 30-minute and higher time frames. Guys, tattoo this on your hand, forehead, write it down, a sticky note, paste it on the computer, whatever. But the best form of confirmation is on the 30-minute time frames and higher. You know, if the trend is bearish or there is a confirmation at retest, candles will make lower lows and lower highs. Whenever price reaches a resistance and you have a candle closing bearish, there's a very high chance candles will make lower lows and lower highs. In the same way, if the trend is bullish or there's a confirmation at support, candles will make higher highs and higher lows. This is extremely important concept. Extremely important concept, right? So candle trends, every trade from here on that you will focus on is going to be based on a trending candles. When candles are making higher highs and higher lows, or when candles are making lower highs and lower lows, there will be no instant where you will be taking a trade when candles are consolidating. It just makes no sense because we're here to make money, and for you to put yourself in the best position to make money or win trades is to focus on candles trending. This is really important. So this is an example of a trending candle, right? You have bearish candle, let's say it's at resistance, and now you want the next one to make a lower high and a lower low. So this is your trading candle, right? Some people say that, hey, we're gonna wait for this confirmation. Man, this is your confirmation right here. This candle closing is your confirmation right here. If this is on a 30-minute or a 1 hour time frame, this is your confirmation saying that there's a very high chance for the next candle to continue moving bearish, right? In the same way, when we're talking about bullish candles, this is what we're talking about right here. Now, when candles is closing bullish, this is maybe let's say this is your support after like a bearish candle. This is your confirmation. Now, this means if this happens on the 30-minute or the 1 hour, you know that there's a very high chance that the next candle is going to go bullish, and that will be your trading candle, right? That will be your trading candle. For candles not to trend, we look at something like this. If you see that this candle is bearish, you want the next candle to also go bearish, right? But let's say if you put your stop up over here, next candle goes bullish, it stops you out. Oh well, that's okay because you managed your risk. This is why having a stop loss is really important. If you don't use stop losses and if you let trades run, man, they will go in a drawdown and you will not feel good. Trust me on that. I've been there and it's not a good feeling at all. In the same way, when we're looking at candles going bullish, you want the next candle to form a higher high and a higher low. But sometimes the probability is not in your favor, and that's totally okay. Sometimes, guys take it very personal. They're like, hey, man, I had a buy and I expected candle to make a higher highs and higher lows, and how come it went bearish and stopped me out? It is what it is. It's a probability game. There's a very high probability price will continue moving bullish, and there's a low probability price will go bearish. And sometimes you're going to be at the end of the low probability stick. You will get stopped out, and that's going to happen less time you will get stopped out. So the only thing you can control at that point is your risk. Like, what sort of a risk are you using today? Um, so let's continue on over here. And so when candles are trending, this is like take a picture of this, write it down somewhere. This is this is simple concept, but it's really important. When candles are trending, they must respect the highs in a bearish trend. They must respect the lows in a bullish trend. And what I mean by this is the candles themselves, they should respect the highs and the lows. I have a question here. What if you get a bullish candle closed at support, okay, but the 4 hour is bearish and the daily is bearish? Do you still take the trade? No. You look for what the lower time frame candle is saying. If the 4 hour candle is closing at support, you can't take a sell because it's at support. You can't take a buy because candle is bearish. Make sense? You either want that support to be broken and make a low and then take a trade, or you want, yeah, so we're going to go over those examples here now. Man, you guys need to relax with the questions. I'm pretty sure some questions you had which I didn't answer, they were answered in the last slides. So we're gonna answer everything, man. Don't worry, don't worry. All right, awesome. So So every chart that we're going to look at here is either going to be a 4 hour chart or it's going to be a 1 hour chart, right? So the confirmations are going to be based on the 4 hour or the 1 hour chart. So basically, what's happening right now here, right? First of all, what we see is that trend is bearish, right? Trend is bearish, but at the same time, we are creating some sort of a support down here, and it looks like we have a bullish candle, so it may be forming another support right over here, right? Now, I want some interaction here. Now, when we're looking at this candles, is this a good time to buy right now? People are saying no. Okay, the stop is going to be too big. This is not a good time to buy right now. But if because the only reason is that price is moving bullish, we need prices moving. Let's see here. So basically, what's happening is price is moving like this. You need a retracement to happen right over here, so you can take a buy and then price can go up. But the most important thing is that there is clean traffic to the left. You see this candle closed above these candles, and you have clean traffic till over here. So maybe this is going to be an area where price might head off to, if it was to go up. So let's see if we get some confirmations here. We have a candle closing like a small bullish candle like this, right? Let's see what the next candle does. Next candle is closing like a bearish candle like this. There's still no trade, there's no confirmation. And now we have a candle closing like this, right? So would this be a good position to take a buy? And even if some people would say, okay, the range is small. Some people would say I might take a buy, but the range is small. So let's talk about biases, right? What's the probability that price is going to go up rather than down? The probability is really, really high that price is going to go up. So when you're starting as a new trader, right, you're basically paper trading, right? You're just looking to see that, okay, what's the probability of price going up or down? So this is when someone said that, hey, the higher time frame is bearish coming down, but the lower time frame is telling us that there's an opportunity for price to continue going up. So this is what we're saying. Someone said there's a 63.756% chance price will go up. So that's pretty good. Now the bias is bullish, right? Even though someone's taking trades, someone's not taking trades, someone is just anticipating. Honestly, when we have the New York sessions, more than half of the time, I'm just anticipating trades. I'm anticipating that price is going to move a certain way, right? So let's see what happens here. So if let's say you're taking a trade or you're anticipating a trade, it's very clear since what we've learned so far that the stop is going to be down over here, right? So let's see what happens here. Next candle goes up. Perfect. The bias was right. We waited for these candles to close and price went up. So now if we had our stop loss down over here, now we're moving our stop up over here, right? And then we look next and then we have a bearish candle forming like this, right? We have a bearish candle forming like this with no wick at the bottom. So when a candle is closing bearish with no wick at the bottom, this means there's no range for the next candle to go down, right? And it also doesn't it also seem like that it's doing some sort of a retest here in this zone, right? Like it's not exact zone, but it's like a ballpark zone there. So let's see what happens next here. It continues to go up, and it just starts ranging then. So maybe this move up was market open, this was volume push, and then market started to range. You see how you had volume, volume, then range, then volume, then kind of like range here, then volume and range. This is how price moves. Price will move with volume, and then there's going to be some sort of a range. Whenever there's a range, you will see some sort of confirmation within that range that okay, we might start moving up now. So when price was ranging over here, this was your confirmation that okay, we might start moving up. Some took the trade, some took a paper trade, some waited. Why did the top of the wicks not put you off, please? Oh, we didn't take a trade. This was just anticipating. Every example that we're going to do here, we're just anticipating trades, right? Step one to being profitable is to anticipate trades. When you can anticipate trades long enough, then you start executing on those trades because your confidence is up. Because now so, for example, I've been looking at US 30 for about a month now, right? I've been anticipating moves on US 30, and I think from June I'm going to start executing on US 30. So that's important. Why isn't first pullback after bottom of page a retest? What? Why isn't first pull back after bottom of page a retest? I don't understand. I don't understand what that question means. So maybe this was a retest here. Like we're just anticipating trades. We're just anticipating. So just to keep it simple, we're just seeing if price is going to go up or down just so that we know if we are right or wrong. All right, let's go to the next example here. Okay, so what's happening at this point? What's the number one thing we see? We see prices ranging. Someone said dog shit. That's also good. Um, but first of all, what we see is this candle, then we see this candle, and then we see this candle, right? So looking at these three candles, can't we see that a support has been formed? Yeah, support has been formed, right? So we have a support formed right over here, support formed. And then we have some sort of a resistance forming over here too. So at this point, we cannot take a trade because, I mean, it's just very hard to take a trade, because we're in a small range. But also it's rejecting down here, so we need some confirmations. Now we have a candle going up into this level. It's at a minor resistance. We can't take a buy because it's at a minor resistance. We can't take a sell because candle is bullish, right? So now we have another candle looking like this, and now we have another candle looking like this, and then we have a candle closing above this area, right? So let's say, for example, now we have this range here. Let's say this range was 50 pips. Would this be a good opportunity to take a buy? Someone said, hell yeah, you know but if this range was 20 pips, then it would be very difficult to take a buy because someone would say, okay, hey, since we don't have prices to the left, so we don't know how big the range is. But hypothetically speaking, if this was a small range, we would anticipate price going up, but we wouldn't take a buy. If this was a bigger range, a 50 pip range, then someone could say, okay, well, we this was a minor resistance, price respected here, price rejected. This candle closed above all the candles to the left, and we have ample range over here, so this could be a better opportunity to take a buy. Yeah, so if this was a bigger range, what time is it? We don't know what time is it. So every example which we're going to look at here, it's going to be a time when there's volume in the market, right? It could be New York Open, London Open, Asian Open. There's going to be volume in the market, right? So let's see here. So yeah, perfect. Next candle went up. This was perfect because this candle closed above the highs, and if you had a stop so far by now, I expect everybody to know where your stop loss is going to be. It's going to, if you're looking for buys, it's going to be below a bullish candle. What some people do is they put the stop right at the wick. That's wrong. The reason why it's wrong is because the spread can take you out. If price comes down, the spread can take you out. So always have it a couple pips below the candle. Yes. So let's see what happens to the next candle here. And oh yeah, next continues to move up. So if you are trailing your stops, right? Let's say you had the stop down over here, then you moved your stop below the low of the candle because you're a smart trader and you're trailing your stops below the lows of the candles if you're in buys, and then since you're doing that, the next candle just shoots up and you're like, oh, perfect, I had a nice trade here which broke out. A dynamic entry, possibly at bottom of range, maybe advanced entry. Yes. So far, if you are new, I don't expect you guys to use dynamic trades, dynamic risk, none of that. I expect everyone to use simple, simple basic static risk. Krish said the right thing. Let the runner run. Perfect. So you put stops at break even. Once price came up here, you took profits because it's at resistance. We don't know. So whenever price reaches a resistance and you're in a trade, write this down, please. Whenever price reaches a resistance and we're in a trade, we don't know whether price is going to break it or not. We don't know that. So it's always good practice to secure profits. If you want to leave a runner, put a runner at break even, and if it continues on, that runner is going to be your golden trade. At the same time, if price reaches a support and you're in a sell, we don't know if it's going to break support or not. We need to secure profits. Can we place more risk there, or is it a bad idea reaching a resistance? It's a very bad idea reaching a resistance and taking a trade. Don't do that. We don't do that. If you are new, then you do that, but it's the best practice not to do that. We already talked about this. When price is moving up, we don't take buys. We wait for price to come down or create like a support or whatever, and then we take a buy. So, how long is this webinar going to be, Raja? I think we're going to go for another hour. So, if you want to leave, that's fine. It's going to be recorded anyway. I'm going to place it in the drive maybe by tonight or tomorrow morning. All right, let's take a look at next example here. Awesome. So, what's what's the bias here? When you look at this, what's the bias? Everyone's saying bearish, is saying downtrend, right? So when we have a downtrend, we wait for some sort of a resistance to be forming, right? So the first things first. First thing is we see prices dropping. So if price is dropping, you don't want to take a sell here. The number one mistake people make is when price is dropping, they take sells. You want some sort of you want some sort of a retracement to happen, and then you want to take a sell. So first things first. First thing is we need to identify our zone. The first zone is going to be maybe right over here, right? Because price broke down, created a resistance, and then it went down. So whenever price is falling down, also write this down too. Whenever price is falling down, it's falling down from a resistance. So you need to mark a resistance. Whenever price is moving up, it's moving up from a support. So in the same way, we have a support right over here because price is moving up. From here, price is moving down, so we have a resistance right over here. So let's see what happens here next. Price is moving down. There's no trade. We don't know what's going to happen, right? So we're still waiting here. Now we have a candle forming like this, like a doji candle. There's no trade. Since what we've learned so far, there's no trade right now. Now we have a candle moving bullish, right? Now, can we take a buy or a sell? I don't thing, so it's going to get pretty difficult because you have a range right over there. So we have to wait a little bit. Um, okay, we have a candle moving up now, so we just it moved up, so we were looking for sell, so we're still waiting here a little bit. Price is still moving bullish. Now notice how price broke above this area and it came up to this previous support, right? It came up to this previous support, it created a low. Also, another thing to note is whenever price is trending down, it will create a low. Whenever a low is formed, there's going to be a retracement, and then there's going to be a very high probability that price will retest that low. Whenever price will retest that low, that's the trade I'm willing to trade. That's the confirmation I'm willing to take. So when we look at the next candle, let's see what happens here. Next, we have a resistance forming, right? So now there will be two groups of people. One group will say, sell it, then another group will say wait for some sort of a confirmation. This is your confirmation. This is if this is a 1 hour time frame or if this is a 30-minute time frame, this is the confirmation you're looking for. Because when the next you need to understand this, guys. Whenever candles are moving with billions of dollars. Every pip moved in a candle is billions and billions of dollars. We're just trading a candle. We're scratching the surface. So if you're trying to take a sell over here, everybody know by now that your stop is going to be above the bearish candle and you're anticipating the next candle to respect that high and continue moving bearish like this. And at this point you're probably securing profits or you're putting stops at break even, but ultimately you want price to continue down to retest this low, right? So if you look at there, price does come down and we start moving further down. So when price came down to this support, this is where you are securing. You're securing right over here, right? Because we don't know whether price is going to continue moving down or not. So that's why you're leaving a runner running. You're trailing your stops and you're leaving a runner running. You're leaving a portion of your position run, so to speak, that okay, if that position keeps on running, I want the most out of that. So then like it starts moving down. You're like, oh, perfect, my runner kept on running, so I had a good trade. Why the price went down instead of moving up? I don't know if that's a serious question or not, but I think that's not a serious question. I hope that's not a serious question. So would this be valid enough confirmation on 30-minute time frame? Yes. Yes, based on what I've seen, based on what I've traded, whenever that happens, there's a very high chance that this will continue on. So the reason why price moved bearish was we don't know where price is going to go. To be honest, we don't know that. All what we do know is that a resistance has been formed, so there's a very high probability that price will go down. We don't know why it's going to go down. We just know based on probability that it should go down. Man, it could have gone up too. Look at this. It could have gone up. Like the next candle could have gone up. Let's say after this one, right? If we had this candle, man, the next candle could have gone up. Where's my candle, man? Come on, Zoom, cooperate with me here. Next candle could have gone like this, but for this to happen, there's a low probability for this to happen. We just go off of based off a higher time frame. Like, what's the highest probability? So when you had that candle close, you're like, okay, there's a higher probability that the next candle is going to go down, and we execute based on probabilities. Raja, each time a candle is formed, we move the stop loss of the runner, correct? Yes. Yes, exactly. So, all right, let's take a look at the next example here, because every day is not sunshine and rainbows. Um, all right. Now, we have this scenario right over here, right? What's it's I think this is a harder example than the previous ones. Yeah, it's very hard. It's very hard. The first thing you see is that candles are moving bearish, right? That's the first thing you see, candles are moving bearish, which means that we have some sort of a resistance forming here, and then we have some sort of a support forming down over here, and it seems like it's kind of like ranging on whatever, but it seems very difficult to trade here. So let's see what happens in the next. So these are all 30-minute and 1 hour time frame examples. So next candle starts moving down. It's moving. It's coming down to this minor support. We don't know what's going to happen here, so we're probably just going to wait here a little bit. The next candle starts moving bearish. Could we take a sell? I don't think so because range is not enough. I mean, it's just very tricky, very tricky. If someone does take a sell, then you would want price to respect the high of the previous candle and then continue moving down. That's what would you would want. But since it's in this area over here, it just looks very dirty, very tricky. It doesn't look good at all. Um, Someone's saying buy it. We listen. When you say buy without a candle closing bullish, that tells me you're not taking any notes. So you have to wait for candles to close in your direction. Listen, if you guys don't wait for candles to close in your direction, you're going to be in the same spot you've been since you started trading. We are here to make a change, and you need to make a change in your mentality first. You need to wait for candles to close in your direction and then take trades. You need to make a change to see a change. That's how it's going to work. If you don't make a change, you're never going to see a change. I know a lot of people who are in my group, and basically, I know people who started when I started with TED, and they're in the same position they were since they started because they're not patient enough. They don't wait for candles to close. They just they overtrade, they over risk. They're in the same position they were since they started. Me, I've progressed. I know a couple of other guys. They've progressed a lot too. So you have to wait. Waiting, man, you get paid to wait. See, so if you would have taken a sell over here, would have gotten stopped out. It would have been very tough. So the next candle closed like this. Next candle is closing like this, and it's approaching this minor support formed here. Now it gets very difficult to trade. We don't know what's going to happen. And the next candle starts going down, reaches a support, and the one after that breaks down, and it's just a mess. So this in this example there was no trade. It was very hard to trade. I'm a new trader, but knowing myself, I would have taken a sell on the third last candle because it broke the low, did not break the high, and closed bearish with stops above the previous resistance. Right or wrong? I think that's a right idea. That would have been the right idea, but then there was a lot of learning involved too. Whenever you take a trade and you lose a trade, you're always learning something. If you would have taken a sell after this candle, it could have worked. This could have worked, and then if someone they could have taken a sell over here, anticipating price to move down, then it could not have worked. So you want a clean range. The reason why this did not look good was because there was a minor support over here. We didn't know what's going to happen, and there was support down over here, so it was obvious. This wasn't an easy example, so to speak. How many candle you want to confirm resistance? Just one. All right, so um what's happening here now? What's the bias over here? Bearish. Okay, someone is saying bearish. Paid to wait. Bearish down. Okay, so if we were to take a sell, okay, so would this be the great idea to take a sell right now? No, someone's saying no, bad idea. Bearish, bearish, bearish. Let's see what happens here. See, this would have been a okay idea to take a sell because we had a wick to fill right over here, and we had a retracement done, support formed right over here, and we had this candle close below the candles here to the left hand side. This could have been a nice idea to take a trade, but if you notice the next candle just wicked all the way down, filled the wick, and then continued moving up, right? So if that trade was missed, now we don't know when to take a trade. Now we're just waiting. Now it's just pretty hard to take a trade because now we're starting to go up and we're coming into this resistance area now. So let's assume we missed that trade, and now if we are creating a support over here, what's going to be the probability? Now since price is, let me just remove this here. So since we are creating a support down here, what's the probability for price to continue to go up? It's high. Someone said she's going up 100%. Perfect. So if price is going to go up, right? If price is going to go bullish, we need to see clean candles, right? So we see that, okay, we're closing above this minor resistance, right? And there's a high chance for price to come up to this area and to potentially fill the gap, right? So if that's going to happen, where would our stop loss be? So everybody knows our stop is going to be below this candle, and then we're targeting an area going up right over here. Even though if we're not taking the trade, we're anticipating price to go up. We're anticipating that. So that's what we're going to do here. So let's just start to see what happens next. Price goes up, respects the previous low, makes a higher low and a higher high, and the next one continues up and it reaches the gap area, right? It reaches the gap area just perfectly. So if we see this was the gap, price came up and rejected it. Now let me ask you this. Let me ask you this. Um, what's the probability that price will break up or go down? Do we think that price will, yeah, 50-50, right? Because we don't know. Gaps happen at very important zones. So maybe that's a very important zone. That's where the gap happened. So maybe the next candle is, now we don't know if it's going to reject it or it's going to continue to go through it. So this is where you have your runners running, you're securing profits, you're doing all sorts of those things, right? So next candle forms like this. If you were still in a trade, right? If you were still in a trade, would you close your buys at this point or you will leave them open? Close the buys. Yeah, perfect, man. You guys are learning. This is awesome. Close the buys, stops at break even, whatever you want to do, and then eventually, price started to come down and just started to do its ranging thing. See how now it just started to range. So this was the perfect move up, going up, because we had clean candles here to the left. So it's pretty good. Pretty good. Nice feedback. I like it. All right, let's move on to the next example here. Now we have trading the trend, right? So trading the trend, it's kind of like it's kind of like what's it called? Trading the trend is kind of like candle trends, but it's like you're identifying the trend. Like all the examples that we're going to go on are going to be almost the same. They're going to be repetitive examples, repetitive scenarios, because believe it or not, all these scenarios, they happen all the time. They happen every day in the charts. If you're looking at like the New York session, Asian, London, you're looking at any pair, it happens all the time. So repetition is going to really help you see these things thoroughly in the charts, and it's going to really help you. These happens on the 4-hour time frame, daily, weekly, monthly, 1 hour, 30-minute, 15-minute, kind of meh, but like normally it does happen. So let me just make sure. All right, perfect. So you start calling a zone when you see 2 wicks there? Yes. 2 wicks basically mean when candles are rejecting. So we're going to talk about that here now. Okay, a trend is identified through the time frame you are looking at, right? This means is This means is like, let's say if you're looking at the daily time frame and you're like, oh man, okay, so it seems like the daily time frame is bullish. So if the daily time frame is bullish, and if you go down to the smaller time frame, let's say the 1 hour or the 4 hour, and you might see that the 1 hour might be bearish. 1 hour might be starting to go down. And when you're looking at the 1 hour, you're like, well, the daily is bullish candle, but man, the 1 hour is bearish, so might want to look for sells. It would just make sense to look for sells because a trend is identified through the time frame you are looking in. Very important. A daily time frame trend might be bullish, but the lower time frame 1 hour and 4 hour might be bearish. This is why when we're streaming New York session in YouTube, guys say, hey, why are you selling when the daily is bullish? Because in the meantime, we see sells happening. So it's very important. It's a good habit to recognize supports or resistances formed on 30-minute and 1 hour time frames to gauge where price will move next. Whenever you're identifying a support on the 30-minute, you're gauging, okay, price will move bullish. If you're identifying support, or let's say if you're identifying resistance on the 1 hour, then you're gauging, okay, price may move bearish. It's a very simple concept. The only problem is that people don't wait for candles to close in their direction, or they don't wait for confirmations long enough. That's the only problem. And when you lose a trade, you start over trading. Like you ever seen a hamster running in the wheel and it starts moving fast and fast and fast? When you lose a trade, that's how your brain starts working. You're like, oh shit, I lost a trade. Now I gotta take another trade. You take another trade, you take losses. Now you want to make back those losses. When you try to make your losses back, it doesn't work. Your whole shit is going to fall apart. It doesn't work like that. So you need to take 1 or 2 trades and continue on. So let's see here. Best way to identify a trend is to see if price is making a high or if price is making a low, right? This is very important. Whenever price is making a high, this means price is in an uptrend and you're waiting for a support to be formed to continue moving up. Whenever price is making a low, that means price is in a downtrend and you're waiting for price to create a resistance to continue price moving down, right? Very simple concept. Whenever price makes a high or a low, there's an 80% chance it will always get retested. I have done this for the last 2 years, and if I've taken like 100 trades, I've maybe lost 25. If I'm going to say I'm a bad trader, I'm going to say I lost, let's say, 30 trades. You know, it will always retest the high. I've made thousands of dollars just by focusing on this simple concept, and that's how the market moves. I mean, if you want to know how market moves in trends. Either it's going to trend up or down, or it's going to consolidate. When price is going to trend up, it's going to make a low and then it's going to retest the high. If price is going to move down, it's going to make a resistance and then it's going to retest the low. That's how the market moves, and that's how candles move, and that's that's how money is generated. So these are very simple concepts. So let's see what we have here. Let's see what Rakil made. Oh yeah, so this is also called the break and retest too, right? So let's say we have a support, right? We have a support and price, no, actually, let's say we have a resistance here and price is moving up. Price is moving up to a resistance and someone says, oh, I'm going to take a sell over here because we're at resistance. I've done this. Price moves up higher. You're like, oh shit, price is moving up higher. Okay, let me take another sell over here because it has to go down. So what's happening at this point is, at this point you are in like a drawdown, right? So you're like, okay, let's wait. And now price moves up a little higher more, and now you're in an even more drawdown. You see what happened here? You took a sell here because price moved at resistance. So you're like, okay, I'm very smart. I'm going to take a sell early. I will not wait for a candle to flip. And you took a sell, and now you're slowly getting fucked. And now it just goes in deeper, And now you're like, oh shit, now we're getting margin called, So now, if you're looking at it from a very logical perspective, right? If you're looking at a logical perspective, you're looking to see that, okay, price is at resistance. I want to take a sell, but I want a bearish candle to close. And if I'm not getting a bearish candle closing here, I'm going to wait a little bit. And you wait. No bearish candle here. You're waiting. No bearish candle. And what you see is, man, hey, wait a minute. We're breaking out of this resistance. If we're breaking out of this resistance, there's going to be a retest. And then there's going to be a support formed. And then I can take a buy because now what's happening is price made a high over here, right? It broke resistance, price made a high. Now this is a very generic concept and we're going to go over examples too, right? So now price is coming down back at this resistance turn support. It hasn't formed support yet, you know. Um, Now the support has been formed. When you see on the 30-minute or the 1 hour a candle is closing bullish, you know a support has been formed, and now you can say that okay, price made a high, came down, formed a support, there's a very high chance price is going to retest that high. And now I want to take a buy, but I want to understand where my stop loss is going to be. The stop loss is going to be below the bullish candle, and you're expecting the next candle to continue moving bullish to retest the high. Very simple concept on trading the trend. You know, you're waiting for supports to form, for price to retest the high. If you have a runner running, that runner may continue moving up, and then you can post it on Instagram and say, "Hey guys, look at this magical this trade I took," and everyone will say, "Oh wow, man, you're so amazing! Wow, how'd you do this? Teach us." You know, so the main thing is you're just waiting for candles, right? So now, in the same way, when you have when this uptrend going to be valid till? When the uptrend is going to be valid till? We don't know. We don't know that. All we know is that we are securing profits and we're letting a runner run. We don't know when the next candle is going to go down. We don't know that. No one knows that. If God trades Forex, I doubt if God even knows what market's going to do. It's just very hard. We don't know when the uptrend is going to end. We don't know where the downtrend is going to end. All we know is that we can just secure profits. We know we can leave runners and we can just call it a day. You know, sometimes, sometimes when I close my buys, I see that price continues moving, right? And when price continues moving, then I'm like, well, it is what it is. I secured my profits and I had my runner. If my runner ran, perfect. If my runner didn't run, then that's okay, whatever. Now in the same way, when price is moving bearish, it's coming down to support, it's breaking support, it's creating a low, right? It's creating a low, and then a low is formed when you have a candle closing bullish because now it's formed a support. It's formed a low in a downtrend. And now you have candles going up back to retest. You don't want to sell over here because you want candles to close in your direction first. You don't want to sell over here either. You want candles to close in your direction first. When the candle closes bearish, this is where you are looking to take sells. You're waiting. If this is a 30-minute time frame, you're waiting 30 minutes, man. You're waiting 1 hour, you're waiting 30 minutes, you're waiting for that candle to form the way you want it to form. Because once the candle forms like this, there's going to be a very high probability that the candles are going to continue moving where you want it to move. Right? These concepts, they may be simple, but they are very, very important. Extremely important. And now, then price starts moving down and you're like, oh, perfect, we're having a winning trade. This is all good, because price is making lower highs and lower lows. So what we're going to do now is we're going to look at some examples here. Um, let's see. Let me see if this is still recording. It's still recording. We're in 4 hours and 30 minutes. Ooh, perfect. All right, trading the trend. What do we see here? What type of a bias do we have here? Bearish trend. Someone said bearish trend. Price made a low. Perfect. Someone said price made a low, formed support. That's perfect. Excellent. Now let's see. Now, the other thing we see here is that we know that maybe price has formed a support. There was another thing that was broken here, right? So we're going to keep that in mind. So we're going to see how the next candles form here and see what's going on. Oh, price is starting to continue going up. Price is still moving bullish. We're still waiting for, ooh, price is still moving bullish up over here. It's coming up to the next resistance here. We have a candle closing bearish like this. Would this be a good indication to sell? Why not? Oh, someone's saying not for me. Someone's saying yes. Someone's saying not for me. See now, this is where anticipation comes with taking a trade, right? Someone's saying it's a weak body, it's a weak body, seems like a rejection too. So this is where you want to know that okay, whether I want to take a trade here or whether I want to just anticipate it. But like let's see what happens with the next candle here. Ooh, next candle closes like this. What's happening here now? See, this wasn't a good idea to trade. You guys are smart. Someone said, hey, we're going to wait because next candle broke the high of the previous one and it closed like this. So someone was waiting here, right? The next candle closed bearish and now, like the overall bias was sells, right? Overall bias was sells. So the anticipation is also very, very important when you're looking at trading, right? So overall buys or sell. Next time it starts to continue down. Some people took sells here, and overall, it kind of worked out well because price was bearish, came down, made a low, went up. This candle was not a good confirmation. This candle was okay confirmation. This candle was really good confirmation, provided that this range was big enough. All right, let's move on to the next one here. Okay, so what's going on over here? Seems like candle is bearish, right? When candles are bearish, they go bearish from a resistance. So we have a resistance here. Candle came down, wicked, and if we look left, it kind of wicked over here, right? It kind of wicked over here. So basically, we have mainly a range, right? We have a range, and this range is this big. This big range. Now, someone can say, oh, well, what about this range right over here? This range, I don't think this range will count a lot because if that range was to, if that range was to affect price, it would have affected, this candle as it was coming down. But this candle just ignored that range and continued down. So now we have a clean candle here. Does this make sense? Now we have a clean, very clean candle here. So what we're going to do is we're going to probably just wait to see what happens here. And, if we see something, we're going to take a trade here. So let's see here. We have a candle going bearish. We can't take a sell because support is there. We can't take a buy because, candles are bearish. Oh, we have a bullish candle forming a support. If this is a 30-minute time frame or a 15-minute time frame, no, a 1 hour time frame, what's the probability of price moving up? Someone might say we don't want to take a trade, but right now, even if you're not taking a trade, we're just saying what's the probability of it moving up. Because once you start looking into probabilities, then you start executing slowly, slowly. Then your execution comes in. So the probability is much higher to go up than to go down. When I was starting to figure this out, I was trying to trade with lower risk because I wasn't sure, but I knew it would go up. So if we execute it with a lower risk, we know the stop is going to be right down over here, and we're going to take a buy. Someone's going to take a buy. Someone's going to wait around. So next candle, ooh, see that? Look at that. That's why we placed the stop loss a couple pips below the candle. But the candle hasn't closed above the previous candle's price. We're not looking at that. It did close. This candle, the bullish candle, this one, this bullish candle did close above this candle, right? It did close above this candle. That's what we're looking at. So let's see next candle. Perfect. Went bullish. Because candle break the low of the previous candle, that's the reason to take a buy. No, it broke the high of the previous candle. That's why it took the buy. you know. So the stops were kept a couple pips below the candle. It's very simple, very simple concepts. Very simple concepts. Like the candles were coming. Let's see here. Things are getting slower here on my computer. Candles coming bearish. This candle closed bullish, closed above the high of the previous candle. What we've learned so far in the last 4 hours is that when you have candles closing bullish like this at support on the 30 or the 1 hour, there's a higher chance for the next candle to continue moving bullish, so that's why we had the bullish run there. So let's see what happens here. The next candle prints bearish. So if you were in a buys, this is where you're getting out of the buys. you know this is where you're getting out of the buys. And now it's starting to, oh yeah, see, now it's just arranging and just terrible. Oh, it eventually started to move down. Yeah. So this was a good buy here, buying opportunity here. This was very good. This kind of got tricky because you see how these candles came down and then they formed support, right? Formed support to maybe continue going up, but it didn't go up. I mean, when this now someone can argue that, hey, what if we had someone can argue that what if we had this area here and we had this candle closing bullish, right? If this candle was closing bullish, there was the potential set on that rejection on the resistance. Yes, if this candle was closing bullish above resistance, someone could say, okay, well, we can take a buy over here, keeping a stop below this candle and expect the next candle to go up. But if the next candle closes bearish like this, then you're taking 50% positions off, your closing percentage off, because you expected it to go bullish, but it closed bearish. So now you're taking some positions off. Um, yeah, perfect. Perfecto. Let's move on to the next example here. Let's see what we have in stock. Ooh, continue moving down. All right. So that buy was in the middle of the range. Yes. Yes, that buy was in the middle of a range. So let's say we have this scenario here. So right now we're ranging. It's very easy to spot the range, and the reason why is because we have support over here, and then we have resistance over here, right? So we wait. You know, even though let's say the daily trend is bearish, but looking at the 1 hour or the 30-minute or the 4 hour, we see a range. So we're just sitting back, just like Raja. You see Raja sit back, so you just sitting back. Buy stops, sell stops. We're not going to talk about buy stops and sell stops right now because I don't want to overload people with a lot of information. Over the next 3-4 weeks, I'm going to introduce some more webinars over the weekends to introduce, buy stops and sell stops, to slowly, gradually introduce information. So that's why we're only keeping it very, very basic right now, the way how I trade. And then we're going to continue on. So, okay, so we have a candle going bearish. We can't take a sell because there's support right there. We have a candle closing like this. We don't know what's going on. We have a candle closing bullish. We're at resistance. We're not sure what's going on. We have a next candle closing bearish. It's still arranging. So mind you, if these are 30-minute candles, you are waiting 30 minutes. You are waiting 30 minutes. You're watching candles form because you're watching this candle go bearish below support. You're waiting for it to close. Some people are taking sells over here only to get wicked out. This has happened to me before. Once candle goes below support, I take a sell and it comes right back in. I'm like, oh man, what the hell? I took a perfect entry, but in the opposite direction. So just waiting here. Oh, perfect. We have a breakout. Now what do we do? We have a breakout right now. All right, we're waiting. We're waiting for support. Wait for retest. We're waiting. Perfect. We're waiting. We have a breakout. Price made a high. So we're waiting. Oh, we have a candle going bearish now. Perfect. This is what we want. We want candle to come down to support this area, create a support, and then go up. We have a candle closing like this. Oh, wow. We have a candle coming right down over here. Now what's going on? Oh, we have a candle closing bullish at this area where it broke. Someone is saying caps lock buys. So, so now this is a support formed. Now this is support formed. You're keeping the stops below the candle, couple pips below the candle. If someone's not trading right now, you are anticipating, you're visualizing the next candle to go up. Guys, listen, visualizing is the most important part of trading. You're v- I the way I the way I got good, I started visualizing the 1 hour candles. I said to myself that okay, if I want winning trades, I want to visualize candles moving bullish. I want to visualize them. So I'm visualizing a candle going bullish, and that's going to be the trade. Oh, wow, didn't expect it to go up this high. But there we go. We had the buying trade. You're putting stops over. See how notice how this candle didn't have a wick at the bottom at all. There's no wick there at all, which means there's no bearish pressure at all. It's just straight savage bullish volume candle. The next one just did a retest here on this area. It start to move up. Just crazy. So this is where you get a Lambo. This is where you get, yeah. So you get paid to wait. You know, awesome. Let's move to the next example here. Let me just remove this. Man, I'm fasting. I'm fasting, man. Like no, nothing eaten or drinking. Fasting right now. So my brain is going. Whoop. All right, awesome. Let's go to the next slide here. Uh-oh. Oh, we're having a problem here. Oh, okay, there we go. Perfect. Okay, what's the bias here? What is the bias here? What's going on? Uptrend. Okay. The stops would be below the previous candle wick. Yes, yes, Jen, that's true. The stops are going to be below the previous candle wick. So we have an uptrend here with the resistance formed, right? This is what we know right now. We have an uptrend, a high has been formed, candles have been moving up, so we're kind of waiting right now. Perfect. High has been formed, candles are moving up, so now we're just waiting. We're basically just waiting. All right, so this candle formed bullish like this. Is this a good opportunity to take a buy? Some guys are saying no. Some guys are saying because it's a weak candle. Yep, that's true. That's true. We need some solid candle to back up our analysis. We need something solid to say that, hey, this we need something solid basically. Ooh, looks like we missed it. Damn, yeah, shit. Sometimes things like this happen. Sometimes you get these thick candles happen and now you're like, okay, let's just wait. So now you're just waiting. Now you have a candle closing like this, and you missed the trade. You're like, oh man, it is what it is. There's no FOMO, right? There's no FOMO. Can get FOMO whenever price this happens. It just happens. Can't really do anything about it. Oh, now what's going on? Now can we take a buy over here? Could we have caught this on the 15 minute? We're not talking about 15-minute right now. We're just talking about what's going on right now, right? So, okay, someone is saying we will take a buy. Someone is saying I'm gonna what's this? Could you have taken the buy when the price broke above the doji? Yes, Gurav. That's an advanced concept, so we're not going to discuss that right now. I have a separate webinar for that. So people are saying buy, support has been formed in an uptrend. Also, if we draw a zone, this is going to be kind of like a zone here, I think like this, because there was a resistance here, price went down, and then now we formed sort of like a support. So now we're anticipating next candle to go up. We're visualizing it, right? So obviously, so far we know that the stop is going to be below the candle and the buy is going to be taken. So whenever you're placing the stops below the wicks, you're anticipating price to continue up. Some people are saying the wick is too small up here, so I might want to wait, but at the same time, I do think price is going to go up. That's also good. In life, we have two groups. One group is aggressive group, the other group is conservative group. The aggressive group is saying we missed the trade and now we see an opportunity to take a buy, so we're going to take a buy. The conservative group is saying, well, we missed the trade, and since this candle is a smaller candle than we wanted, we still think it's going to go up, but we're not going to execute. It's okay, right? But the bias is still they're saying it's going to go up. So let's see what happens. Next candle, perfect, goes up. Because we're trading the trend. We waited for price to make a high. It came down, candle closed doji. This candle went up, missed the trade. Then this happened. We waited. Then this candle happened. We're like, okay, perfect, makes sense to take a buy. So some people took a buy. And some people who didn't take a buy, we still had our bias, and the bias was that it's going to continue going up. Even if you doubt a trade, always take a paper trade. Even if you doubt a trade, paper trade. I always take paper trades. So when I start the webinars for the New York session, and when I take my one or two trades first thing in the morning, and when the trades do happen after that, I'm always paper trading in my head. In my head, I'm always saying that okay, I'm going to paper trade this trade, and if it works out perfect, I'm going to use this information into the next day. So it's always good to, in your mind, paper trade, grab a piece of paper, write down, it worked. So that's always good. Having winning analysis and missing a trade is the same thing as winning a trade because you were not wrong, you were right. And then we had this candle and then came down, and yeah, it just started come down. Wow. Okay. All right. What's going on over here? Bearish bias with support formed. Downtrend. Wait on a bearish candle. Wait on a better trade that fits your plan. Downtrend. Okay, downtrend. So can we take a buy over here, or are we waiting for a resistance to be formed? Okay, retest or a buy? Are you waiting for a retest, or are we taking a buy? Wait for resistance. Because retest, exactly. Because trend is down. It's a downtrend. Someone said the fuck. Yeah. So it's a downtrend. When a trend is down, you're waiting for price to create some sort of a resistance and to retest the low because now a low has been formed. Did it gap down? Yeah, a little bit. I think it gapped down a little bit. Okay, so now we have a candle forming like this, right? What's happening here? We have a candle forming like this. Rejection, retest, resistance forming. you know let's see how the next candle forms, because realistically I don't like the way this candle has formed. It has a small body. It has a very small body. So kind of want to wait. The principle I want to apply to this scenario is going to be in a advanced webinar that I've already done for you guys. So later on you guys can watch that, but like later on, right? So okay, perfect. Now this seems like a good selling opportunity. Yeah, now we sell. Perfect. So now we put our stop loss, above this candle right here. And now we anticipate the next candle to continue down to retest the low, right? That's the higher probability. Okay, what's the probability it's going to go down? It's pretty high. Okay, yeah, it's pretty high. It's pretty high probability it's going to go down, right? So we won a lot of trades so far. Way better stop loss. Yeah, it's a way better stop loss right now. Oh, shit. Oh, someone said I don't like it. Yeah, see? So if we would have taken a sell here, got stopped out, right? We got stopped out because this is just a probability, probability of it not working out. In the past examples we've seen, it has worked out. But then this one times it may not work out the way you want it to, so when this happens, there's no rhyme and reason. You can't say, oh, what was the cause of this happens. When this happens and you had a higher probability of someone said they're still in a trade because they moved their stop loss. I don't know, man. I think you gotta get out of the trade. So you can't move stops. We're not in the business to move stops, right? Perfect. So when these things happen, you're like, it is what it is. You just kind of like, okay, whatever. All right, let's see what happens next here. Wow, price continued moving up. Bearish candle. Okay, so we formed a support here, and then we formed a resistance here. Now we can give our trade a second chance for selves. You know, we can give our trade a second chance. Higher lows and higher highs. No, we're not making higher highs and higher lows. We're making lower lows and lower highs. We're looking at what's happening now. Right now, what's happening is candle closed like this. This candle made a lower low, lower high, and a lower low. You have this clean candles here, right? So if this was a 50 pip range, this would have been a really good sell based off resistance formed. Remember what we talked about? We talked about whenever there is a resistance formed, you need to see a bearish candle forming here, right? And then it's going to continue down. Remember that at first we saw that the price was bearish. We were making support. We had to come up to come down to retest the low, but it didn't happen. You know, price did what it had to do, came up, created a resistance. Now it's the second chance. Now you're like, okay, maybe now price may continue moving down since we have clean traffic here to the left. You see this. And if this is a 50-40 pip range, there's a high chance price may continue down. Um, is not now a bullish momentum, so we should stop thinking about sells. Well, it's up. Someone can say, okay, it's in a bullish momentum, and we don't want to take sells. And someone can say, well, we're forming resistance, and candle has formed bearish, so price may continue moving down. So that comes into fact that okay, are you overthinking, or are you just executing on based on what you see? Right? So I think this was a little difficult, but people who saw resistance here forming and this kind of forming bearish, so this was confirmation for price to go down. Essentially, if you did have a bigger range here, then it made sense to take sells. But if this range was, let's say, 20 pips, then it would have made no sense to take sells, right? But if this was a 50 pip range, then you could say, okay, well, if this is a 50 pip range, man, I can grab maybe 20 pips out of it real quick and be out of it because price may start doing some dirty dancing here, right? So something very important. And then, oh yeah, and then price started ranging here. How's my pace? My pace good, fast, slow? I think it's good. Pace is pretty good. Pretty good pace. Good, perfect. Ooh, sexy pace. Nice. Man, I can't believe Zoom started finessing us in the start, man. I was pretty disappointed. I was actually very embarrassed because I had a very streamlined webinar planned, and in the start, just Zoom just didn't want to do it. And I also feel bad for Ted because Ted had a very bad audio quality there too, but we made it work. All right, let's continue on here. Um, this is like the last portion we're gonna go on. After this, we're gonna go over trading plans. So let's take a look here. So basically, now rejections happen when price reaches a strong support or a resistance. This is like the example. This is like the example we had in the previous example where price went up to resistance and then the candle closed bearish and then we start to go down. So all these examples are almost the same. The examples are all almost the same, right? So now if you look at here, the higher the time frame, stronger the zone. This is when we go back to the apartment complex example where we talked about how you have an apartment complex and you have different levels there, and different levels are stronger. So the weekly is stronger. Now the 1 hour is stronger than the 30 minute. 4 hours stronger than the 1 hour, and daily is stronger than a 4 hour, so on and so forth. So never sell when price is moving towards a resistance. Never ever do that. Never buy when price is moving towards support. It's really good to have like a wick entry and show off to your friends who don't really care about what you do, or it's really good to have that wick entry and post it on Instagram to people who don't really benefit you in any way. It's always going to hurt you. Whenever price is moving to a support and you want to take a buy just because you could have a wick entry, stop it. Don't do that. I used to do that, and most of the times it didn't work. Always wait for candles to flip in your direction. Always wait for candles to flip in your direction. 15-minute is risky. 30-minute is less risky. Trading in general is risky, but we only trade based on good probabilities. Right, so 15-minute, I think as you guys start watching the charts from a new perspective after we're done today, you're going to start to have a newfound respect for candles. You're going to have a new respect for 15-minute being a risky time frame, 30-minute being less risky time frame, and so on and so forth. Lower time frame has a lower probability of moving in your direction. I've been saying this over and over and over again, right? Higher time frame has a higher probability of moving in your direction. So get a tramp stamp, get a tattoo, get like put it down in like lower time frames. Don't base your trades off of lower time frame analysis unless you are experienced enough, unless you've seen things happen over and over again. It's very, very important. Um, let's take a look at some examples here. Now, when we're looking at this, what do we see here? What do we see here? First thing we see here is First thing we see, candles are going bearish, right? Whenever candles go bearish, they go bearish from a support. So, oh, sorry, resistance. So we have a resistance here. Now, notice how I'm not plotting my resistance like this. I'm not plotting it like this. I'm plotting the resistance um, like, let me just do it again. I'm plotting the resistance kind of like this. Like I'm including some wicks, like a ballpark value. Like it's very neat. It looks very neat here. So now this is it. And now when we look down here, maybe price came down to some sort of a support zone. It came down to a support zone. So what are we looking at? Let's say if this is a big range, 40, 50 pip range. So that's what we look. So let's see here what kind of. So we can't take a sell here because we're potentially down to a support. We can't take a buy here because candles are bearish. So we just like, yeah, whatever. Um, okay, this candle closed with no wick at the bottom. See this? Now we're getting these examples here, right? Candle closing with no wick at the bottom, so we don't know what the hell is happening here. Over here, we can also see this candle closed with no wick at the bottom. It just went up, whatever. We're just focused on right over here. And the next candle closed bullish. We have a candle closing bullish, right, at support. If this is a 30-minute or the 1 hour support, someone can say, well, it hasn't really broken the high of the previous candle, but it still seems like it can go up. Someone can say it seems like it can go up. Like, when you like really twitch your eyes really close, you're like, it seems like it can go up, but it's a small body. There's a rejection here, so might want to wait a little bit. But what's the bias? I want to know the bias. What's the bias here? Bias. Okay. Bearish. Someone said bearish. The candle closed bullish at support. So the bias can't be bearish. The bias is bullish, but not 100%, not like 80%. It's like less bullish, like it's less bullish. Ooh, wow. Yeah, it did go up. It did go up. So now can we take a buy? Maybe, like a wick fill? Probably we could get a wick fill. Maybe we missed this trade. Let's see what happens. Oh, nice. Wick fill. And then probably it's going to continue moving. Oh, that's it. Yeah, Wickfield. So bias was bullish. I think this was a difficult confirmation here. This was a very hard confirmation here because the candle body was kind of like meh. It didn't really break the highs over here, but eventually it did reject here. I think the other thing is that since this candle closed with no wick at the bottom, this This told us that okay, there's no bearish confirmation here because that bearish candle didn't even have a wick at the bottom, and the next bullish candle tried going down, but it couldn't go down. So now the next candle, it was a maybe, yeah, someone just said something very nice. Miles said that maybe we could have reduced our risk. That's very important. As you go along, you will feel that some trade setups are going to be some are going to have a very high probability, and some trade setups are going to have very low probability. So at that point, you will have to decide, okay, if something has a low probability, something like this here, right, might want to reduce the risk a little bit. Might reduce the risk and take the trade so that if it runs, you feel good about it. But if it goes down, then you're like, okay, whatever, it got stopped out, but I risked something less. Why do wicks must get filled? Wicks get filled when price is in momentum. That's why wicks get filled. Like this candle had no wick, price didn't go down. This candle has a wick. Wicks basically mean, like when you watch cartoons, and in cartoons when the cartoon character, it's dark and they go in a maze, and then when they go in a maze they leave breadcrumbs. They leave breadcrumbs for their friends to follow the breadcrumbs, and then they can find the guy. So wicks are like breadcrumbs. When price is moving bullish and you have, are they unfilled orders? I don't know. That's an advanced concept. So when you have a wick over here, this means price has left breadcrumbs for the next candle to fulfill. So if this wick is going to get filled, candle has to respect the low of the previous candle, which is going to be it has to move bullish, right? Which it went bullish to almost fill the wick, and then it went higher, right? So wicks are known as destinations too. If price moves up, it's like a destination. So, oh, let me just remove these here. All right. What's happening at this point? We are support formed. That's true. We have a support formed. Kind of like looks like a downtrend. Maybe, like maybe price was coming down from this area here. So yeah, this is someone saying bearish, someone saying support formed. See what happens here. Oh, we're going up. We're going up to that same area there. We're closing, a candle is closing like this. We can't take a buy at this point because we're at some sort of a resistance area. We can't take a sell. Essentially, price did make a low. We can't take a sell because there's no confirmation to take a sell. Now we have a candle closing like this. It's creating a lower high and a lower low, you know. So someone is saying we'll take a sell with a lower risk. Someone is saying that we'll take a sell and a stop loss is going to be above the previous candle with a lower risk. So what's going to be the bias here? Take a sell, no wick to the upside. Okay, okay, okay. See what happens here. Nice, perfect. See, now someone is saying, oh, someone said, okay, full margin sells. Yeah, so see now the conservative party was like, well, this candle is bearish, but we want to be careful. Now they're saying, okay, perfect. Now the conservatives are becoming liberals now. They want to like, okay, perfect, let's take a sell over here. So for this to continue down, now here's the thing. When price is going to continue bearish, it has to make lower highs and lower lows. Uh, Moga Lifestyle says he's selling now, so makes sense. Let's take a look here. Perfect. Awesome. This is picture perfect sells. This is like you won a trade, but like not actually won a trade, but it actually worked out. Price respected support as well. Exactly. It respected support as well. So it was pretty good. Yeah, this was like the trade on GJ when the week closed. Oh wow! So runner kept running here. Beautiful. Perfect. And it continued going. All right, let's move to the next example here. So, what's going on here? We have formed. All right, let me get my. Okay, man, my computer is getting slow over here. It's my computer is getting tired. Okay, I guess we're just ranging here, right? Yeah, we're just ranging here. Downtrend, lower high formed, yeah, downtrend. Kind of like a resistance formed over here. Don't really know what's going on. Can't take a sell because support's right there. Can't take a buy. This is how I approach trading. Whenever you're looking at whenever you're looking at the chart, you always ask yourself. Now, if we're looking at this chart, I always ask myself, can I take a sell? I can't take a sell because the support's right there. I can't take a buy because candles are bearish. So there's no trade. So basically, I'm waiting right now. Oh, come on, man, move. Okay, perfect. Now we have a candle closing bullish, but at the same time, candle is at this resistance area here as well. And I guess after we cross this resistance area, there's going to be a clean move going up to this area. Make sense? Makes sense. Oh, see, this is why we didn't buy over here. We're waiting. Oh, wow, perfect. We're breaking up right now. Now what's going on? Nice. So there's a, oh, someone's taking a buys. What exactly do you mean by clean move? Okay, what I mean by clean move is when you're looking left to see that we had a clean move coming down, right? Whenever you have a clean move coming down like this, candles are more prone to repeat that clean move going up. This is what I mean by clean move. Whenever to the left you see there was a clean move, then there's a higher chance candles will mirror that move. That's what basically it means. Um, Someone's waiting, and someone's waiting for a retest. Oh, shit. Wow, that was uncalled for. That candle just came out of nowhere. Basically, what's going on over here is now since we missed this buy, right? Since this buy was missed, could we have taken a buy with a lower risk? Yes, we could have taken a buy with a lower risk. So let me just go back here. Okay, perfect. So one thing is this was the breakout candle. One thing what I've noticed is I haven't really back tested this enough to say for sure, but but what I've noticed is that whenever you have a candle that breaks out of a resistance, there's a very less chance that the preceding candles are going to break the low of that breakout candle. Make sense? So this is the breakout candle. So there's a very less chance the next candles will break the low of the breakout candle. So I think if I was trading this in a live environment, I would have taken a buy with a lower risk. Because if this was something like GJ or gold, normally they don't do retest, normally they just keep on running. So maybe a lower risk would have worked. Wait for a retest in these situations or have a buy stop. See, that's something we don't know. Someone is asking, should we use a buy stop or a retest? We don't know that. It is what it is. Sometimes you wait for a retest, and while you're waiting for a retest, you have a big candle just prints on the chart like this. And you're like, wow, it was just didn't really know what to do. So that's something very important. Sometimes price just moves the way it wants to move. Sometimes it's going to do a retest. In the previous examples, we've been looking at a lot of charts and we saw that charts did retests, but in some examples, we saw price just kept on moving like this. So when this happens, this will happen to you over and over again, right? And okay, what's this? Would you have bought for the fact that it closed back in that zone and above the other candles to the left? Yes. Yes, exactly. So I've seen this happen over and over again, and slowly I've been training my mind to take a buy at the breakout candle because sometimes there will be no retest. So when there will be no retest, I want to get in on that trade. Okay. In the lower time frame, yeah, could have been a retest on a lower time frame. So let's continue on here. Let me just grab my eraser and remove this. And let's move on to the next man. My zoom is getting really slow. Wow. Holy cow. All right. Ooh, what's going on over here? We have a resistance forming right over here, right? We have a resistance forming here, and we have some sort of a support forming here, right? There was a gap over here. There was a gap, price gapped above this area, kind of forming a support, kind of forming a resistance. So we're kind of waiting right now for some confirmations here. All right, candle is closing above this area. Perfect. This is what happened in the last example here too, right? This has happened in the last example here too. Now, here either you can take a buy with a like I'd say like a lower risk because it's a breakout candle. It could kind of like come down and like retest, or it could continue moving up. We don't know, so we have to wait for either someone's going to wait for a retest or someone's going to take a buy with a lower risk because it's a breakout candle. So let's see what the next candle does. Perfect. Made sense. Made sense. See now, see now the next the previous example, same thing happened. We missed the buy, you know, and this is going to happen over and over again. Over and over again, you will miss trades, and as you miss trades, you will try to train your mind to see, okay, how could I have caught this trade even with the lower risk? So I think this was a really good example where you saw that okay, price broke above resistance. This is a breakout candle. It's making higher highs, higher lows. What are the chances that the previous example can play out again without a retest? You could say, man, there's still a chance it could happen. So I might want to take a lower risk trade. And you take a lower risk trade and it runs, you're like, perfect. It happened, right? So let's wait to see what the next candle does. Next candle comes down. Someone who's waiting for a retest. So this is where you're getting your retest here for a continuation up. A candle is closing bullish like this. Was that actually a retest wick? Yes. Yes, Joe Alexander. That was kind of like a retest wick. But this buy was just based on the fact that we saw this happen previously, so we anticipated it to happen again here as well. So let's see what happens after this candle. Thank you for all this paper trading, Raja, making us more confident at executing. That's it. It's just practice. Honestly, it's just doing the same things over and over and over and over again to the point where you start dreaming about it. Man, the other night I was dreaming about we were in a storm. We were in a ship. We were sailing with some cargo. That cargo had our money in it, and we were moving from coast to coast. And all of a sudden, this wave comes on, and this wave has a bullish candle going up. And we're like, oh, such a bullish candle over here. We have to wait for a retest so we can go around the candles. And the retest came, candles came down, and I mean, yeah, it's just you start seeing those things in your dreams too. So, yeah, see, retest. This was a retest. So candle closed bullish, and you took a buy, and candle went up. Perfect retest. So we waited here. Someone took buys here, and then we had a bearish candle come down, and then we had a bullish candle formed, creating support on the 1 hour. And if it broke above resistance, there's a high probability that the next candle is going to go up. And the only wet dreams. And the only reason the next candle is going to go up if it respects the low of the previous candle, right? So it starts to go up. And also understand this. This only happens when there's volume in the market. When markets open, when markets are closing, I think after news events, when the markets are open, when the markets are rocking and rolling, this only happens at that time. It's not going to happen in the afternoon of New York session. It's not going to happen after, like let's say once the Asian movement is done. It's not going to happen before pre-London. It's only going to happen when there's volume in the market. Oh yeah, see, it's continued moving up, and then it did what it had to do. What's that now retest you're talking about? Oh, this retest right here. Like price went up. I'm trying to get my marker here. Price went up after breaking this resistance. Candle came down to do a retest. This candle closed bullish, hence a support has been formed, and we've broken above. So break, retest, support formed. What's the probability of the next candle to continue going up since it broke out of resistance? Someone can say, I think it's a pretty high probability. So you're like, okay, perfect. If I'm going to take a buy, I'll leave my stop below the candle right over here, and I'm going to anticipate the next price to continue moving bullish, bullish, and then bearish, and then ranging. Um, Raja, do you wait for retest with the same time frame, or do you usually look for on a lower time frame? It all depends. It all depends. It all depends. I wait for it. It basically depends what's happening in the market, but this is exactly what I wait for. Ted Monty and trade only zones. I mean, this is the only way to trade. I mean, you draw your zones, you draw support, and then you just see how price is reacting to that, and you basically take a trade on that. Okay, let's go to the next example here. All right. This looks like it's very, very difficult. Did you try another trading style? I tried. Okay, so we're going to answer these questions in the end. We're approaching the end of this webinar here. So right now, this is extremely difficult. There's no sense. There's no sense of what's happening here. Let's take a look at the next candle. Ooh, next candle went bullish. See, next candle went bullish. It broke the low of the previous candle, so it didn't respect the high thing. It also created no wick at the top. So far there's no trade. We can't take a buy because candle has no wick on the top. We can't take a sell because candle is bullish. So we're waiting for the next candle to form. Lovely. Next candle forms bullish. We can't do anything either. Wow, next candle goes more bullish. Wow, well, so far I think we missed the trade. Now candle is forming bearish. Um, yeah, I don't know, man. Looks like it's creating a high over there. Looks like it's creating a high to continue to go up. I mean, it's very difficult here. Still waiting. Candle's closing bearish here. Wow. Yeah, I would have missed that trade. Oh, candle's closing some sort of a bullish candle here. We're getting some sort of information here that maybe this little downtrend is exhausting, and we might see a support forming over here. If I see a support forming it, okay, what's going on over here now? What are we doing? Someone said buys. Buys above the break of the wick. We're not talking about the buys above the break of the wicks or anything like that. We're just talking about what's happening currently right now. Currently right now, if you take a buy, okay, here's the thing. If your bias is bias, let me talk about when guys say, okay, let's take a buy above the wick. If your bias is buys, right, your stop is going to be right over here, below the low of the candle. If you take a buy over here, this is your stop loss. If you take a buy over here, your stop loss is huge, man. That's a really big stop loss, right? So price broke above this resistance. Where is the resistance? Okay, so price broke above this resistance. on, man. Okay. And then price went up, created a high, came down, created a support based on everything that we've learned in the past 5 hours. It indicates that this will be a good opportunity to take a buy because price is creating a support. There's a high formed. There's a what's the probability? Okay, what's the probability price is going to go up? What's the probability price is going to go up? Is it high or low? 80%. Someone said high. It's pretty high. So there's no reason to overthink things. When you start overthinking things, that's when it gets pretty hard. So let's see. See, you took a buy, candle went up, now you're securing profits. You wrote this one 30-minute candle all the way up over here. You're securing profits, you're putting stops at break even, you're doing all those things to secure yourself because next candle can continue going up as well. Let's see here. Oh, next candle started going bearish. So you secured profits and now you have a runner and you're like, okay, maybe now I want to close the runner or whatever because wow, price just went down. So it's very important. The first candle closing, there's a higher chance for the next candle to continue moving bullish. That's what we've learned in the last 5 hours here. Perfect. So um, the next topic we have trading plan. Trading plan is really, really important. After we're done from this webinar, I expect everyone to create a trading plan. Take your time. There's no rush. There's no need to trade next week. Next week, instead of trading, you can just, watch some webinars because everyone's going to get, okay, that's going to come in the end. Next week, you can just watch stuff, watch how price moves, watch how things actually make sense. But most importantly, create a trading plan, right? And this is going to be the basis of your trading plan right here. First, you're going to think about what time are you going to trade, right? This is really important. What time suits your lifestyle? What time do you have in the day to trade? Do you work at 9 a.m. in the morning? Can you trade early mornings? When I used to work, I used to go to my office. I used to leave for my office at around 8:30 a.m. So I would trade from 5:30 to 8 a.m. 3.5 hours. No, actually 2.5 hours. I would do that. Then I would say that okay, if I have that time to trade early morning, what session is that going to be? Is that going to be New York session, London session, Asian? So I have to understand that. Okay, so I knew okay, I'm going to have New York session to trade. So I'm going to write that down. So I'm going to write down the time. I'm going to write down what session I'm going to trade, and then I'm going to say okay, is there going to be enough volume at the time that I'm going to trade? Like if you have time to trade between like the New York afternoon, there might not be enough volume to trade at that time. Some people they do work, and they have time to trade at the time when there's no volume. When there's no volume, then you might be looking at the higher time frames, the 4 hour, to see if you can maybe get like a higher time frame trade based on the candles or not. But the most important is you're understanding if there's going to be volume to trade at that time or not, right? And then you're going to see that okay, if there's going to be any news coming at that time or not. I think my jaw muscles are making some abs right now from all the talking. So first off, there's going to be time to trade, right? Next is going to be my jaw's getting gains. Next is going to be what pairs are you going to trade? Like are the pairs which you're going to choose, are they in session? Are the pairs correlated? We talked about pair correlation in the very, very beginning, where we said that okay, if you want to choose, let's say GBP USD in the New York, you might find that the pound and the USD is gonna the pound and the USD are they might move this they might consolidate because like in the New York session, pound and USD is influenced by both pairs, right? With both currencies, sorry. And then you're going to see okay, how is the spread of the pair that you're going to choose? Is the spread too big? Is the spread too low? So those things really matter as well. Next thing is going to be, have you watched the pair enough? Have you sat and really back tested it? Back tested means have you live tested the pair or not? We did a webinar that I'm going to share that that you guys will find in the drive. It's about live back testing and back testing. That's very important. So how's the spread? Have you watched a pair enough? So when I started trading GPJPY, I watched GPJPY for about a month in New York session to see how it moves. Do I really understand the fundamentals behind it? We didn't really go over fundamentals a lot. That's left for another time because I didn't want to overload a lot of people with a lot of information, right? So do you understand the fundamentals? Like if someone's trading the USD CAD, right? Or if someone's trading CAD JPY in New York, then you might want to know that, okay, what are the news around oil? Because, like, oil moves CAD, or like if you're trading in the pound, you're knowing that, okay, what are news around Brexit? What are news around, like, with the coronavirus thing happening? What's Boris saying? What's the whole fundamentals around that pair, right? That's really important. So, time to trade, what pair to trade. Next, you're going to have risk management. This is really important. What's your daily risk, right? What's your daily risk? Am I comfortable risking that? That's also really important. Dynamic risk or static risk. If you're new, starting right now, I think you're going to be mostly focused on static risk. How many trades will I take in a day? That's also very important. I recommend 1 or 2 trades. What's my monthly, weekly goal? Let's say if your weekly goal or your monthly goal is 20%. Now you're breaking it down into weekly goals. Weekly goal might be 5% per week, and now if you break it down to a daily goal might be 1% a week, so now you put that in perspective that, okay, now I have some money in the bank. I have money in the bank in my savings account, and the bank offers me 2% a year. Now 2% a year is dog shit because I know that if I'm focusing on, let's say, 20% a month in trading, I can easily get 1% a day. If I'm getting 1% a day, that means I'm making 20% on my money a month. But if I focus on 20% a day, that's never going to happen. There's a very high chance I'm going to lose my money. So you have to really understand that. And the next thing is, what do you do when do you secure a runner? Like when do you cut losses short? And when do you leave a runner running? That's something you have to realize. Now, once we're done with this webinar, I'm going to upload it. It's going to be uploaded by tonight. I expect people to rewatch it, rewatch the risk management part. That's very, very, very important. You're going to really understand how to cut losses watching the risk management 3.0 part over and over again. Next, we have technical analysis, right? So we went over time to trade, what pair to trade, what risk to use, and then you have technical analysis, right? Technical analysis, what time frames are you going to focus on? Are you going to focus on the 4 hour, daily, 30-minute, 1 hour, all those things. If someone's going to focus on the 5-minute or the 15-minute, it's going to be very disappointing. Is there a valid support resistance formed? When you're talking about technical analysis, do you have a valid zone formed? Is there enough range for the price to move? Like if you have a 10 pip range, there might not be enough trade. If there's a 20 pip range, you could make it work. Or if there's a 40, 50 pip range, that's perfect. Has the candle closed in your direction? Extremely important part here too. Does the stop loss make sense? Is the stop loss too big? Is the stop loss too small? Is the stop loss at the wick or below the wick? Those things are very important when you're talking about technical analysis. Next, you have trade management, right? How are you managing the trade? Are you comfortable with your gain? Has trade moved in your favor? And are you comfortable with what you want to secure? I'm always comfortable in securing 10, 12, 15 pips, man. Since I started, I've been securing 10 pips since I started, June 2016. I'm guilty. People say, hey, they are the 10 pip army. Man, 10, 12, 15 pips has made me a lot of fucking money over the last 4 years. But the first year it was trial and error. I started learning. But second year hit, things just start to change because you start to understand that, okay, this is like you come in every day, you get what you can get, and then you just go back the next day. That's how it works. Are you comfortable with your gain? Like obviously, if you're looking at the 4 hour time frame, or if you're, hey, is my audio okay? Can you guys hear me? Hello. Okay, perfect. Yeah, so let's say if you're looking at the 4 hour and a daily, obviously your pip gain is going to be more. But if you're looking at the 30 minute, 1 hour, then you'd be looking at like 10 pips, 15 pips, 20 pips most of the time. So those things can work too. And once you're in profits, you're looking to see is your stops at break even or not. Most times what happens is when people are in profit, they don't put stops at break even, and something happens and price comes and hits a stop loss. That's a very sad situation to be in. So you need to see that, okay, are your stops at break even? Are your positions protected or not? Should I close partials in a loss? When you're managing your trade and when price is coming down into a drawdown, and sometimes when price comes in drawdown, it's going to hit your stop loss. You know that. But what are you doing to minimize that risk? Are you taking 50% off? Are you taking 75 off? What are you doing? Like, what are you up to? It's going to hit your stop loss. What the fuck are you doing? Are you closing partials so that you don't take the good hit? Or are you, like, saying that, hey, I'm going to secure 50% in a loss and then I'm going to let the rest hit my stop loss? That way you've now minimized your loss. That's a very effective way to keep your losses short. Like a lot of times people talk about, oh yeah, man, you know what I'm saying? You know what you got to do? Just keep your losses short, man. Keep your losses small and keep your winners big, man. It's going to work. But no one tells you how to do that. How? How are you going to do that? We talked about this. We had 3 sections on risk management. We talked about that. So that's how you're going to keep your losses short. Um, are you in profits for the day? For the day, are you up? If you're in profits, just remember, they say that only 90% people fail. I say 95% people fail. If you're in profits, man, you're in the top 5%. There was a day in April I made $12. And I called it a day at $12. In May, there was a day I made $118, and I called it a day at $118 because I was up for the day. I was up, man. I was in blues because I knew if I would have taken another trade, I'd be in a loss. So I didn't want to do that. I wanted to be in the top 5%, whether it's by a $1, whether it's by 50 cents, whether it's by $10,000. I want to be in the top 5%. Do you have a runner at break even? Sometimes, you think price is going to go, but you're scared. You're scared to let price run, just leave a runner. If you're so scared, man, just leave a point zero 0.01 run. If you're running a 10-cent lot, leave a point zero 0.01 run. There's nothing wrong in that. You're building confidence. As you leave runners running, you're going to build confidence in letting runners run. And after like a couple of months down the road, when you have runners running and they keep on running, you're going to say, okay, man, you know what? Fuck it. I'm going to leave my whole position running at break even because I've seen this run hard. And if this run is hard, I'm going to have a big payday. That's what happened to me this past week. This past week, I had a sell on GJ, and I had a 10 lot and it ran 50 pips. I had a big payday, and the last time I did that, I think was like a year and a half ago. Um, yeah, so, and then how do you journal your trades? Like, what are you doing when you journal your trades? What program are you using? What I personally use is, I'm going to write it down here. Come on, Zoom, work with me here. Trixie.trade. This is what I use to journal my trades, but most of the time I just keep um, I just keep before and after pictures of my journaling. I have a before trade picture and then I have an after trade picture. What that means is then I know what I was thinking and what actually happened. If it was a win, I'm like, perfect, it played out. Now I'm going to start to look for the same thing the next day as well. Someone mentioned Trello. Trello is another good thing here. You can Google Trello. I don't know what the website is, so Trello. Yeah, I think Paul and some other people use Trello, right? So at the same time, if you had a loss, if you had a losing trade, and if you had before and after pictures, what's going to happen is now you're going to look at the loss and you're going to say, okay, how could I have made this loss better? How could I have seen something how could I have seen something to take a better trade? We have a webinar in the database on gaps and losses as well, which I will highly encourage people to view. That will make you go over the fact how to analyze your losses. So it's going to be pretty good. Um, With that said, thank you very much for everyone who stuck it out here with me. I really appreciate it. I hope I answered m- most all the questions. I tried. We have some advanced concept webinars in the database. They're called Fakeouts Refresher. This is all on fakeouts. I wanted to include that in here as well. I wanted to include all this in here, but then again, I didn't want to overload people with like a lot of information, right? Because yeah, it would have been a whole lot of information. Then we have this webinar is really important, how to give trades a second chance. This will be really amazing. Gaps and losses is also a very good webinar here as well. With that said, if someone has, I hope I answered a lot of the questions. If you have, what is the percentage you recommend for each trade? That's totally up to you. That's totally up to you. You can use 1% per trade. You can use 2% per trade. You don't use more than 5%. That's all what I got to say. I think if you're starting out, I recommend everyone to start out with 1% per trade. Let me bring the Zoom screen over here. Yeah, start with 1% per trade if you're starting out. Just a few words on momentum. Okay, hold on. Let me just see here. Come on, Zoom, cooperate with me here a little bit. How do we obtain those webinars? Well, you will obtain those webinars. We will have an announcement. Um, Man, Zoom is not working. If it continues on like this, we'll have to end the session here. Uh, do you put? Thank you for putting this together. Oh yes, you're welcome, welcome. Did you try another trading style? Yes, and honestly, I tried a lot of trading styles, and at the end of the day, what I really understood was if I don't understand how candles move, I can't trade. That was at the end of the day, that's what I realized that if I can't understand candles, I can't basically trade. So I just started focusing on candles. I started focusing on trading the 30-minute and 1 hour, and it worked really well. Few words on momentum when sessions close. When sessions close, there's momentum because there's a lot of volume in the market. You will see like London close, it's going to have a lot of volume. So far, I've only seen London close have a lot of volume. London close. Do you journal your trades? Yes, my journaling is done on my YouTube stream where I go over the trades and see how I could have done better, or if I took a loss, how I could have done better. But before that, I used to journal by keeping screenshots of like before and after trades. Sometimes, people in the group, they send me their charts as well, so I can review them as well. So if you want, you can send me your charts. I can look at them as well. Do we only trade with the trend? Yes. I mean, that's the only way to trade. Someone sent some code. I don't know what that is, so we're going to skip over that. If you're waiting for a 30-minute bullish close and it closes bullish, but the 15-minute is bearish, would that put you off? Yes, that at that point, I may look to reduce my risk. When price creates long wicks, do you look at that price as wanting to go in the opposite direction? No, not really. That depends on what. That's very subjective. That's very subjective on what's happening on the higher time frames as well. So every situation is different in that aspect. TED section was great. Too bad it was only, yeah, I know TED's audio was pretty off, so we'll try to fix that. Are you sending out generic emails for those that can access the database? Yes, as soon as I'm done with this, I can get that done. Will you let us know when the content is available? Yes. Would looking at multiple confirmations on different time frame to confirm your bias a good idea? Yes, exactly. It is. Looking at like if different time frames give you different ideas, then that's good. Is there info on about how to post a chart? Yeah, you can just post a chart, whichever channel you feel like posting a chart in. You no longer trade Bitcoin? No. What is the next step after this orientation? Well, let me get off this orientation and then we will go to the next steps. But if I'm get stuck here, then we'll stuck here. Confirmations, able to explain briefly. I understood as candle closing. Hamayu, you need to rewatch this webinar. We talked a lot about confirmations. Will you ever release your mixtape? Probably if someone pays me some money. Thank you for your work. Thank you. Thank you. Webinars usually on Sunday. They're usually every other week on Saturdays. Is there info on how to post chart? Should I use constant risk management for each trade? Yes. Keep your risk steady. Keep your wrist steady for each trade. Okay, everybody, so I'm going to head off here. I've been fasting the whole day. I need some rest. Hope this was insightful. So ending steps is going to be I'm going to spend the next hour in giving everyone access to the database. Once that's done, I will let everyone know in the main channel. So it will take around 3 or 4 hours until you all will get your logins activated. If someone who don't have their logins activated, you will be given a generic account to access the database. What else? Yeah, I guess that's about it. Take care, everyone. Thank you for joining, and we'll see you tomorrow morning.